and is crucial to manufacturing of several gadgets like mobile phones, wind turbines, electric vehicles, aerospace, among others as well. Among the 20 bidders, the listed entities that come in are L&T, Coal India, 20 Micros, as well as a Renew Private, which are a part of this as well. So that's the latest update that we have coming in on the rare earth magnet scheme. But let's move on and go back to Rachna again, who is going to give us an update in the world of tech and AI in our special segment, AI Pulse. As always, Rachna, back to you.
Well, first up is Databricks that has closed a $5 billion round at a $190 billion valuation. This is up from the $188 billion valuation that was announced in the month of July. Now, Premji Invest is a new investor. CEO Ali Godse says Databricks intends to list but sees too much distraction in public markets right now. And speaking of listing, one of the most weighted ones this year is, of course, Anthropic, but its early investor meetings that have started are not covering specific financials or a valuation. As per CNBC, CFO Krishna Rao is leading these meetings focused on the Claude models and management. Then there's AMD that has raised $4.75 billion in its biggest ever dollar bond sale across 4 tranches. AMD has committed up to $5 billion to Anthropic. Similarly, Intel raised about $20 billion in an upsized stock offering just this week. Two new launches then. Google has launched Gemini 3.7 Flash just 3 weeks after 3.6 Flash, halving the introductory pricing to 75 cents per million input tokens and $3.75 per million output tokens. Those rates double from the 1st of January. OpenAI has also previewed a mode called Ultra Fast, which it says runs on GPT 5.6 Sol at 14 times the standard speed and up to 750 output tokens a second. This is on its Cerebras partnership, and only a small group of customers can access it. Then there's IBM that's partnering with OpenAI on enterprise AI. The terms, however, remain undisclosed. IBM will set up a dedicated OpenAI practice and says it will train tens of thousands of consultants, and this deal follows OpenAI tie-ups with Infosys and TCS here in India. Then there's Microsoft that has shut at least 15 offices and joint ventures in China over 5 years, and Wade leaving in 2023 as per Reuters. It stayed because Azure serves Chinese firms like ByteDance going global. Analysts question how long that holds. That's all we have from the world of tech and AI for now.
Absolutely, Rachna. Thank you so much for that. But with that, we are absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Up next, your Bazaar Morning Call. Stay tuned in.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. Welcome to Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I am Reema Tendulkar. With me is Nigel, and Prashant will be joining us in just a bit. And before anything, happy Independence Day to all our viewers. May this year bring in, all the colors of the flag, right? Orange for strength, courage, white for peace, green for fertility, and the Ashoka Chakra, which stands for the laws of Dharma and constant movement.
Well, that's right. Independence Day, proudest moment for all of us Indians. So, we are in the attire as well, Indian attire for that special day. But we've got an interesting trading session as well, Reema, ahead of us.
Well, indeed. So let's take it from the top in terms of the queue. So U.S. markets ended higher yesterday. The S&P 500 makes a new record high. It crosses that 7,800 mark, ending with a gain of about 0.65%. The Nasdaq was the outperformer, and you had gains coming in names like Meta, Micron, and Netflix. This at a time when the war continues to chug on and on. So one of the key drivers for the U.S. market rally was the inflation print. We had a benign or a tame CPI inflation print 2 days prior. Yesterday, we got the July PPI, and it came in at 0% month-on-month versus estimates of just a 0.2% growth. So that was a positive. Therefore, the U.S. 10-year bond yield cooled to levels of 4.64%. At the start of this week, we were closer to 4.7%, and now the probability of a September rate hike has further come down. It was at 48% prior to the CPI inflation print, came down to 40%, and now it's further come down to 35%. A quick update on crude. Well, crude, when we started this week, we were closer to 90, but in the past 2 days, crude prices have been around that 88. In fact, now as we speak, we're even below that $87 per barrel, even as the stalemate on the war continues. Iran, Oman, yet to reach any sort of an agreement on the Strait of Hormuz. There are two watch points on the global front. One is the U.S. long-term bond yields. So yesterday, the U.S. markets conducted an auction, and the 30-year bond yields hit 5.2%. This is the highest level that we've seen since 2001. And in a way, it does complicate the issue for for Donald Trump, Scott Bessent ahead of the midterm elections, and the fact that the entire underpinnings of the AI rally is now moving to the bond market. So that's going to be important to watch. And secondly, the USD JPY, that's the yen. It's closer to 160, again getting, weakening. And there was a Bloomberg article which says that Bank of Japan could raise interest rates in September or October. But it's the last day of the earnings season. It's a Friday. And so far, this week, the markets have been fairly range-bound. If you look at it on a week-to-date basis, the Nifty is down 0.7%, while the mid-cap index is up 1%. But Nigel, Friday, yay!
Yeah, that's right. Friday, and in yesterday's trading session, you got some spice actually on a Thursday because it was the Sensex weekly expiry that played out. And the cash session, in fact, it had a bit of spice out there because the 78,000 call, you did see a big premium spike out there. And on the put side, there was a big crash. That's because suddenly in that cash session, you had a big spike on the Sensex itself. So that could realign itself just at the start of today's trading session. The good news, though, from an India perspective, is that Brent crude prices, after hitting a high of around $91 just a few sessions ago, that's holding sub $87 per barrel, which is good news. Well, in terms of flows, the FIs are mild sellers, 500 crores or thereabouts. The DI is bought. Remember, we've been seeing large trades as well. So that's why, that data, you're not getting any big trend out there. But in terms of the FI action on index futures, they went ahead. They had 3,500 contracts on the short side. 87% of their positionings are on the short side. While on stock futures, they did the reverse because they added more longs than short positioning. Moving to what were they doing in terms of the writing action on index options? Well, they went ahead. They wrote more calls than puts in yesterday's trading session. But I made this point yesterday. For the last 5 trading sessions, the Nifty was making lower lows. Now, yesterday, that trend seems to have got broken, which is good. So in terms of a reference point on the downside, you don't want this level to actually break. You want this trend to continue, continue to make higher lows as well, which happened yesterday. Moving to the options data, then you had the 24,500 call, premium around 70 rupees out there. While on the downside, the 24,350 put, the premium over there around 65 rupees or thereabouts. So looking at these premiums, looking at the technical levels as well, I've got a couple of reference points. The recent low, which is at around the 24,226, that becomes the level of support. You don't want that to get breached on the downside in today's trading session. On the upside, I think there's very firm resistance at around the 24,600, or you'll have crude oil prices to come down, or maybe a fresh trigger to help us get past that particular mark. So that's going to be important. For the time being, this is the 400-point range, 350, 400-point range that I'm looking at. The Nifty Bank, well, it's very, very crowded because the 20, 50 as well as 200 DMA, all of them are in the vicinity of where it ended yesterday. So you don't want this level to get breached on the downside, the 50 DMA, 200-300 points. So for the day, you don't mind some kind of consolidation, but I think the bias continues to remain on the positive side, particularly since Brent crude prices have pulled off. So the bulls will latch onto that.
Nigel, hi, morning. Rima, hi, morning.
Hi.
And welcome.
Happy 15th August. Happy Independence Day to all of us here. I think we've covered most stuff in terms of the cues that you need to watch. But just two things, right? Oil's cooled off, and that is great news. From a high of 90 plus earlier this week to about 87. But this is going into one more weekend. And, every Friday, it's that conundrum. How will you wake up on the other side of this weekend on Monday morning when we come back? Why are oil prices down a little bit? I'm really not sure, because you look at the commentary, there are just two comments. And both kind of point to the same, the more of the same, and not a change. That's Secretary Besant saying that, we're going to do stuff we've never done before. Well, that's not de-escalation, right? I mean, we'll isolate Iran in such a way that, the world's never seen, and there's some rhetoric to that end. And the U.S. Defense Secretary also saying that U.S. can sustain its blockade against Iran indefinitely. So that's the other one. So there are two comments there. Otherwise, I mean, that's the only thing I wanted to point out, which is that you, once again, going into this weekend, it's a Friday. Markets, of course, always hopeful, and they will react if there are comments, etc., any signs of a deal, etc., which emerge. But it could go the other way as well, as we've seen over the last 2 weekends. So just keep that in mind. If you're trading, I think that becomes more relevant. Otherwise, I think, as Rima has said, U.S. markets have been good. Chip makers have done well. What's interesting is you look at on the bond side, right? The 2-year is down sharply, whereas the 30-year is up. So the bond curve is steepening, and it's one of the steepest steepening we've seen in a long, long time. So, and that's not great news, right? I mean, the near-term cost of funding is dropping. The long end is actually rising. More on this a little later, and I think our guests will be able to weigh in as well. And I think, as Nigel pointed out, yesterday, once again, the cash session played up. Every day since we've begun, and this is, by the way, end of week 2 as far as the cash session goes, it looked like the gap is narrowing between 330 and 315. Yesterday, it widened. So the Nifty was up 40 points from 315 prices, and the Sensex was up 200 points from 315 prices. So they will correct. That'll adjust a little bit today. That adjustment needs to take place. And because between 315 and 330, the Nifty jumped 40 points, we closed above the resistance. But I'm still putting that as the resistance because after correction, we'll be under the first resistance, which will come up on your screen, which is 24,390. That's the first resistance. Then 24,500 on the downward sloping trend line. Actually, the exact number is 24,494, but 24,500 rounded off. And then, of course, if that is taken out, the projection, the channel projection, which comes in at 24,800, supports at 24,350 and 24,260. In that sense, is where we are at. So that's a quick bit out there. Taimur Beg is now with us, Managing Director and Chief Economist at DBS Group Research. Taimur, good to have you with us here. I just wanted to address the steepening, which I was sort of talking about. What does it indicate, and does it have? Will markets start to worry at some point, especially equities?
I think it's a big story in the making. And in fact, it is tied to the measures that the U.S. has taken to coordinate with Japan to intervene on the yen. I don't think the U.S. did that as a favor to the Japanese. They did it to stabilize their bond market because the rising long end yield and the steepening of the curve does worry the U.S. Treasury and the Federal Reserve alike. Consider the following. In the So the lead up to Donald Trump's election, Scott Bessent, who was hoping to get the Treasury job at that time, is to criticize Janet Yellen for pursuing irresponsible fiscal policy. What was she doing? She was issuing a whole lot of bond at the short end of the spectrum because the view was that the long end is not capable of absorbing the multi-trillion-dollar issuance that the U.S. was doing at that point. Well, 2 years later, nothing has changed. The U.S. is still relying on multi-trillion-dollar issuance, over $1 trillion worth of interest payment, and all of those things require even more printing of U.S. Treasuries. Who's going to absorb all that? Well, in the case of Scott Bessent, after he became Treasury, he followed the exact same path of Yellen, which is double down on short-term issuance. So the long end would tick up. There's not that much support there, even if there is not a lot of issuance there. And by the way, it has a real cost, which is U.S. mortgage rates, which take their cue from long end. So the steepening is not just an artifact of lack of supply on that side. It's an impact on U.S. residential real estate market is substantial. So going forward, we will probably see a scenario of financial repression under which the U.S. comes up with innovative ways to force both local financial institutions as well as nudge foreign allies, quote unquote, to hold and not sell U.S. treasuries. Otherwise, the steepening would get even more acute.
Just come in. Very simply put for our viewers, right? What does the steepening mean? When the near-term cost of funding drops and the long end rises, what does it indicate?
Well, there are two kinds of steepening. There's a bull steepening and a bear steepening, right? So if we are going to think of a situation in which we're giving up on the Fed from hiking rates anymore because inflation is not that huge a concern, then the focus entirely shifts on the fiscal aspect. That is there sufficient capacity of the market to absorb all the issuance that is coming in? If the answer is no, then the long end will start selling off. And as a result, even if the Treasury and the Fed are coordinating to keep the short end anchor, there's only so much they can do under the current toolbox, and we will start seeing what we call a steepening of the curve. Now, if inflation were to completely disappear tomorrow, if the US were to enter a massive growth spurt around which tax revenues surprise on the upside and fiscal starts to improve, then of course we can expect a gradual shifting down of the curve. We're not in that territory at all. There is no signal whatsoever coming from the US fiscal authorities about any meaningful consolidation down the road. And despite the AI boom, there is no indication of a massive spurt in US GDP. So it is hard to see a situation under which, without additional job owning from the Fed and Treasury, how the steepening is prevented.
But Taimur, what does this mean for the equity markets? Debt markets and equity markets are connected, and yet you almost get the sense they're disconnected. The U.S. bull run is now in its fourth year. It was a record high for S&P 500. And at the same time, we're talking about this credit market, which is in a way flashing a warning sign. How is this going to feed into what's happening with the equity markets?
So, Rima, you're absolutely right that there is a very strong connection between the yield and the equity market. We call it the yield gap, the dividend that is being issued by the stock market vis-a-vis the risk-free return that you can get by investing in debt. That yield gap right now is basically at an all-time high. Basically, the kind of highs that we saw in the lead up to the global financial crisis, that's the kind of yield we're seeing. So as the curve steepens, from a risk-free return perspective, the stock market's ability to attract flows just on the dividend versus risk-free return, it just diminishes extraordinarily. Now, you could argue nobody cares about this yield gap measure anymore. We only care about growth, and therefore all those tech stocks that give you zero dividend but promise 20, 30% gain every single year, that's what matters. Well, I suppose it is true to some extent that we are talking about a long-term measure of valuation versus short-term market momentum. Clearly, the short-term market momentum is massive. New IPOs, all sorts of new promises from the AI spectrum is keeping investors, both American and global investors. You know, we will, I'm sure, at some point talk about Japan. One of the reasons why Japan's flows of funds is so unfavorable, despite running such a large current account surplus, is because the Japanese want to be long U.S. stock market and they want to put their money in the U.S.
All right. Taimur, we'll leave it there. Thank you very much for joining us. Good speaking with you. It's always a pleasure having you here on CNBC TV 18. We'll take a quick look at what's lined up here in terms of interactions, and it's a fair bit, right? So we've got the management of Galaxy Surfactants to discuss their first quarter numbers. That's coming up at 8:39. We're joined by Rajesh Ravi of HDFC to focus on the cement space. 9:20, it's markets with Motilal Oswal's Rajat Rajgadia and Gautam Duggar. 9:30, the management of LG Electronics on their first quarter numbers. There's a call later this evening. Brigade Enterprises will be speaking with us at 9:40 on their earnings. 9:50, we have the management of Arvind. Another earnings discussion at 10, and that's Page Industries, which reported numbers in the last hour yesterday. We've got the management of Canara Bank joining us at 10:15 on numbers and the road ahead.
Well, time to slip in a short break, but we'll go full tilt on all the stocks on the other side of the break. For the time being, I'll run you through the top 10 segment. Endurance, LG Electronics, Max Financial, Honasa, Brainbees, they'll all be reacting to positive news flow. On the flip side, you have Tata Motors PV, Amber as well as Piramal that will be reacting to negative news flow. And you could expect a mixed reaction coming in on Sammaan Capital as well as on JSW Cement as well. Well, we'll also remember the big bull, Rakesh Jhunjhunwala, one of the boldest, the strongest bulls India has ever seen on his death anniversary. His conviction, optimism, and passion for Indian equities were unmatched. There'll always be a void in the Indian markets in his absence.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Hi, guys, and Upasana. Good morning. Sudarshan, let's go first with Tata Motors Passenger Vehicles and Endurance Tech.
Good morning. So Tata Motors Passenger Vehicles JLR problem seems to be never ending. So we should say JLR or Janleva Rasta, because in Q1 also it was a drag on the consolidated segment, on the standalone segment. For JLR, if you see on every front, it has seen a decline. And if you talk about the recovery, it sees recovery only in H2 of FY27, not even in Q2 of FY27. So on the consolidated business, because of the outperformance by India passenger vehicle business, company has seen revenue growth of 9%. Margin, though, has declined to 6.5% from 8.8% in the same quarter last year. Talking about JLR, revenue was down 10% and EBITDA margin has fallen to 8.1% versus 9.3%. Talking about the outlook, JLR has maintained FY27 outlook despite Q1 underperformance, and it's setting a goal of 10% revenue growth per annum. Talking about India passenger vehicle business, it's targeting double-digit growth for FY27 and believes that Q2 margin expected to be flat versus Q1 despite the inflation impact of 3% that company is expecting in Q2, and that can be offset by the price increase and the other measures. Endurance Technology, it was a healthy set of earnings led by India business, and total order wins, including the Maxwell order wins, were at 405 crore. Even in the Europe, it has seen order wins of almost 14 million euros, and revenue growth was up 30%. EBITDA has seen an increase of 19%. Margin, though, has contracted by 100 basis points, but remains healthy above 13%. So overall, good for Endurance Technologies and weak for Tata Motors Passenger Vehicle.
Got it. All right, Sudarshan, thanks for that. Well, going across to Upasana. Upasana, you're tracking two stocks, LG Electronics as well as Amber. Tell us more.
Well, first up, let me start with LG Electronics. Overall, it's been a good quarter for the company, slightly better than the estimates. Now, it's been the strongest quarterly growth reported by the company since its listing. Now, revenue growth stood at 15% versus estimates of 13%. This was mainly led by company's premium portfolio that led to such a high growth. Now, EBITDA margin saw an uptick of 110 basis points at 12.5% versus the estimates of 12%. And PAT also saw a strong uptick of 27%, which was mainly aided by the jump in the other income. Now, company is confident that it will certainly surpass the FY27 targets, that is the mid-teen revenue growth and early double-digit EBITDA margin growth. Now, talking about the key segments that performed well, home entertainment was the key performance here, where the overall growth came in from. It reported a strong performance with a revenue growth of 22% versus the estimates of 18%, and margins also saw a sharp uptick of 330 bips at 19%, which was mainly led by IPL and FIFA, which led to such a high premium large TV screen demand. Now, home appliances and air solution, the revenue growth largely in line at 14%. Moving on to Amber Enterprises, it's a miss on the revenue and margin largely in line with our poll. Now, revenue growth stood at 20% versus the estimates of 27%. Consumer durable, the key segment of the company, performance came in lower than what we were estimating at just about 7%, and margin saw an uptick of just about 60 basis points at 7.6%. Electronic division, which continues its strong growth run rate, here also the performance was lower than the estimates at 29%, and margin saw an uptick of 180 basis points. Now, overall, if I see, there is an exceptional item worth 123 crore and adjusted PAT stands at 126. So overall, the con call is also scheduled at 9:30 a.m. So we'll be watching out for key updates on that as well. So going with the red for now, but stock might turn into green depending on the con call commentary.
All right. Well, thanks very much for that. Upasana, Max Financial reported numbers post-market hours, and on the value of new business and the margin on the value of new business, I think there is a decent beat here. Yash, take it away.
That's correct, Prashant. So it's a strong top-line growth which has been in line and not with just a dash, but a heavy splash of a big beat coming on the value that it's been able to derive from the top line as well as the margin performance. As I said, strong top line growth but in line. So APE growing by 15%, retail APE growing by 17%, absolutely in line with CNBC TV 18 poll. Now, where does the beat come from? Value of new business growth, it has grown by 33%. The estimate, the CNBC TV 18 poll was 398 crore rupees. The number which the company has delivered is 446 crore rupees. rupees. So about a good 50 crore beat on that particular base. As far as margin itself is concerned, the CNBC TV18 poll was about 20.5%. What the company's delivered is 23.2%. So a 310 basis points beat as well as the margin is concerned. The stock hasn't done much. It's down about 5%, 7% in the last 1 month. I expect the stock to be in green on the value and the margin performance.
Got it. All right. Thanks a lot for that, Yash. Well, let's go across to Ananya. She's tracking Sammaan Capital. Hey, Ananya, morning.
Good morning. So yes, Sammaan Capital, they delivered a stable Q1. If you can see, the turnaround in business is clearly visible, but earnings quality needs monitoring here. Now, AUM grew 6% sequentially to 56,240 crore, while disbursement stood at about 3,875 crore. Now, asset quality, if you look, remains strong with GNPA at 0.22% and NPA at 0.17%. So very strong asset quality, though in previous quarter the asset quality was negative. Now the biggest positive is on the liability side. Now the cost of fund has fallen to 10% and management expects it to decline further to around 9.3% by FY27 end year, which should support margins going forward. Now PAT came in at 243 crore, down 27% year on year, while calculated PPOP was around 86 crore. So recoveries and write-backs remain an important earnings contributor here. Now management is targeting 30,000 crore of FY27 disbursements with a sharp acceleration expected from Q2 onwards here. So overall management remains confident about the outlook with CEO Mr. Gagan indicating that Q1 marked journey for the company here.
Okay, all right. Thank you very much, Ananya, for that. So that's Sammaan Capital in focus. Honasa is the other one, and First Cry, both reported numbers. Mangalam has got details. Mangalam, take it away.
Well, a solid show coming in for Honasa, and the stock has moved to show for that as well. Up 80% in the last few months itself, and at near record high. 27% growth in the company's revenue. We were apprised of that already because of their first quarter update. Margins jumped from 7.5% all the way up to mid-teens. So it's a doubling of the EBITDA. And we had the net profit, which did extremely well as well. We have a 30% volume growth that has come in. E-commerce grew 20%. Margins improved because of the mix improvement towards general trade and modern trade. The important part, while Mamaearth, which is the mainstay of the company, maintained its high teens growth, the younger brands grew over 40%. And the Dermaco has clocked a 1,000 crore annual run rate along with mid-teens EBITDA margin. So that's a positive. Brainbees as well, the stock is down from 700 all the way to 200 rupees, and it's the strongest revenue growth that the company has reported in the last 5 quarters. The EBITDA has jumped 80%, and the net loss has narrowed from 67 crores to about 44 crores. The India revenue is at a 7-quarter high. The question is, can the good times return for Brainbees? Because GMV of offline also continues to grow in mid-teens. So after a lot of underperformance, there is some growth sputtering back on Brainbees.
Thanks a lot for that, Mangalam. Well, I'm looking at JSW Cement. The revenue growth is actually very good at around 21%. That's because the sales volume growth was up by close to around 15%, coming at around 3.8 million tons. That compares with around 3.3 million tons. This as their North India operation capacity utilization ramps up. And in the month of June, it was much better than the average for the quarter itself. So that's telling you things are improving after their foray into North India. Realization as well was up close to 6% on a quarter-to-quarter basis. So that's good. The problem was margins. Margins have come down to around 15.8%. That compares with more than 20%. And the EBITDA per ton as well has come down. Remember, the results are a little bit softer because higher than expected operating costs. They entered a new market. Marketing costs will be higher on them. And that explains why margins and EBITDA per ton has come down. So it's a bit of a mixed reaction that we could get on the stock because, you have good volume growth. Their foray into North India is picking up steam, while in fact margins are under some pressure. So that's why going with a tinge of yellow on that particular one. But going to Vivek, who's here to tell us about Piramal Finance. Vivek?
Piramal Pharma is the one small correction over there. We are expecting a block deal to transpire in this particular stock. We are expecting close to 6% of the total equity to go ahead and change hands in this particular block deal. The total size of the block is expected to be around 1,750 crore rupees. If you consider 6% at the current market price, we also understand that there may be a minor discount that may be offered to market participants who are willing to go ahead and enter this particular block. And the likely seller is most probably the private equity investor, Carlyle, which has been a long-term investor as far as Piramal Pharma is concerned, going with the red, but depends to be seen whether this particular deal transpires in the block window.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Endurance Tech, LG Electronics, Max Financial, Honasa Consumer, and Brainbase Solutions. Stocks with negative news flow are Tata Motors Passenger Vehicle, Amber Enterprises, Piramal Pharma. Mixed view on Sanman Capital and JSW Cement. Well, that's equities for you, individual stocks. Let's get a complete roundup of all the action from the world of commodities. Manisha joins in. Manisha?
Well, thank you so much for that. I'll start with the gold prices, which are off its 10-week highs. That exactly is the scene, actually, that you're looking at in precious and the base metal prices today. Some bit of a profit-taking on the last day of this week. But having said that, it's still headed for a second weekly gain when it comes to the gold prices. Ditto for silver, and the crude oil prices are up 4% this week, even as they have declined 2% in the overnight markets there. The profit-taking just about continues in case of base metal prices. Also, copper prices, which hit all-time highs in the previous week, are now trading at a one-week lows right now. Same goes for aluminum as well. That has retreated from its recent 7-week highs. The supply concerns that the aluminum was reacting to now seem to be easing, especially from Emirates Global Aluminum, which currently is trading at 18% of its smelting capacity, is expected to return to full capacity by first quarter of 2027. But the major gains really seem to be coming in for the agri or the soft commodities. You have the global raw sugar prices now trading at a one-year high. You have Arabica coffee prices trading at a 6-month high. So it really is about the soft commodities, while other non-agro space actually goes in for some profit taking.
All right, thank you very much for that. Get into a break. On the other side, we'll invite the first management on the show, and we've got so many of them lined up today. Galaxy Surfactants will join in to talk about the Q1 numbers and the road ahead. Welcome back. Galaxy Surfactants is the first management on the show. It was a good quarter. Q1, K. Natarajan, Managing Director of the company, is now joining in. So strong numbers this time, 38% revenue growth. The bottom line has doubled. And even in terms of the EBITDA, this is one of the strongest performance that we've seen. Your EBITDA per metric ton is in excess of 35,000. What led to it, and what is the EBITDA target now for the full year?
Thank you. First, and a very good morning. Thank you for having me on the show. Essentially, this quarter's performance is a demonstration of how well we have been planning for growth in a significantly superior way when we rolled out our Vision 2030 last year. And I think last year there were a lot of external challenges, but we continued to stay focused on how do we execute well on all the plans that we have made. And I think everything started falling in place in this quarter, and we also had some good support externally that enabled us to leverage on it further.
Okay. Any one-offs to your EBITDA per metric ton of 35,000 plus? And earlier you had shared a guidance of 19,000 to 21,000 metric ton of an EBITDA level for the year. Does that hold, or are you revising it up after the Q1 performance?
Yeah, so I would not call them one-offs because there have been some opportunities that we had in the first quarter that we were able to intelligently capitalize on. But there are some of those opportunities may or may not present as we move forward. But what we are confident of is structurally, okay, everything is in place, and we're going to be ending this year in a very superior way. With regard to guidance, I would look at a 6 to 8% volume growth guidance for the full year, and the EBITDA per metric ton, we're increasing the guidance for this year to 24,000 to 25,000 per metric ton for the full year.
Okay, so volume growth guidance is 6 to 8%, and the EBITDA guidance has been increased from 19 to 21,000 to 24 to 25,000 for the full year. Okay, so now with respect to the volume growth of 6 to 8%, the problem is your Africa, Middle East, Turkey, Egypt business is under pressure. I believe even in this current quarter, you spoke about low double-digit decline. And in the past, you've spoken about logistics disruptions, raw material availability, constraints, repricing pressure, cautious procurement, etc. What happened on the AMET front, that's Africa, Middle East, Egypt, Turkey? Has it bottomed out? And what is the volume growth guidance across the various geographies?
Yeah, so the first thing is my Africa, Middle East stream somehow have been tested quarter on quarter almost every year since 2025. Credit to them that they've been able to find a way to be able to keep their head above water and prepare themselves for opportunities that present. So if you look at my Africa, Middle East, Turkey, volumes were down year on year by -4%. But what is very heartening is that quarter on quarter it grew by 18%. And we could have grown significantly even year on year, but for the logistics disruption into incoming feedstocks due to the West Asia crisis. Things started improving only from the last week of May, and I do see things getting significantly better in quarter two. We do look at growing year on year as well there.
Okay, so the AMET business has bottomed out for you, right? Safe to say, and Q2 should see a volume growth on a year-on-year basis and even on a quarter-on-quarter basis.
Yes, you're right.
All right, so that's turned the corner. Good to know. What about the India business? Because the India business has been a driver of growth for you. And in the current quarter, you've spoken about a low double-digit growth seen in the India business. Can you break it up in terms of performance and specialty, and what should we expect for the full year?
So India growth, we have got back the strength that we had earlier in 2 years back. We did have certain challenges significantly last year because of certain reformulation dynamics. So India came back very strongly this quarter. Year on year, we're grown by 11%. Quarter on quarter again by 18%. And we do see the demand momentum continuing to give us that particular advantage as we move into the festive season. We do expect the demand to hold up based on the commentary that our customers have been giving on their India performance. And importantly, I think what made a difference in this quarter significantly was last year our Tier 1 volumes in India were impacted because of reformulations. I think those came back in this quarter in our favor, and the Tier 2, Tier 3 business as well as the direct-to-consumer brand business also retained its momentum. So everything fell in place.
What about US and the rest of the business? Europe, Europe and Latin America?
So the rest of the world has delivered a significantly superior performance, majorly driven by the Americas business, majorly North America. And the mix was significantly superior due to two accounts. Our specialty business in the US coming back after the tariffs were rationalized to 10% since February this year. That had a good contribution. And our Tri-K premium specialties business continues to perform significantly well. Both these contributed to the rest of the world performance, registering a good growth, as well as the mix became pretty favorable even within the specialty portfolio.
Mr. Natarajan, thank you very much for joining in. Short conversation today, but we've got a lot of earnings to parse through. So thank you very much for joining in.
Thank you. Have a good day.
Good day. Well, that's, the management of Galaxy Surfactants in a way sounding positive because they've raised the EBITDA guidance for the full year after a strong showing in Q1. India is driving growth for the company, but even the Africa Middle East business, which has been under pressure, seems to have bottomed out and turned the corner. Siddharth Khemka of Motilal Oswal Financial Services is now joining us on the show. Siddharth, morning. Give us one stock from the earnings that came out in the last 12, 18 hours, which one should watch and why.
Definitely. I think, good morning, Rima. The last leg of results, and I think this quarter has not disappointed us at all. A lot of good results, interesting ones as well. So if you look at one stock which is looking quite interesting is LG Electronics. After coming out with a strong IPO and then weak numbers followed that, I think finally the company has started delivering results. So 15% revenue growth, 26% EBITDA growth. What is important and heartening is that margins have started improving, supported by volumes, premiumization, operating leverage. And we believe that in the consumer durable space, being a market leader plus the diversified product bouquet, I think the premiumization would continue to support LG Electronics in its overall journey towards higher profitability. What also helps is that valuations, because of the past underperformance, is pretty good and giving us a good entry opportunity into a global MNC name which is doing so well in India. So I think overall we remain confident that there could be a mid-teen growth in terms of revenue, double-digit EBITDA growth supported by margin expansion. This would be because of healthy demand, the right product mix, as well as improvement in exports. So I think overall from the yesterday's results, LG Electronics pretty good stands out. So we have a buy rating with a target price of 1800.
Right. I said good morning. I thought you'll be in your kurta. Maybe tomorrow. Sid, what about a couple of other earnings reactions? Stocks that have seen big moves. You had Honasa. That stock, in fact, could be in focus today. It's already rallied, I think, more than 50% in the last few months. And Brainbees. Do you track either of them? Do you have a view?
So Brainbees, unfortunately, don't track. Even I think Honasa, unfortunately, not under coverage, but pretty strong numbers. I think finally the new age companies across segments or sectors, they have started delivering on the profitability part. So net profit growing almost 120% to 90 crores. Margin seeing a sharp improvement. I think volume growth, that was a pretty strong out of the park kind of a hit with 30% kind of volume growth. So overall, I think pretty good set of numbers from Honasa. Market should definitely look at it from a positive view.
Got it. All right. Got that one as well out of the way. Well, let's focus on the alumina basket then. Nox Hydro, their Alunorte facility, they went ahead and they said that no gas availability, so we're going to be pulling down production. They had a capacity of 6 million tons. If they pulled down production by 50%, it would come down to around 3 million tons. The street got excited. Said alumina prices now are set to recover, which could very well be the case, but not because there'll be a shortage. There could possibly be a bit of an issue for them. Now what they're saying is they managed to secure the gas. They have spoken to the regulators, etc., and they're ramping up production again. So that puts that theory out of the way, which becomes a bit of a issue. But I think the street was sensing it, that this cut was not going to be long lasting. Yesterday as well, Nalco ended at the low point of the day. What's your view on the theme?
So yeah, I think I read your comments on this as well. So definitely this was a short-term phenomena on which market reacted to positively. So you know that commodities, because of some global developments, they do react very sharply to either ways. And now, as you rightly highlighted, Alunorte has kind of got a temporary gas supply, which would help it improve its production, and the loss would not be as bad as thought earlier. Nonetheless, what we see definitely is that bearing the near-term volatility, the long-term view, as we have already always discussed with you, that we remain positive on the base industrial metal cycle over the next few years, led by strong industrial demand. The power sector plus the AI data centers would also lead to a strong demand multi-year upcycle for the metals. Within that, as I said, base industrial metals, copper, zinc, aluminium, these are preferred bets within that space, and something like an Hindalco, Nalco, these are our preferred picks within that. So again, bearing the short-term volatility, I think from a long-term perspective, we remain positive on the entire metal cycle.
Okay, all right, got that. One quick view on Piramal Pharma. Could be a large trade today. Stock could pull back a little bit. Shown plenty of promise numerous times. Delivery has been a little short, but what's your view?
So yeah, I think within the pharma space, there is still Piramal is trying to get up on its feet, and we have expected margins to recover. That has marginally happened. I think going forward, things would again look positively. But within the pharma space, I think the CDMO players have been kind of reporting much better numbers and consistently delivering. Companies like Divi's, Laurus, now Gland also reported good numbers. I think we will continue to focus on that. This market, if you look at clearly, is rewarding companies which have delivered strong numbers, plus outlook is positive. Piramal, I think things are looking up. Next 2 quarters would be crucial in terms of growth as well as in terms of margins, and that would be a key monitorable going forward.
Got it. Okay. All right. Stay with us, Sid. For the time being, we take a short break. Come back. We continue our chat with Sid. We'll also be joined by technical experts. Sudeep and Mitesh are waiting for us.
Okay, welcome back. There's 11 minutes to go as far as pre-open session is concerned. Let's spend 2 minutes talking about the Tata story. Sources tell CNBC TV 18 that Tata Trusts is exploring legal options to ensure the succession process can proceed. Rachna is here with more. Rachna, take it away.
Tata Trusts are now exploring their legal options, and that could mean going to the Bombay High Court. That is what our sources are telling us this morning. Now, yesterday, the trustees of the Sir Dorabji Tata Trust met and adopted the resolution on N. Chandra not seeking reappointment. The trust also had to appoint a joint nominee for the upcoming AGM. And that could not happen because Sir Ratan Tata Trust, the trust with which it has to appoint the nominee jointly, cannot participate in meetings owing to the Charity Commissioner's freeze. And since there is no update on that front, the restraint order of the 15th of May continues to apply, which is why the next option is the High Court, the appellate authority on Charity Commissioner's orders. Now, we've gone through Tata Sons articles of association, and they tell you exactly how tight this is, because until yesterday, this was about one nominee being jointly appointed. From today, it's about 4. Article 86 is the first one. Quorum at a general meeting needs at least 5 members personally present, and that must include one authorized representative jointly nominated by Sir Ratan Tata Trust and Sir Dorabji Tata Trust. But now look at Article 118, which governs succession at Tata Sons. The moment a chairman has to be chosen, a 5-member selection committee has to be constituted, and 3 of those 5 are nominated jointly by the same 2 trusts. The chair of that nominee also, the committee also comes from those 3. So one joint nomination for the AGM, 3 more for the selection committee. Sir Ratan Tata Trust cannot take a board decision right now. So in all likeliness, the AGM is also expected to be adjourned if no legal relief comes for the Tata Trust.
All right. Well, thanks very much, Rachna, for that. So that is the that's the story as far as Tatas are concerned. Siddharth Khemka is still with us. Sid, I don't know if you've spoken about Max Financial. I don't know if you've seen the numbers. Yash detailed it out for us earlier. Numbers look pretty strong. I mean, especially when you compare it to some of the other life insurance companies which reported earlier. Very strong expansion in margins.
So yeah, Prashant, we definitely did had a look at Max Financial results. As you said, pretty strong numbers. VNB growth of 33%, 14% higher than our estimates. VNB margins expanded 300 basis points. This was supported by strong protection annuity and non-linked product traction. So I think distribution remains a key growth driver for Max, with Axis branches and now non-Axis branches also offering significant scope for growth as well as penetration into tier 2 and beyond. Overall, I think the growth in non-Axis bank assurance is improving. Axis bank channel is showing momentum and is likely to sustain business growth. So overall, we have raised our estimates. VNB margins have been increased. Estimates have been increased by 50 to 100 basis points. And overall, we expect APE growth to sustain about that 15-16 marks. And we believe that with a good business mix and continued VNB margins, Max Financial looks pretty strong now. We have a buy rating with a target price of 1860. So pretty positive there on Max Financial.
You know, the other one is Honasa. I don't know if you've looked at this. Okay, I think we discussed Honasa. Sorry, I just stepped out. But Honasa we have. There's lots of stuff, right? Honasa, there's LG Electronics, which we discussed. And numbers, of course, have been pretty strong on Honasa. LG, of course, will speak with the management in terms of guidance, which I think is more relevant as we head into this festive season over the next 2 quarters or so, apart from, of course, what they've reported in the first quarter. So, there is a fair bit. One other name, right, which has done phenomenally well this week and absolutely under the radar is Turtle Mint. So they're an insurance distributor. Numbers came, I think, 2 days back. Numbers were strong. Stock was languishing way below the IPO price. I think 150 or so was the price, and it had fallen to about 110, back at about 140. So very different business model as compared to Policy Bazaar, but it's in the distribution space. Any thoughts here? Sid, if you've looked at this?
Prashant, unfortunately, we've not looked at it, so we'll not be able to comment.
Fair enough. No problem. By the way, have you sort of formed a view 2 weeks of this closed auction session, which is now wrapped up? We have a sense of how volumes are trending, and volumes have been hit, especially in the last 15 minutes or so of trade. And, the last 30 minutes is pretty large. has always been pretty large as far as overall volumes are concerned, especially on expiry days. Any view on names like BSE?
So yeah, I think, Prashant, this is a new phenomena, and as you rightly said, generally we see huge volumes on the first 30 minutes of the opening session and the last 30 minutes of the closing session. So those are crucial in terms of volumes. But now with this closing auction session, things have definitely changed, and especially the bulk of volumes from the option writers, especially on the expiry days, because the closing has been changed from the normal closing to now the closing being discovered on the cash segment, where again volumes are gradually picking up. Market is kind of realizing. I think this will be a short-term phenomena, at least till the time the market participants understand the dynamics, participation increases, and there is a fair discovery, which we saw initially in the first few days, how because of low liquidity, low volume, low participation, there were sharp spikes in the closing session. So I think the exchanges are doing enough of these sessions, trying to meet the brokers and make them understand. Plus, market participants will start happening. So I think this is an interim impact because of lack of participation and understanding. Slowly and gradually, things should normalize.
All right, so that we'll leave the conversation here. Thank you very much for joining in. We will get into a break. On the other side, pre-opening rates, we'll connect with Rajesh Ravi of HDFC Securities and talk about the cement sector. Stay tuned.
Okay, welcome back. There's a minute to go for the pre-open session to kick off. Sudeep Shah of SBI is with us. SBI Securities is with us with some technical trading ideas. Sudeep, good morning. Good to have you with us here. I seem to be matching the colors this morning. Go on, Sudeep. How are we set up on the Nifty? the indices first, and then we'll talk about stocks.
Good morning, Prashant. Good morning, Nigel and Rima. Prashant, what I feel is that Nifty in the last few days has been consolidating. Markets briefly on the 4th of August touched the 200-day moving average, but since then they have been slightly on the downside, and that coincides with that volatility which started with the cash thing. But now going forward, I feel a lot of things are settling on that front also. The global news which were there regarding Iran and US, now also they are also subsiding. So overall now we are at a very crucial support zone, which is 24,300, 24,200, and the base is shifting higher since last month. So now I feel that dips closer to 24,250, 24,300 should be used as a buying opportunity. On the downside, 24,100 remains a positional support, a stop loss for long positions. And I feel till this zone is guarded, a rebound move up to 24,500 and 24,650 will be on the cards.
Got that. So buy the Nifty closer to 24,250, 24,300 for upside to 24,600. What about stocks, Sudeep?
Stocks, there are a couple of them which I like. The first one is 361 WAM. Here we have seen a strong momentum in the last couple of days, but on a longer degree charts, on the weekly and monthly charts, the stock is ripe for a breakout. So we feel that at this level, which is around 1180, 1183, and any dip closer to 1160, we can average. And the stop loss on the downside would be 1130. The targets on the upside would be 1240 and 1270. The second one is a large cap name, which is Larsen & Toubro, L&T. Here also post a strong consolidation. We are seeing some kind of a rebound move, a strong move in the last couple of days. So this can be bought with a stop loss at 4,020 on the downside. And the first target on the upside would be 4140, followed by 41.8.
Mitesh is also joining in. Mitesh, happy Friday to you and pre-Independence Day celebrations. What are you going with this morning in terms of a Nifty call and in terms of stocks?
Yeah, happy Friday. I think, most welcome. But on the stock side, I have two buys and two sells. I think 360 wealth management was also mentioned by Sudeep. It's on my buy list as well. Keep a stop at 1159. Look for targets of 1230 here. BL, after completing a correction, is now showing signals of an uptrend. So that's a buy with a stop at 403.5 for targets of 425. A sell on ICICI Bank. Keep a stop at 1430.5, 1431, and look for a target of 1355. And GMR Airport is also on the sell side, a call with a negative bias. Keep a stop at 105.25 for targets of around 99.
Got it. Okay, thanks a lot for that, gentlemen. We'll come back to you all for a 9:10 call. Well, let's turn the spotlight then on the cement sector. We're now joined by Rajesh Ravi, the Senior VP Institutional Research at HDFC Securities. Hi, Rajesh. Good morning. Good to see you in. Lots of news flow coming in the cement space. We'll have to find out how material is it. Let's start off with what we heard recently with regard to the royalty fee that's going to be imposed by the Bidla Group on all their companies. Hindalco, Novelis, Grasim, in all probability, it'll be Ultratech as well. Sources tell me that, yes, that's a given, that they'll have to pay that 0.25% with the maximum cap at around 225 crores odd. You've done some rough math that it appears very, very small, but what could the hit be to Ultratech Cement?
Yeah, hi, good morning, Nigel. Yes, the probability of even Ultratech coming in to pay this royalty is for sure very high. But as I note, 225 crore on an annual basis from an Ultratech perspective works out anything between 10 to 12 rupees per ton, which is quite minuscule from a number perspective. Given 1,000 to 1,200 rupees EBITDA per ton, this is less than 1% of its EBITDA. So from that perspective, it's immaterial. However, it may be, from a different angle and understanding if this is right or wrong, that is a totally different subject. But from an operational number perspective, the impact is minimal.
Okay. All right. Got that. So that's out of the way with regard to the impact on Ultratech Cement. The other big news that we got was that the MMDR bill, that's got altered. You know, a lot of sell-side analysts are saying, thank God, because otherwise it's getting very tricky. They have to track even state elections. Every time the ruling BJP is to not come in power, you are fearing now what's the state government going to do? That said, what kind of impact could it have on a company like Ramco Cement? Because that's been searching for good news, right? A big value creator. And then this royalty issue came up. And on limestone, they're spending close to around 160 rupees per ton. Now, with this amendment, they get some kind of a breather out there. How big a positive is it?
Correctly. So when this royalty was implemented by the Tamil Nadu government last year, two companies who were badly hit were Ramco Cement, which on a console basis have been paying close to 80 to 100 rupees per ton additional on a total cost basis. So that was the cost impact which Ramco had for its clinker production in Tamil Nadu. Even Dalmia has close to a 40 rupees per ton impact on a total basis. So these two companies were worst hit, followed by India Cement's operations in if I look from an ultratech perspective, that was relatively low, but all these three companies were impacted. But more so, given the nature of the royalty which was implemented last year, there was speculation that all state governments, mines bearing states will look to implement similar sort of taxes, not only in cement, but even for other minerals. And even in cement, all these states like Chhattisgarh, Madhya Pradesh, Karnataka, Maharashtra, which have large limestone reserves and multiple cement companies operate. So there were a lot of speculation that going forward, this may become a norm. Now with this new bill which is passed in the parliament yesterday, and things are now, any such ruling may not come forward. That gives a lot of certainty to, and as you rightly said that, irrespective of which government is at the center, or at the state, that uncertainty goes away. So from that perspective, it is positive for the sector as a whole. And from near-term perspective, this will have positive bearing in terms of increasing the competitiveness for Ramco and Dalmia Cements. Ramco predominantly because they've been reeling under significant margin pressure. Margins have come down to below 700 or between 700 to 800 rupees. So this will obviously help them inch up their margins subsequently.
Got it. Some part of the uncertainty goes out of the way, so that is good. We'll have to see now how pricing trends move as well as raw material costs. We had JSW Cement that came out with their numbers yesterday. You tracked that one? Their foray into North India seems to be progressing pretty well. They're spending more, obviously, but the utilization levels moving to 60%, I think the street will like, right?
Correct. So in the first quarter of their operations, they have reported 55% utilization, which is good given that this is totally a new market for them. So from that perspective, it is commendable, and this will help the company to break even faster than most cement companies whenever a greenfield project is, and taking into account that this is a new geography for them. So generally, we build in that the EBITDA break-even would happen after 4 to 5 quarters. So let's see what the management guides for in terms of the profit contribution from their North operations. But obviously, this is something which is good for the JSW Cement operations.
Okay, so are you positive on JSW Cement? It's not in your coverage universe?
No, this is not under active coverage, but we do track this company, and that is why I'm saying given that overall for JSW, which is more of South, JSW Cement based more in South and East markets, the North operations, this was some speculation that they will have, it will not be easy for them to push volumes and gain market share. At least that initial fear is behind from a market perspective.
Lovely. Finally, give us your top buy and sell calls.
So in cement space, we are positive on Ultratech and JK Cement. These two companies we like, given the consistent nature of industry-leading volume growth, along with very healthy margins, and the balance sheet remain in very solid state despite their steady capex programs, which is always on time for last 3-4 years. They have been they've executed all their projects well on time. In addition to this, Ambuja, we are also positive on Ambuja. However, the company is able to, if the company is able to pull up, its capex, whatever which have been delayed, if they come on time over this calendar year, and the margins which have suffered during H2 of FY26, If that recovers over next 1 or 2 quarters, the valuations is quite cheap, and that stock can see an upside, a significant upside, I would say. And top sell, we currently have strong sell on Ramco Cements, given that the company is suffering from slower capex, and that was also the right move which the company did to slow down its expansion program, given the balance sheet was quite heavy. And unfortunately, South market remains quite volatile, and that is where the margin profile have been hit for Ramco Cements.
Got it. Have a good day, Rajesh. Thanks a lot for joining in and giving us your view on the cement sector and discussing all of that with regard to the royalty fees, the MMDR amendment bill, as well as his top picks. Well, let's move on then and tell you about the alumina market. Well, overnight, Nox Hydro's Alunorte facility, they are saying they're going to be ramping up alumina production. Earlier this week, they said they're going to be cutting production by close to around 50%. So this ramp up didn't take time. This will be a negative read-through for Nalco, in particular, then followed by Hindalco as well as Vedanta Aluminium. Hindalco because they make their own alumina. So in case alumina prices move up, they'll get the benefit. Vedanta, well, more or less neutral because they didn't run in the first place since they buy some part of their alumina from the open market. Now, remember, this ramp up of capacity follows the approval by Brazil's oil, natural gas as well as biofuels regulator, which is ANP. They're saying that they can become self-importer of gas. And gas was the issue that they were talking about, reducing the alumina production. Alunorte, they have reached a temporary agreement with its gas supplier, which is Selba, regarding the terminal access. So now gas comes on stream, so they can restart the facility, they can gradually ramp up. And a rough number that they put out is the total production that is launched. It's just 1 lakh to around 1,20,000 tons, which is very, very small, given that the globe is in a surplus of alumina of more than 1 million tons. So the refinery has now begun alumina production, which in turn makes things tricky for a company like Nalco, which sells alumina in the open market. And that's why the stock is down 5% after being down 4% in yesterday's trade. Hop across to Mitesh. Mitesh, tell us the 910 call.
Yeah. I'll go with the sell on ICICI Bank for targets of roughly around 1360, 1355.
ICICI Bank on Mitesh's radar. Let's go across now to Sudarshan, who joins in on Tata Motors Passenger Vehicle. So disappointing numbers, so expect a gap down?
That's correct. So in the pre-opening session, the stock is down almost 6% on the back of very weak set of numbers, mainly because of the JLR continues to be a major drag on the overall Tata Motors Passenger Vehicle. Talking about the consolidated numbers, company has seen revenue growth of 9%, mainly because of the outperformance by India Passenger Vehicle business. But due to higher raw material cost and the forex loss that company has seen in Q1 of FY27, margin has seen a contraction on consolidated business by almost 200 basis points. For JLR, revenue has seen a decline of 9%, and here too, margin has seen a drop of almost 100 basis points. Going forward, for India Passenger Vehicle business, in FY27, company is targeting double-digit growth, and also it believes that it would be led by new launches. For JLR, despite the Q1 underperformance, company has maintained FY27 guidance.
Okay, so we'll keep an eye out on this one. 6% lower, by the way, as things stand right now. So, two names I want to quickly highlight. Actually, we'll do that, but let's just focus on Honasa as well. Mangalam is standing by just to put the spotlight back again. I think last quarter was a blockbuster. Stock saw a big reaction post that, and I think something similar this time around as well. Mangalam.
The last 3 or 4 quarters for Honasa have been extremely good, and which is why the stock's actually bounced all the way up to 495, closer to 500. It's rallied about 80% since March itself. 27% revenue growth. The operational improvement is something that the street really likes. Margins at mid-teens, and we've seen the net profit jump all the way up from 40 crores to about 90 crores. The internals of the business are strong. 30% plus volume growth at the same time. Growth coming in from channels which are more margin accretive, which is the likes of general trade and modern trade. And Mamaearth, while that itself is doing well, growing in mid-teens, we've seen younger brands grow at 40%. So, the kind of growth of house of brand strategies playing out, with the Dermaco actually clocking 1,000 crore annual run rate at the end of this quarter, with entering margins in mid-teens as well. So all these factors playing out well for Honasa. That stock understandably sells about 3% higher in pre-open.
Okay, all right. Well, thanks very much for that, Mangalam. So Honasa doing very well. I think there's about a minute to go for the market open. Let's just look at Galaxy Surfactants. We had the management with us. I think the call is scheduled for the morning, the first half. But it's up 15%. I mean, it's one of those names which has not done very much over the last 5 years. And there's a guidance raise. Rima spoke with the management just a while back. and 15.5% higher on a Galaxy surfactant. So that's a big one. Look at Max Financial as well. Reported numbers yesterday. There's a value of new business is strong, growth is strong, margins on the VNB is also strong. It's a 3% pop coming through there. Mangalam, of course, spoke about Honasa. I mean, it's basically as we wrap up the earnings season, it's a flood of earnings. I think we got about, 6 well-covered names in the last hour yesterday and many more post-close. First rates are up on your screen. We can take the bell off, the timer off, that is. About 0.3% lower, 24,323. Nifty Bank is down about 0.16. The Sensex is down about 0.3, 0.4%. The small cap index is up. I mean, actually, every day of this week, even as large cap indices have sulked, the broader market indices have actually picked up a little bit. So in the green for what it's worth. I think because yesterday, during the cash session, the closing auction session, the gap was about 40 points on the Nifty and about 200 on the Sensex, basically 330 over 315. I think there would be, I guess, that being corrected this morning as well. So, we are back at about 24,300 in that sense on the Nifty. So that correction has to take place. I mean, we thought the gap perhaps as the spread is reducing, but yesterday, of course, it widened again. I think something similar perhaps for the Sensex as well. So when you look at these lower rates, I think you've got to maybe adjust a little bit for the sharp jump in the closing auction session that we saw, 40 and 200 in the Nifty and the Sensex respectively. The heat map up on your screen, Wipro, TechM are the top gainers. There's Bajaj Auto, but there's more down than up. On the other side, Tata Motors Passenger Vehicle is down sharply, as Sud was pointing out. Hindalco and Max Healthcare are the other names. Max Health jumped 30 bucks after the results yesterday. Let's see where that is at. I think about 9.95 was the low. So that is in focus as well. But broader markets, Rima.
Well, it's Tata Motors Passenger Vehicle that catches your attention, down 5%, facing headwinds on the demand front for JLR and on the cost side. Stock is getting punished. Nalco is retreating, down 4.5%. There is a downgrade coming through. Oil marketing companies like HPCL lower by nearly 5%. And then you've got softness in names like Solar Industries was a big mover, 8% up yesterday. Today seeing some profit booking. On the way up then, it's Galaxy Surfactants, very strong Q1 numbers. The bottom line is double. The management raising the EBITDA per metric ton guidance to 24 to 25,000. LG Electronics is surging. Page Industries seeing buying. Jubilant Food came out with numbers towards the end of trade. That's got a gain of 3%. Max Financial, Honasa. These are some stocks where you are seeing big moves, and then smaller names, but like an Omax, Manali Petro, Wellspan Living, Z Media, very, very large moves. EIL also reacting to numbers.
Well, that's right. Just keep an eye on a few more stocks. Apex Frozen, just pull up that stock. It's moving higher. It's a gap up of more than 10% on rather large volumes. So that one comes up for you. 14% higher actually on that name. So that's why we're looking at that one. I think it's reacting to its numbers, if I'm not mistaken. So good move out there on that stock. What else? Manorama Industries, that stock is up close to 7.5%. So big move is what we're seeing out there. And volumes as well are high. Mangalam had said that Indigo Paints, those numbers actually were stellar. And that stock continues to run along. JNK India, that's another stock that came out with its set of numbers. That one as well has gapped up, big one out there, 7% higher on that name as well. VATech, Wabag, that stock in fact up in today's trading session, and volumes as well rather large on that name. On the losing end, let's try to pull out a few losers. You have Fino Payments Bank, that's down close to 5.5%, so that's coming for selling. Supriya Life is down close to around 5%. Nalco, the big moves that we're seeing in alumina prices globally, restart from Nox Hydro's Alunorte facility, and that's why that stock as well is opened up with a cut of close to around 5%. Net, headline index is down. Plenty of stocks moving though from the broader markets.
No, yeah, absolutely. And there's enough and more to keep us busy. It's all about individual names, single stocks, and no real lethargy there. LG India, you will hear from the management in about 10-12 minutes, is up 4%. It's got large volumes on it, post numbers. The call, I think, is later in the evening, but you'll hear from the management first up here. Page, of course, I think we highlighted Hitachi is up 2%. KRN. So KRN has got a bit of a bid here. So I think every day this week it's been up 5%. Stocks at about 1,500 bucks. So I think was it about 1,200? Start of the week it's at 1,460, 1,470 now. KRN Energy. So looking super strong. there is, look at something like a Tilaknagar Industries, which has also been, moving higher all of this week. I think, and I think it's up another 2% or so, 2.5% or so this morning. Indigo Paints is up 6%. Galaxy is locked up, as I said in the morning, after the guidance raise from the management here about 30-40 minutes back. So it's limit up. I don't remember the last time Galaxy was limit up. Has had a tough phase. Actually, specialty side of the business has done well, but the biggest chunk has been the largely commoditized segment, which has not done well. It's also, by the way, a market which is very generous with betting on at least allowing to nurture the idea that maybe things can turn. And we've seen that with so many stocks where benevolent kind of period, especially for mid and small caps in that sense. Okay, we'll talk more markets, but we have the top team from the Motilal Oswal institution with us. 22nd Motilal Oswal Annual Global Investor Conference will kick off from the 17th of August. That is this coming Monday. And as always, for the curtain raiser, we're now joined by the two gentlemen who run it. We have Rajat Rajgaria, whole-time director and CEO Institutional Equities, Motilal Oswal Financial Services. We have Gautam Dugat, managing director and head of sales, Institutional Equities at the firm. Gentlemen, great to have both of you here. Thank you very much.
Prashant,
I was just wondering, it's like jackets versus bundis today, and Rima looking fabulous in a sari. But I want to say Happy Independence Day.
Thank you. Same to you and to all your viewers also.
So lovely to have both of you back here. It's also going to coincide with the wrap out of the earnings season.
Yep.
And what's happened over the last, I think, 1.5 odd years is that there's been some accident or the other, then the accident goes away. It was tariffs. Then the tariffs were not a problem. There's the oil price, and then briefly oil prices were not a problem. Markets reacted every time. But then as soon as there is a glimpse that things are resolving, markets snap right back. Rajat, I want to just start with that. Where are we at in this sort of game of... the point is that the index has not gone anywhere, although we've had these big swings on both sides. So why don't we start there, and then we'll get to the conference itself. Go on.
Yeah. No, I think that's fair. If you look at our markets, 2-3 years, index is quite range bound. The range is 3,000 points, but range bound. And two reasons I can think about it. First, the overall earnings has been little patchy. Only in the last 1 quarter, 2 quarter, you have started seeing things little better. And I think secondly, the narrative of global flows has always been more towards some dominant theme in the rest of the world, not towards India. And our markets, you can spend a lot of time on top down, but this market has become very bottom up. For the same index, if you can keep plotting charts or stocks, you will see many of the stocks just moving higher and higher and higher. So we are a very growth-oriented market. Wherever there is a growth, there is a demand. So that's point number one. Point number two, the two trends which I think are very visibly common. First, the retail money, the domestic money will keep coming in, not letting the market go down. And the primary market will keep supplying paper, not letting the market go up.
Correct.
So these two trends are also very common, right? And I think third thing is, we have started seeing now trends of earnings getting better. And I think this quarter, Gautam can speak more details, but this quarter has been where earnings have started becoming more broad-based, right? We don't differentiate too much like large cap, mid cap, small cap. We think growth is growth, whichever bucket they fall into, right? But we have started seeing breadth of the earnings being very good. So that's a good sign. This could just be a trend where after 2-3 years of consolidation, you may start seeing India again taking
You've given me the perfect segue, Rajat, so let me take it to Gautam. Do you think we're at the phase where earnings acceleration can happen, or this quarter is more of a one-off, or you think, we're set for, as Rajat put it, broadening of the earnings, and it's showing up in many places, but also continued acceleration?
So, Prashant, look at it this way. Last 1 year, we've had a lot of improvements in macro. Multiple steps that the government and RBI has taken in the last 9-12 months. You had interest rate cuts, GST cuts, right? And of course, government cut the income tax rate last budget. The cumulative impact of all of that is now getting manifest. You look at auto numbers data, credit growth, power, whichever segment you look at, GST collections. Despite the rate cuts, the GST collections were at a new high. And that is now transmitting into micro numbers. This quarter, everyone was expecting a quarter because of what happened in Iran and the geopolitical factors. Despite that, this has turned out to be the best quarters in last 3 years. In terms of quality, in terms of quantity of earnings, in terms of the breadth, whichever way you look at it. I have not seen a 20% plus earnings growth for last 12 quarters now. More importantly, the top line growth is at a 3-year high now. So inflation has made a comeback, which is now representing in top line across sectors. So for our coverage as of yesterday, 350 companies have reported numbers ex-OMCs. The growth is 23% in earnings against expectation of 15.
350 companies, 20% earnings.
23%.
23% top line growth.
So this is earnings I'm saying. Top line is also 18-19%. Right? For Nifty, it is 18%. We were expecting 10%. Look at the other factor. We are seeing earnings upgrades now after 12-13 quarters. We have seen a 2% earnings upgrade for our broader coverage and about 1.5% for Nifty, right? Like Rajat mentioned, it's a bottom-up market, right? After 3 years, we are seeing a turnaround in small cap earnings. We were expecting a 30% growth for full year, and the first quarter has given us that confidence that the full year can be met. The first quarter small cap earnings, and we cover a very vast numbers. You know, we have 180 small cap companies under our coverage. They have delivered 32% earnings growth.
Wow.
Mid cap 25%, which is why market is also representing that. You know, from the bottom, if you look at the March bottom, Nifty is up 9%, but mid cap 150 index is up 21% and small cap is up 25%. And I think this trends will strengthen as we move forward.
But Gautam, for the full year, can we extrapolate these numbers for FY27 and FY28? 18-20% large cap growth, 25% mid cap growth, 30% small cap growth. Because in the current quarter, there was also that benefit of repricing of low priced inventory. So are these numbers sustainable for not just this year, but even say FY28?
So Rima, there is an interplay of that. Some sectors benefited because of inventory gains and some sectors lost out because the inventory input cost went up. But when I look at the 31 sectors that we cover, 20 have beaten our expectations. 9 have met expectations. Only 2 have disappointed. I have not seen such a strong breadth in last 3-4 years. Now moving forward, when we started the year, we were projecting 14% growth for large cap, 21% for mid cap, and 30% for small caps. And like I just said, we have seen an earnings upgrade. So that basically means our expectations, which were there a month and a half back, have actually got more reinforced. So we are expecting to end the year on small cap with 30%, mid cap with 22% now, and large cap with 15%. Nifty will see 15% growth after 3 years. I mean, look at FY24, we did 1,000 rupees of EPS. FY26, we ended at 1,065. So in 2 years, we got 6% earnings growth cumulatively. And market has been absolutely fair. In 2 years, the Nifty market cap went up 5% from 181 lakh crores to 192 lakh crores. So market has respected only one thing in the last 3-4 years, which is earnings. Whether you look at last 3, 5, 10, whichever construct you create, we've looked at 5 different indices and their moments on last 3, 5, 7 and 10 year basis on EPS and index moment. It is matching 100% to the earnings growth. So if we are expecting a 15% earnings growth in Nifty this year and 20-30% in mid and small cap, I would think market is looking very constructive. And more so after 2 years of a very strong time and price consolidation. The only missing link, as we all know, in the last 2.5 years has been the flows. The FII selling has been massive. We are all aware about the numbers. In fact, on a decadal basis, they've become neutral now. Last 10 years, cumulative flows of FII is zero now. They've bought $69 billion in primary market, and they've sold exactly $69 billion in secondary market. So as and when that changes, you will see another tailwind coming in for the markets.
All right. Hi, gentlemen. Good to have you all in the studio. Well, a valid point, right? With regard to the flows, the FIs, they have not come to the party. Hopefully, that trickle that's been seen, that, just goes up from here. The other problem is when mood gets better, earnings get better, the market sentiment changes, then you'll have more amount of supply of paper. Could be good for business. But otherwise, that base as well, right? Barely in the last few days, we've heard a lot of IPOs, a lot of OFS, a lot of promoter sales as well. How big a problem is that? It could be good for business, I'm saying yes. But a bit of an issue for market sentiment, right?
Look, I think both yes and no. Yes, because of course things get bunched up. So if you look at from January to May, the primary market was almost very low. You hardly had paper. And suddenly things get bunched up. Now you are seeing maybe weekly basis, 3-4 IPOs, 3-4 QIPs, half a dozen, and this pace will continue. But it does very good to the markets over a medium to long term because of two things. First, the quality of companies which are getting listed now are truly representing what this country is growing. Point number one. Point number two, the wealth impact is getting more widespread because now you have bigger participation. Please remember, from a 2-3 crore demat accounts, today you have 25 crore demat accounts. And with every one large IPO, you see more demat accounts being opened into the system. And lastly, I think for a lot of the money that offshore investors will put in, primary market will be an important source to attract that money. We have started seeing some of the recent IPOs, you see FIIs being anchor, QIPs, blocks, they participating. So I think bunching up is an issue. Primary market supply is not. You need, in India, if you still look at a $5 trillion market cap, the free float is still relatively low compared to the rest of the world. But phasing out is what ideally needs to happen. It may not happen.
And you know, I remember talking to Ramdevji earlier in the year, and he said that this year IPO, and that's the kind of market like last year was great for IPOs, and we were talking about, I mean, the capital market business, and he said, well, maybe this year is not going to be all that great, but look how it's turning out, right? It's back to being as busy as ever in terms of primary issuances, taking companies public, etc. Right, Rajat?
Yeah,
I mean,
I think
phenomenal.
Prashant, I always think this is very healthy for our and look at the kind of companies which are getting listed, from the largest asset manager to the largest exchange to the largest telecom company.
I mean, imagine a scenario where we were just talking about the same old 100 companies, right? Yeah, I mean, or so the breadth, actually it's also the size, so the variance is amazing. Very large companies, smaller companies, but also the kind of companies, right? I mean,
I also wanted to highlight one point. When you look at the credit growth today at 18%, it needs to supplement with an equity capital markets, because for all the capex that we are beginning to see to happen, you need equity contribution to come. So that's why you are now seeing QIPs coming up big time, and QIP is the primary capital into the company for funding the growth, right? So I think primary markets are very supportive and important for the overall economy to grow. As I just said, we ideally phasing out is important, but our markets may not do that. So we'll weather this phase.
You know, we have 4 or 5 managements waiting, so I'm going to rush you guys because I want to get just 2 more things. Gautam, earnings, right? You're a numbers guy, and you're looking at, and you said that, well, that's the only thing which matter, and markets have been very fair in judging stocks and what to do, what does well, not does well, based on numbers. Where are you most confident about? And in terms of earnings acceleration, based on what you've heard from management in calls, etc., where there will be steady increase in earnings.
So, Prashant, that has not changed for us in the last 1.5 years.
Just revise it for us.
Yeah, of course. So, and that's also part of what we are trying to represent at our 22nd annual conference in the CEO track. Right? India is a very diverse market. You know, you have 5 big cohorts if you look at it: financials, consumption, tech, industrials, and healthcare. And one common thread running across these 5 cohorts over the last 2-3 years has been the big bellwether stocks in each of these cohorts have done pretty much nothing. When I was looking at bottom-up numbers for Nifty 50, there are 27 companies in Nifty which are almost stopped growing, or maybe growing at 5-7%. So real growth, even in the top 100 companies, is happening beyond Nifty 50. So you have to dig there a little more. So where are we positive? If you look at financials, we are more positive on the non-bank side, both lending, non-lending capital market, which is a big overweight in our model portfolio. If you look at consumption, one good thing we did 2 years back was made FMCG zero. We converted all our 15% weight on consumption into discretionary, right? Industrials also, if you look at it, what is done well? It's not the benchmark stocks which are bellwethers in that segment. It's the power-oriented names, it's transmission, defense, likes of Dixon. They are the ones which are there in our model portfolio. Some of them are obviously representing in our CEO track starting Monday. If you look at tech, we've been consciously away from the traditional legacy large cap tech. We are more towards the new age technology. In fact, our coverage also has ramped up significantly out there, and we expect to have a far broader coverage in that domain. And lastly, Prashant, if you look at healthcare, If you look at healthcare, the traditional top 5 large pharma generic companies, which were there 10 years back, cumulatively over a 10-year period, they've compounded earnings at 7% and market cap at 8%. So if you have made money in healthcare in the last decade and maybe in the years to come, the money was made outside of the traditional generic names. So you have CDMOs, you have hospitals, you have diagnostics, all kind of names. And as a top-down thought, what we have done essentially recently in our own portfolios is we have moved almost 700 basis point of weight in our model portfolio from large cap towards mid and small cap. So largely consumer discretionary auto, non-bank financials and industrials. That's where we are more constructive.
We will talk more at the conference as well. It's a big one, as always, Rajat. I'm sorry, I wanted to talk about the conference, but we will pick up on some of these themes on Monday when we see you at the conference. Thank you both for coming and dropping by.
Have a good time.
Thank you. Well, I think we have the management of LG Electronics now waiting by. They reported a good set of numbers for the first quarter. Strongest growth since listing. Margins have expanded. Companies confident of delivering ahead of their F527 targets of mid-teen revenue growth and an early double-digit EBITDA margin. We are joined by Mr. Sanjay Chitkara, Co-Chief Sales and Marketing Officer at the company. We also have Atul Khanna, Chief Accounting Officer at LG Electronics. Gentlemen, great to have both of you here. Thank you very much for joining us. Sanjay, if I can start by asking you, just to, Q1 has been great. Revenue growth is now 15%. How has Q2 so far been panning out? Because now you're entering into the phase which is the best for any company like yours, which is, there is the pre-festive demand which will start to pick up. And of course, then you will get into the actual festive season. So just describe the environment right now. Q2 so far.
Well, first of all, the Q1 results, which was ever since we got listed, it was the strongest quarter. And that boosted a lot of confidence among us because you see the market conditions were very challenging. There was cost pressures. And despite of that, we took price increase also 10 to 14%. And despite of that, we grew by 15.5%, improved our profit by around 27%, which gave us a very strong confidence that it shows LG's brand strength, India's fundamental, and things are moving in a right direction. The best thing about our growth is that it was not a one season specific or a product specific growth. In fact, all the products registered double digit growth, which shows that it's a very diversified performance. And since LG has products for all season, for Q2, for Q3 and Q4, so these all products have shown double digit growth, and we are very confident that we will try to beat our guidance for Q2, Q3. There might be some fluctuation based in every quarter, but our annual guidance, which is mid-teen digit growth and early double-digit EBITDA, will definitely hit that.
Could you talk to us a little bit about so guidance is maintained, right? So is this, again, to go back to Q2, what you've seen so far, is it better than what you thought it would be? Or is it in line so far?
Yeah, so far it is in line with, or in fact, I can say it's better than what we performed in Q1. And if you remember last year, we had a troubled Q2, wherein on 15th August, GST was announced but rolled out in September. So there was some confusion among consumers and trade partners. Partner was carrying a lot of AC inventories. And this year, the things are better. GST completely rolled out. Products affordability has improved. And best thing is, this year, Diwali is in November month. And we have seen, last year it was in October month. And we have seen whenever Diwali is delayed, we get a much bigger window for our sellout. So we are very confident that we will outperform our guidance.
How much better, Sanjay, can you do compared to your guidance? Mid-teens revenue growth, can it push towards high teens? And even in terms of early double-digit margins, what were you penciling in and what can it stand at?
So see, this is a very long journey. We have just finished quarter one only. And being a sales leader, I will definitely try to push more. But it is too early to say. But things are very positive and we are very confident because all products have shown a double-digit growth.
Right.
And the products which generally sold in quarter two and quarter three in the winter times are the washing machines, televisions. There, our growth rate was much better than our average growth rate. So we are moving in a positive direction. Definitely, we will give a better outlook.
Got that. Atul, on margins, what led to the margin expansion in Q1? And if you could tell us about the commodity inflation and if there is another round of price hikes you think you need to take.
So you know that when the revenue increases, it always gives a leverage to operating leverage for getting some efficiencies in absorbing the fixed cost. But nevertheless, whatever the new tech-based product we have introduced during our quarter four of FY26 as well as quarter one of FY27, it has given a very proven result that consumers are looking for a premium product segments which are expanding their lifestyle, their ease of life, convenience to them. Vis-a-vis, it was adding our margin profile also. We are still focused on our localization weight of brand, increasing our weight, particularly of localization, which will reduce the pressure of forex depreciation, as well as I will say the commodity cost also.
Okay.
So yes, you are right. There are some challenges on commodity prices, pressures on profits, but we manage well with the good price hike which we took during April month for across all our product categories, and we are continuing this phase for quarter two and thereafter, and we'll maintain our guidance for early double digit EBITDA margin. Vis-a-vis, our endeavor is always to grow better than our past performance. So this is our endeavor to take that leap forward, and we are confident that we can deliver better results.
Okay. Hi, gentlemen. Good morning. Just to clarify that, now you're confident of surpassing the earlier guidance, right? You're not quantifying it, but you're confident of getting past the mid-teen revenue growth and the early teens margins, correct?
I said our endeavor is always to surpass our past performance.
But now you're feeling more confident about it.
Yeah, so we particularly maintaining our guidance, which we have given, Sanjay ji has given, but we will challenge ourselves, right, to deliver better results.
Okay, got it. What about exports? You had told us earlier that goes to double digits in this fiscal year. I think last year it was 6%. Possible that happens? What was it in the first quarter?
So quarter one has shown it. Yeah.
So export is moving in right direction, and in quarter one we registered around 30% growth. And when we did our IPO, we were exporting to 47 countries. Now we expanded number of countries. Now we are doing export to 65 countries. And once our new plant in Shri City that will be operational, we will further expand our export because we will have more capacities.
Correct.
And currently we are running roughly around 85 to 90% of our both the plants.
Right.
And we are getting a very demand also. So once third plant will be operational, we will definitely expand to newer categories and newer countries. The Essential series, which we launched in the October last year at the time of IPO, we have started exporting that also to 22 countries.
Okay.
So export is moving in the right direction as we planned.
Okay, very quickly, have you gained market share in either of your big verticals, refrigerator, TV, or washing machine, or have you maintained it? Gained, maintained, or lost some market share?
So there are some short-term fluctuations quarter-wise quarter. But if you see, we are a company which is 29, 30-year-old. And from last 13, 14 years, we are maintaining highest market share in the country. And some products we gained, some are stable, but we are maintaining our leadership across all the product categories. Our premium market shares are very high, like our side-by-side, it's 40%, OLED 59%. So the premium market shares are further strengthening. The gap with number two player is increasing.
Just one last question, sir, just to wrap it up, all up. Is there a possibility you revise your, I mean, basis what you're seeing in... sorry, I think there was some static. So my question, Sanjay, is there a possibility, basis what you're seeing in Q2, that you up your guidance for the full year?
I mean, it's a call which the board will take. And on my personal capacity, I cannot give a very selective declaration about the guidance. But we are very confident because the Q1 was very challenging. So many external conditions, cost impact, and we have grown. And we have taken a price increase almost 10 to 14%. And despite of that, we registered a 15.5% growth. Things are normalizing. Consumer sentiment is getting better. Festival preparation. We have launched many new products for these festivals. We are very sure that we will cross whatever we have planned.
Got that. We'll leave it there, Sanjay. Appreciate you joining us. Atul, great to have both you as well here on the program. We wish you all the best of luck and speak again mid-quarter or maybe at the end of this particular quarter, that is Q2. We'll take a break. We are back. Brigade Enterprises on the other side with their earnings. Stay tuned.
Welcome back. Well, Brigade Enterprises, that's the next stock in focus. The company reported actually a muted set of numbers in the first quarter. Residential bookings, there was some weakness. Volumes fell close to around 19% sequentially. Let's find out what's the way ahead. Joining us now is Pavitra Shankar, the MD of Brigade Enterprises. Hi, Pavitra. Good morning. Always good to have you on the show. Tell us, what's the revised guidance for this year? FY26, I think you fell a little bit short of the guidance. There are various moving parts. But help us out with what's the trajectory for this year in terms of residential sales?
Hi, good morning. Thanks for having me. Yes, while we did see a slight drop in FY26 residential numbers, a lot of that has been pushed into FY27, and therefore we think we'll be able to make up a lot of the lost ground from the previous year. We did have a muted Q1, but that's fairly typical from what we have seen in the past year or the pattern from the last few years. A lot of our launches tend to get pushed into the second half of the year, while Q2 is looking like it's going to be a good quarter in terms of launches. We do expect a lot of the sales and launches to start coming in from Q2 onwards. So that said, we still expect like a higher number in terms of sales. We're looking at a number of 9,000 crores in terms of pre-sales.
So your pre-sales guidance is maintained at 9,000 crore. This is what you told us even in April, and you're holding on to it. So that's pre-sales. What about the launch pipeline? I think you were trying to hit 12 million for the full year with a gross development value of close to 11,900 crore. Are these two numbers in terms of a guidance for the full year also intact?
Yes, as of now, they're still intact. We are still expecting to hit that number. While there are some, delays in approvals that we're seeing, we're still working on trying to pull in all of these numbers into FY27. And they're also the reason why we are still aiming at the 9,000 crores pre-sales.
Can you tell us a little bit about the delays? Because even last year, there were some regulatory hurdles, there were land, parcel clearances, etc. So what are the delays, and how are you so confident that it will get resolved for you to meet your full year guidance?
So some of it continues from last year with the some of the changes in senior positions in the local government and the state government. This is something that we're continuing to face. But as it's been going on for a while, we're hopeful that is closer to the resolution. And this is the reason why we're expecting to still see the launches come in this financial year itself. There is still not enough clarity on it, but it's something that we're working and spending a lot of bandwidth to ensure that it happens.
What's the extent of the deferral for Brigade Enterprises as of Q1 or a carry forward from FY26 and cumulatively including Q1? And also tell us a bit about the realizations, sharp jump in your realizations.
Yeah. Well, actually, the predominant delay has come in Q1. Like we didn't have about 1.5 million square feet of launches that we would have liked to do in Q1. We do have visibility of that coming into Q2 and Q3 as well. But yes, as you mentioned, positively on the realization aspect, our average price realization has gone up to over 14,000 rupees per square foot, which is a 20% jump year over year. If you look at Q1 FY27 versus FY26. A lot of it is, of course, due to the inventory mix and due to which are the projects that sold in Q1. We did have, some high-end launches in the last quarter, Q4 of FY26, and also continuing into Q1, sales from the same projects coming in. So that's a blend. Over the course of time, though, as we see the new launches coming in, we're looking at a different unit mix and a different product mix. So we'll be seeing some of that normalize over the next few years.
So last year, realizations were hovering between 12 and 13,000. This quarter, you're above 14,000. So when the new pipeline comes on stream and it normalizes, what is the broad range on realizations?
So if you look at what we have in the launch pipeline, the average price realization over there would be anywhere from 10,000 to 11,000 rupees per square foot. That's the rate at which we've provided a gross development value for these projects. What's happening today is you're seeing a lot of contribution from sustenance projects or projects already launched. And we do have 40 to 45% of our projects coming in from the above 3 crores plus ticket size. And a lot of these are more high-end projects in Chennai, Hyderabad, and Bangalore, where the average price could be more than 14,000, 15,000 rupees per square foot. In some projects going up to 20, 25,000 rupees per square foot. So it's very much a factor of the contribution of the inventory that got sold over the last quarter.
Okay, we just want to probe you a little bit on that Chennai project, Brigade Morgan. Where are we at? Because there were conflicting reports that came in the last month or so. Some said there was clear, some said it's not cleared. How confident are you that things will actually get cleared out and the project moves ahead as per your plans?
Well, as of now, it's definitely an evolving situation. The matter is currently in the Madras High Court. Brigade and the landowner have filed writ petitions in order to seek clarity about this. We have been maintaining that from when we launched the project, which was over a year ago, in May of 2025, we launched with all the requisite approvals in place, including RERA, including CMDA, including environmental clearance. But in October 2025 is when this PIL, this public interest litigation, got filed in Madras, in Chennai. And since then, it's been an evolving matter. We have gone to Madras High Court. We have referred the matter to Supreme Court, and it has come back to the High Court. The government itself has issued various clarifications, but I think it is an evolving matter, and it is not just Brigade Morgan Heights that is impacted. There are multiple other projects, developers, and individual citizens that have been impacted by this whole thing. So we are quite confident that it will have to get resolved, and it will have to, at some point, come to a head. And at that point, we will be ready to take this project forward and see through to completion. We are confident in terms of the approvals that we received for this project.
Have you sold any of these, any of the inventory of this project, though? Have you already done some sales?
Yeah. Yes, we had sold.
What is the amount?
So whatever we had sold, we have refunded and in the process of refunding the last few. Well, again, while we are confident about our approvals, it is not something that we have an immediate visibility in terms of moving forward right away. So we felt it was not right to hold on to customers' deposits. We've refunded those. We have communicated with all our customers and been, forthcoming with all of the information.
Oh, that's good. So customers will be feeling a sigh of relief then that, they've got their money back, if there is any kind of uncertainty. Could you help us out with what was the quantum?
We had about 80 bookings. So, maybe about 80 crores or so 80 to 100 crores was what we had taken bookings for, but we have refunded pretty much all of them. Some are in the last stages of refunding. Even in situations where the customers were comfortable to leave the bookings open, we felt it was something that we should just do and not have it hanging for them for a long period of time. And we will be ready to reopen for bookings once we've resolved the matter.
Okay, all right, Pavitra, thanks a lot for joining in and giving us clarity with regard to the guidance as well as on that project as well. Wishing you and the team all the very best for the remainder of this year.
Thank you. Thank you.
Okay, let's move on then. We've got a management joining in. Arvind, they've delivered a strong Q1. Margins have come under pressure for the textile business, but on the whole, revenue and EBITDA has beaten estimates. We have with us Puneet Lalbhai, Vice Chairman of Arvind, now joining in. Puneet, morning. Rima here. So overall for FY27, I think you are looking at a early teens growth on a base of 10,000 crore rupees. This is what you had guided in the conference call. But you also spoke about the possibility of an inorganic acquisition. 1 or 2 acquisitions flagged, but the timing was a bit uncertain. So tell us what's the thinking, because you recently concluded a QIP of 500 crore rupees as well. So what's the war chest, and on the acquisition front, what should we expect?
Rima, I think we've already done a large acquisition.
Yes, Dalco.
Which is the Dalco GFT acquisition in the US. And this is the first quarter where it has started reflecting in our results. So 2 months of Dalco GFT are showing in the Q1 results. So for the time being, I think the rest of the year will be spent in trying to integrate Dalco GFT while we look for other opportunities. We'll always keep our eyes open for other opportunities, but nothing immediate around the corner. The 500 crore QIP funds will be used to retire the extra debt that had come onto the balance sheet in order to finance the acquisition that will be taken off the India entity.
So revenue growth is going to be in early teens for the full year on a consolidated basis. Can you tell us how much will come from textiles, denims, AMD, and the Dalco acquisition?
So if you look at the business, it's sort of in 3 parts. The textile piece is the largest piece, which will grow at high single digits. The garment part of the business will grow mid-teens, and the advanced materials business will grow around 20%.
Okay. And Dalco in particular, because Dalco is also high margins for you. What is the full year contribution?
The full year should be around 1,000 crores in revenue, with a 16% around that mark in terms of EBITDA.
Okay. And what will all this mean for your margins? Because for the textile business, we've seen a margin contraction. But then you've got this Dalco acquisition with high 15% kind of margins contributing to the consolidated numbers, which was not there last year. So that offset is there. So on margins for FY27, what should we expect? And then break it up again for us in terms of the various segments.
So margins should be broadly around the range that we have been at for the full year. There is a lot of headwind in terms of war-related, conflict-related price escalations, which are continuing, unfortunately. So the textile margins are under pressure, at least for the first half of the year. The second half of the year should see some recovery there as well. However, the advanced materials business is inherently a higher margin business, which is now becoming a larger part of the overall portfolio. Almost 30% now this year with Dalco GFT coming in. So that will sort of counterbalance the headwinds on the textile margins. However, even on the textile business, we've been able to maintain or even grow absolute EBITDAs. Our absolute EBITDAs, even in textiles, grew quite significantly in the first quarter through higher volumes. And that is going to be the effort going forward. We're going to try and compensate some of the war-related margin contraction through higher volume, and the demand scenario, even in the core textile business, is quite robust.
So since textile is a chunk of your business, more than 50% comfortably, here you said margins currently in Q1 were 8%, lower than last year's level of 8.4%. But you are anticipating a recovery in the second half of the year. By how much? Can we get to 9%? What is the number that you're hopeful?
So we should come close to double digits. in the overall textile business. Our year is generally a year of two halves. Our first half of the year is generally more muted than the second half. So generally the margins tend to also recover in the second half.
So full year margins, Q1 was at 10.3%. With an improvement in textiles, higher contribution from advanced materials, what would consolidated margins look like?
It'll be very similar to last year. Okay. Our stated objective is to actually increase margin year on year through operating leverage by 50 to 75 basis points. That, unfortunately, this year has been taken away by war-related impacts and raw material escalations. But overall, we will have robust growth and we will maintain margins.
So maintain margins, though ideally you would have liked to improve your margins by 50 to 60 basis points on an annual basis. But this year, given the geopolitical issues, that's difficult. Okay, on net debt, you said the QIP money will be used to retire your debt. What is net debt and how much will it come down by as we wrap up FY27?
So net, it was around that 1,200 crores last year. 1,200 crores last year, and we increased it. We increased about 1,000 crores to acquire Dalco. 600 came on the India entity, and about 450 was at the US entity. We will retire the 600 odd crores that came on India. So the India balance sheet will almost revert to what it was last year. And Dalco GFT has a robust cash flow, which will be able to service its debt over the next 3-4 years in the US.
Consolidated debt? Puneet, consolidated debt as of Q1 is 2158 crore. What will that number come down to?
It will come down by 500 crores going forward.
Okay, and that is immediately because of the QIP proceeds. But after that, will you further look to bring it down?
No, we are very comfortable. As I said, the India debt is almost exactly what it was last year, and the debt service ratio is very, very comfortable. So we will allocate capital towards growth rather than reducing debt further.
Okay, all right. Thank you very much for joining us, and we wish you all the best of luck and look forward to the next conversation. We take a break. We're back with the management of Page Industries to talk about their first quarter numbers on the road ahead. Stay tuned. Coming up.
Well, Page Industries is the next management in focus. They reported a strong showing in the first quarter. To discuss the quarter gone by, the growth outlook and the margin trajectory, we're now joined by Mr. Dipanjan B, the CFO at Page Industries. Hi, sir. Morning. Good to see you in, and nice to have you on the show as well. But let's get a couple of points out of the way. In the first quarter, you've done close to mid-single-digit volume growth, but you're guiding that things will improve from here on. What's making you so confident? Is demand good on ground? And also, if you could help us out with this margin trajectory, you believe you can maintain it, though input costs have gone up. Do you need to take another price increase, or the one that you've taken is good enough?
So coming to the volume sentiments, the demand sentiments are quite strong. That's what you've experienced in the first quarter. And we are expecting things will remain as it is. Coming to the margins, yes, we have got a margin around 20.3% this quarter, which is well within our range of 19 to 21%. So while we did see a bit of an increase in input costs, especially cotton and all petroleum-based products in the mid of Q1, things are improving. And if the Middle East situation remains as it is now, we think that the input costs will remain at the same level. So we are fairly confident that the EBITDA margins of 19 to 21% will be retained for the entire year.
19 to 21 margins with volumes in double digits, right? So that'll be making up in the remainder of the year.
Yeah.
All right. Athleisure, that's a segment that you're focusing on. I think you're pushing a lot of marketing expense as well out there. And there's a lot of focus from the group over there. Could you help us out? Currently, I believe, it's 30% of your mix?
We don't exactly share the category-wise numbers, but we are definitely seeing a very good growth as far as athleisure is concerned.
But it's around, I think, 30-35% of the total mix. That would be a fair number. A third of your revenue comes in from athleisure?
We don't exactly share the number, but yes, it's a significant contribution of the business as of now.
Right. Mr. Dipanjan, good morning. Prashant here. On athleisure, could you give us a sense of how you're thinking about, expanding the range? As we understand it, all new launches, etc., are focused in this segment, whatever you do. So just, how big is the segment here as you see it? It'll help us crystallize what Page's strategy is. Yeah.
It's an evolving segment. As far as we are concerned, athleisure is largely 4 categories for us, which is the daily comfort wear, which you can wear at home. And then I would say the casual wear, which you can wear and step out. We also have the performance range, which is the jockey move range. And the last category you kind of entered recently, which is the street fashion, which is our JKY groove range. So with all these 4 categories, which is being adopted very fast across India and across the younger generation specifically, we definitely see a very good opportunity for us to grow in this segment.
And in terms of how much you will need to spend here on marketing, etc., could you give us a broad sense of how should we think about this?
See, largely we spend around 4 to 5% of our net revenue as marketing spends. And yes, within that, we have a focus on brand level marketing as well as category level brand awareness. So that will continue. Yes, there can be slightly higher spends for athleisure, for bringing in new consumers and for making sure that all our available range within athleisure is made aware to all our consumers.
There is one more thing, which there's a new platform, consumer data platform, which you are working on, which is expected to go live, I think this month or next month.
It has already gone live.
Okay.
It has gone live around mid of Feb, but it takes some time to get all the consumer data and start generating intelligence out of it.
So this is essentially an internal system to boost, cross-sell, etc., right? Do you expect it to provide a meaningful bump?
It takes some time. See, we have a large consumer base, across our online and for reviews. It's a very large consumer base, and to assess their buying behavior and then have an insight, meaningful insight from there for us to work upon, that will take some time. But yes, we do expect significant intelligence coming out of that, which we can use in future.
Okay. Sir, on the Disney and Marvel license, is there any current revenue contribution, or is it going to be meaningful in FY27? What are the numbers that you're working with?
It's very low as of now. We have just launched, and it will be gradually ramped up in the coming quarters. I don't think in FY27 it will be a significant factor, but yes, it will be gradually ramped up.
All right. So could you clarify on this? Feedback is that the EBO owners, they were not very, very happy because they're probably not generating enough of ROC since returns are linked to sales growth. In hindsight, do you think that aggressive MBO expansion that you took on a few years ago, that was a bit of a mistake, or you could have done it differently?
No. See, we have clear focus for each channel, whether it is MBOs and EBOs. And as we understand, as far as the exclusive branded stores are concerned, their turnover is much faster. So typically, most of our exclusive branded stores are break-even within 7 to 1 year. So we don't see there's an issue there. And given the fact that there's a significant interest in opening EBO franchises, so it's doing quite well and it keeps growing.
Okay. All right. Final question then. Royalty rates, what is it at and when does it come in for review? If you could help us out with that. And also, we have various trade agreements that have taken place globally. Does it give you a bigger punch in the global markets? Will exports form a bigger proportion of your sales? If you could help us out on that.
Okay, so royalty rate has been 5% right from inception, will continue to be so. And we have the agreement with Jockey till 2040. So rates are quite stable and will remain so. FTAs, yes, it's an opportunity which has come in. Though the countries which we have signed FTAs, except Middle East, right now we don't have any export presence in those countries. But yes, it is opening up new opportunities and we have to see how it evolves going forward.
So on third-party logistics, you said that failure cost you about 3 days of extra billing. Now that you faced a disruption on account of the logistics, are you rethinking the way your logistics operations will be here on? Would you look at in-house delivery or a more diversified logistics play?
No, this was a temporary development which happened in the June end. Our way of operations with third-party logistics will continue. We don't see any challenges there.
All right. Thanks a lot for joining in, sir. Wishing you, the team, all the very best. We'll hold you to these numbers. You're expecting a good bounce back in terms of volumes, and you expect the margins to hold in this vicinity of around 19 to around 21%. Have a good day ahead. Time to take a short break. On the other side, Lata's waiting for us. She'll be joined by the management of Canara Bank. Stay tuned.
Welcome back. It's time to speak to big banks once again to get a ground check on FCNR's credit growth ahead of the festive season and some liberties that the Reserve Bank has given. Canara Bank is the bank on our radar. It reported a strong 18% loan growth, but less than 12% deposit growth in their first quarter. Net interest income was impressive, grew by 13.4%, but profits grew only 2.2%. Asset quality is top class, so credit cost is next to nothing. Joining me now is the MD and CEO of the bank, Pradesh Kumar Singh. Mr. Singh, good morning. Thank you very much indeed for joining us. Well, for starters, why don't we start with this advances and deposit growth mismatch? Clearly, your predecessor drew on the 75% credit deposit ratio they had, but now you're at 80. So do you still think you can go towards 90 and therefore you will not concentrate so much on deposits which are anyway costly? Or, I mean, what's the strategy on deposits and loans?
Good morning, Lata. Thank you for having me on your channel. But before I start, let me tell you something with deep sense of gratitude. While I was preparing for this position and for other interviews also, I was continuously watching one of your programs called Indianomics.
Oh, thank you.
The way you used to moderate, the kind of panels you used to invite, it was very helpful.
Thank you.
We used to get the diverse views, and it helped you to have your own views on those very contemporary topics.
Thank you, Mr. Singh.
So thank you for having me on your channel. So yes, our CD ratio was down little, but it was at 75%, and you earn less on yield on investment is around 6.90, whereas yield on advances is at 8%. So it was obvious we wanted to grow on advances side, though calibrated. We grew very calibrated and keeping underwriting standards. We were very mindful for that also. So as of now, we are 80% on CD ratio, and we can still grow 1 or 2% here and there, but we are focusing much on deposit. Our deposit growth was also very in double digit also, and as of now we speak, still we are growing. We are growing very handsomely.
Okay.
The most heartening thing is that we are going in like in CASA, if you speak, which is the low cost deposit. We are going in individual side. SB individual, we are going much better than the institutional part of it.
Okay. Okay.
Gradually, we are doing, yes.
Yeah, since you brought up CASA, I wanted to ask, do you have any legacy wholesale deposits which you can run down? Are there any levers? Because you're one of the few banks which has reported slightly higher margin compared to the fourth quarter. I mean, it's not much. Fourth quarter, I think you were 2.51, now you're 2.52. But it is still, the direction is higher. Do you have any leeway to improve the margin? What's the guidance for this quarter? Half the quarter is over.
Yeah, very correct. Trajectory is towards the positive side. Yes, we have got some leeway. We have got some high cost. Our dependency on bulk was little on the higher side. So we will be shedding some of the bulk deposits, which are high cost bulk deposits. We will be shedding that. We will be replacing. It will be not entirely possible to replace it by CASA, but gradually will be replacing it with retail deposit. May it be retail term, may it be retail CASA. And this FCNR deposit is also helping us.
I was coming to that. What is your number? In that parliamentary breakup, I don't remember your number, but you all were not up there with the SBIs of the world who have, gone whole hog. What is the number so far and what are you targeting?
I think we have done very good on that count also. See, we gave guidance that we will be garnering 2.3 to 2.5 billion of dollars by those three things: FCNRB, ECB, and OFCB also. But as of now, ECB and OFCB will be targeting in the October, November, December, considering this FCNRB dispensation is up to September only. So our target was 1.5 billion. Against that, we have already done more than $2 billion. And we are only third nationalized bank after SBI and BOB.
Okay.
In spite of we are not having much branches across the globe. But still, 2 billion we have already surpassed.
Okay. So you're trying to beat your previous bank, huh? You come from BOB, didn't you? You're trying to do better than them. You're trying to do one up over them. But, lately there was a fear that FCNRB is not really reducing margins. All banks are at it. So you're forced to offer higher returns to the investors and also higher leverage, will it really improve your margins?
It will. It is helping us not on margin count, but on count of this thing repricing some of our high cost bulk deposit. So last month, whatever we were repricing, it was more than 7. But this we are offering here 6.5%. But that also comes from the swap, the free swap, the free rupee swap we have been offered by Reserve Bank of India. So that costs somewhere around 3%. So we are only paying, say, 1.5% therein, but still we are saving 1.5%. Again, this is not attracting CRR and SLR. So again, you are saving 22, 23 paisa there. So it is helping us, yes.
Okay. What about this new rule that Reserve Bank is going to start, that you all can freely price your bulk deposits depending on the LCR category? That is, for a retail investor like me, you will offer higher on bulk, whereas for financial institutions like a mutual fund, you can offer less. Is this a very big advantage? You think it'll add to margins or anything?
So whenever you get some this thing, headroom or legroom, so it is advantageous only. So you can, I mean, depending upon your ALM, depending upon your LCR position, you can offer those rates. I mean, me or any of the banks. So it will help us in repricing our deposit portfolio at a lesser frequency.
Okay. You said that you're working a lot on your advances growth, but your guidance for loan growth is much lower than what you have achieved. You've achieved 18%, and the guidance, which I assume is the Q4 guidance, which you'll have carried over, is only about 10 to 11 to 12. Isn't that a bit understated, considering that I've done 18? Do you want to lower it, change it?
No, we don't want to lower it. We want to change it. Guidance are there, but we will better it certainly. And first quarter, there was help from this emergency line of credit also, which that dispensation came. So that has also helped in MSME. And then again, I mean, due to West Asia crisis, there was much utilization on front of overseas line of credit also. And our dollar assets also got repriced. So it was an effect of everything taken in the right perspective. But still, we will better. Whatever the guidance we have, 11 to 12% we have given, we will be certainly bettering it, yes.
I guess there was a base effect also for credit growth.
That's correct.
Yeah. Mr. Singh, I wanted to know, where will you lend? I mean, it's 18% is good. And as you say, even if you do better than 11 and 12, you do 13, 14. All of you guys, banks, are going to be flooded with whatever, $80 billion or something. That is an additional 18 lakh or 8 lakh crore to lend. Is the growth, is the demand for credit that good? You don't have what will be your priorities in terms of whom you lend to?
So you would have seen, Hakini, there is a lag between the growth rate of deposit and growth rate of advancement. In your opening remark only, you said. So some of money will be this thing, it will be bridging that gap. So, and then there is a demand in this thing. Yields have hardened, so the debt market has become a little costlier for corporates also. So they'll be looking towards banks. So we will be getting opportunity there also. And in retail also, we are doing very good retail RAM sector. So everywhere there is a demand. The demand is from this thing, power. Demand is for power evacuation, battery saving, green, and then this. How do I say it's a data center? So a lot of demands are coming from new sectors also.
All right. Oh, that's good to hear. Good to hear from the economy point of view. A final question. You said that after this FCNRB season, you all will look at ECB and OFCB. Just for the benefit of viewers who don't like abbreviations, it is overseas foreign currency borrowing of banks, and ECB, of course, external commercial borrowings. Why would you want them really? Because your CRAR, your capital, is very good. It is 16.5. Although it was 17 last year, it has come down to 16.5, but that's a very good number. Do you really want more money?
So agreed. We are not doing this for margins. We are not doing this for augmenting our capital base. We are doing it with some other motivation, considering we want some inflow in the country, dollar inflow, so that our rupee gets this thing stabilized. And there are other benefits of also. We have got deficit in current account.
Cost of funds. Cost of funds will be an advantage because the swap is being picked by RBI. So will you have a cost advantage?
yes, we have got a cost advantage. 3 rupees swap in FCNR, then again this thing concessional swap in ECB. So we will be registering advantages on that count also.
Okay, and you have fixed up on the number, how much you will raise ECB or overseas foreign currency? Any numbers already been arrived at?
Like everywhere, we are bettering our guidance. So 1 billion we thought Hagney 500 and 1.1 billion we wanted, but I think we will be bettering that also.
Okay, I think you should give us a new guidance and not stick to your predecessor's guidance. We will wait for that in the next quarter. Thank you very much, Mr. Brajesh Singh, for joining us.
Thank you.
And a very happy Independence Day weekend to all of you.
Thank you to you too. Stay blessed.
Well, that's it on this edition of Bazaar. We wrap up. Chartbusters coming up.
Tata Motors PV is the top loser on the Nifty. Stock slips 5% after a weak quarter where Jaguar Land Rover business drags numbers. Management commentary indicates that a recovery is likely only in the second half of this financial year.
Honasa consumer surges in trade. That one still holds with a gain of around 3% as its strong run continues, with EBITDA rising 140% in the first quarter. Welspun Living as well is up close to around 9% on strong margin expansion and profit growth. Indigo paints two rises on strong numbers.
Street cheers a strong performance coming in from Galaxy Surfactants. Stock locked in 20% upper circuit after the profit doubles in the first quarter. Management speaking to CNBC TV 18 also raised its EBITDA per ton guidance for the year.
Jubilant Food rallies as broker Jefferies issues a buy rating with a target of 650 rupees after its first quarter numbers, citing strong management commentary. The stock rallies close to 3.5%.
Page Industries recovers some of yesterday's losses on an optimistic management commentary which suggests that undelivered billings led to quarterly underperformance. Brokerages like HSBC issue buy rating on the stock with a target price of 47,650 rupees a share.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. For the time being, markets are down but not out. Hey, Mangalam.
Down but not out, but a bunch of stocks which are moving around. So best time to actually get in some ideas for profit coming in from our colleagues at Money Control Pro. And today we have Kanchi Shah, who's talking about a stock that she's been tracking. Kanchi.
Bajaj Auto's revenue grew by 37% on a year-on-year basis and the EBITDA margin expanded by 113 basis points to 20.9%. So this was achieved despite supply chain disruptions and a temporary suspension of operations because of the cybersecurity incident. Exports were the biggest growth drivers this quarter, with the volume surging up to 54% on a YOY basis, and exports now make up to 51% of the total volume. So this mix shift matters because the export business is more margin accretive and rupee depreciation works further in Bajaj's favor. Management is also targeting a monthly export volume of over 2.5 lakh units now going forward. Also, the company has made significant strides in electric vehicle segment and it now holds the second position in terms of market share. So Chetak delivered quite good performance with EVs now contributing around 30% of the domestic business. Demand is outgrowing supply and it is prompting a capacity hike of 50 to 60,000 units a month for electric vehicle. Bajaj is also planning its biggest capacity expansion from 7 million units to 9 million units. So with exports, EVs and premiumization all firing together, we recommend adding Bajaj Auto to your portfolio.
Well, with that, let's go across to the new listing on the bourses. That's logistics player Leap India. But before that, we will take a short break. Come back. On the other side, the management joins us. Welcome back. You're watching us here on Chartbusters. The stock on our radar right now is Leap India. If you remember, about sometime last week, we had the management join us. They are the company that make pallets for logistics, and today is the listing. It listed at slight premium, thereafter saw a bit of a sell-off. So currently trading a little below the issue price of about 159 rupees. The stock at around 153 thereabouts itself. So to understand the company's growth plans post-listing, we are joined by Sunu Matthew, who's the founder and managing director, who joined us in our studio last week, joining us again. Thanks a lot, Sunu, for joining in. Congratulations on the listing. A milestone indeed for the company. Now, you know, the last time we understood your business, we understood everything that you're doing. Let's get in granular and let's talk business now that you're listed. Your outlook on FY27, revenue as well as EBITDA. Back of the envelope calculations suggest if you continue to sustain this 30% jump in EBITDA as you had pointed last time, you can get to 600 crore EBITDA by FY28 and 105 crore PAT by FY28. So on FY27, revenue and EBITDA outlook, and whether these numbers for FY28 are justified.
So thank you, Nigel and Mangalam, for calling me to your show. We are very happy as a team, to be listed on the National Stock Exchange. See, as far as growth is concerned, we have already said that we will continue the momentum what we have done in the past, and the proceeds of this will actually strengthen our base if we have to add any further assets into the pooling model. See, we have done the certain numbers which I have told in the past, like 747 crores of turnover with 379 crores of EBITDA and 63 crores of PAT. So in this pooling business, Mangalam, what happens is that the more you start to pool, the cost actually comes down. So there are much more chances that we will be showing much better numbers in the future times to come. And as I have told in the past, that the depreciated value of my plastic assets, which is basically used in automotive, is coming to an end. Plus, the proceeds which is going to pay off the debt is going to free up a lot of interest, and that will directly flow into the PAT. So you will see a fantastic number in future. And about what you have envisaged and calculated on the basis of our previous numbers regarding EBITDA in FY28, we are somewhere near that, but currently it's not right for me to talk about FY28 numbers.
Okay, all right. So around 600 crores of EBITDA with 100 crores of PAT is directionally where you're headed in 2028, right?
See, again, I will not be able to give you a certain number.
Okay.
But definitely, yes, I have said that PAT, definitely we will be growing ahead of 50% plus.
Okay, all right. You know, how long are your contracts with your customers? Could you tell us after how long does it come in for renewal?
Okay, mostly our customer contracts are between 3 years to 5 years, and it comes in between, and every time we actually increase the contract tenure, that comes up with a price index on the basis of plastic and the wood price index.
All right, because you had last time said that, you know, prices of both plastic and wood have increased, so that may have impacted your future margins. But the question is also, you know, your total assets. The last time you joined us, you said you have 9 million pellets right now. Over the next 3 to 5 years, at what rate will these grow? Because you are deploying some of the capital into increasing your pellet capacity as well.
Absolutely. So, Mangalam, what we will be doing is, since last 6 years, we have put in round about 600,000 pallets to 1 million pallets. Last year, we have put in 1 million pallet. And that is the kind of pace and the growth that we are having in the industry. So, we will keep doing that, a little more than that, because now we are flushed with capital. We will be trying to do more than that. And also, the container business that we have. See, previously it used to contribute around about 14%. After buying of CHEP, it has actually surpassed 21%. And this year we are looking that the component manufacturing in automobile will contribute somewhere to the tune of 24%. So there also it is not only about pallets, wherein we will add 700,000 to 1 million pallet, but definitely we will add a lot of our plastic assets. And last but not the least, we have something which is known as MHE rental. Everybody in India today is looking out for lithium ion battery forklifts on rental. So we dramatically is going to improve the numbers in MHE renting also.
All right, final question. How does the revenue mix evolve? Other material handling equipment and pallets, how will it look like, say, in the next 3 years?
See, I think the pallet will continue to grow because we are still at a very nascent stage into pooling of pallets business in India. So I believe that 66% will be contributed by pallet, then 14% will be contributed, 14 to 16% will be contributed by MHE, and rest will be from the automotive business.
All right, take that point. Thanks a lot for joining in and giving us an outlook onto your business. We'll obviously speak about more once your quarterly numbers are revealed as well. For now, enjoy the day. Congratulations on the listing.
Thank you. Thanks a lot. Thanks a lot.
With that, we'll take a short break. Come back on the other side, an exclusive conversation lined up with the management of Solar Industries to discuss their strong first quarter numbers. Stay with us.
Welcome back. Solar Industries delivered a solid showing in the quarter one on all parameters, revenue, margins, as well as on the profitability front. The order book is well at around 21,350 crores. Well, the street really liked that number. Joining us now is Shalini Mandana, the joint CFO of Solar Industries. Hi, madam. Good morning. And good to see you in as always. Congratulations on a good showing. First up, going by what you have delivered in the first quarter, the street would like to know whether or not this 14,000 crores of revenue guidance, 4,500 crores coming in from defense, Is it conservative? Do you believe you can outbeat this? Point number one. And point number two, now you're consistently doing margins in excess of 25%. Is the 27, 28% the new normal?
Hi, good morning. First of all, thanks for having me on the call. So yes, so the annual ambitious guidance for this year had been 14,000 crore as against 9,800 crore in the previous year. So first quarter had been a good start for us, and we believe that, and we are very optimistic that the number of 14,000 is quite achievable. Since we have given the guidance just a couple of months back, so we may do revision in the guidance after half-year results.
Interesting.
Coming to defense top line, yes, we are very happy to state that defense has been a key growth driver for our business now, and it has done a business growth of 123% year on year. But you see, defense business is always a slow moving cycle, starting from product development to getting the product qualified, getting orders, setting up the supply chain limit. So we see that the 4,500 as a current visible number for this year. But as I said, let the further quarters evolve. We'll see how the numbers evolve in further quarters for any revision.
So possibility is that you could be looking at revising this guidance after the strong showing in quarter one, but we'll have to wait for quarter two to hear about that. Got that, Shalini? What about margins? This is the new normal, 27, 28%?
Yes, margins, we could maintain the margins of around 28% in this first quarter, despite the volatility in most of the commodity prices. This has been achieved mostly on account of strong execution from our team members, efficient supply chain management, and the gains we have achieved through our recent expansions. Also, another wing which has recently come up is the defense revenue, which started generating good numbers since last year. We see that 28% around margins are new normal for business at this growth stage.
All right, 28% margins, and the growth that you're reporting extremely strong. 35% plus is what you've targeted for the entire year, and with a probability of that increasing as well. Just a two-part question here as well. If you could break down the revenue growth expectations for both the domestic business as well as the international business. The last time you joined, you said it would be about 35% each. If you could revise that for us. And secondly, on Pinaka as well, 550 to 500 to 550 was the annual billing. You had expected this number to go up to 700 to 800. By when does that happen? And what's the revised number here too?
Okay, so we had said that with the annual results that yes, this year the volume growth should be around 15% and the price growth should be at 18 to 20%, so around 30-35% growth both at domestic as well as international level. We do maintain our guidance. The domestic business was really helped with good demand from the electricity segment, which led to demand from mining sector and which augurs well for our industry. We also got advantage of the commercialization of our Dhule plant in northwestern part of India and expansion in Dholpur plant in the northern part of India. And we also setting up a plant in Odisha and another plant in southern India in next 1 to 2 years. So all this should give a good backup for growth in the domestic market. Even in international market, the growth had been good. The year-on-year growth went up to 65%. And we see these for the current year, we are maintaining the growth of around 30 to 35% in both the explosive division. Coming to Pinaka, yes, Pinaka, we are in the order book of around 18,000 crore from defense. Pinaka is the largest contributor, and we expect the Pinaka extended range order to come in soon. We are in the negotiation stage, and we do see that the order should come in before the end of this year. So once the order comes in, we'll add the numbers. The numbers on Pinaka will be added going forward.
Pinaka, we hear about the Pinaka, the enhanced range, we hear about it sometime in the second half of this year, maybe in quarter 3?
Yeah, quarter 3, maybe before the end of this year, we feel that should be there.
All right. And when you're talking extended range, what is that range you're talking about? I think earlier it was 25 to 35 kilometers. Now I think you're looking at 45 kilometers or thereabouts or more. You could correct me on that number.
Yeah, the guidance range is around 75 kilometers.
75 kilometers.
So what does that mean in terms of increased revenue for you? For the extended range, you expected that to be about 700 to 800 crores, right? Is that a possibility, or could that be higher?
We expect those numbers, but let the order flow in, then we'll be able to, have a clear guidance on the number.
Got that. And what's the update on Bhargavastra? Because the last time, again, the management joined, said that FY27 trials are on. You are considering proof of concepts and all of that. All the prototypes are happening, and something should happen this year. What's the update there? And how big could this business be?
With respect to Bhargavastra, we are at a very advanced stage. Most of the trials which we have done have got completed. The final testing and final lot trials are in place. So we do expect that the trial should get completed before the end of this year, and the order should flow in from next year.
Okay,
once
all right.
the RFP comes out.
From next year. Bhargavastra is for next year, Pinaka second half of this year. Tell us about the 155 diameter shells as well that you're looking at. I think the capacity is 300,000 units. And by when do we start seeing some revenue contribution from here? Because that's the new line of business, right?
We have good demand for 150, and we have set up the facility. The progress is on, and the final trials are in process.
We start seeing some revenue recognition from this vertical in the second half of this year?
Yeah, some numbers may come in from second half of this year.
And the capacity is 3 lakh units?
At present, very difficult to say. Let's see, how the numbers come in. We may comment in the fourth quarter.
Okay, so at full utilization, let's not talk about the numbers on capacity, etc. You're uncomfortable with that. At full utilization, how big could this business be?
So there, it all depends how the qualification and how the order comes in. So let the order come in. That's what I said. Then we'll have complete details on the product and the delivery schedule.
Okay. Shalini, I'm looking at Goldman Sachs estimates. They are talking about 2,300 crores of net profit in this year and 2,800 crores in the following year. That's FY28. Going by the run rate that you're doing, do you think you can get closer to the FY28 number in FY27 itself? That means a PAT of closer to around 2,800 crores?
So you see, first half have been very good, and those numbers, it's currently we are not revising. As I said, we just had annual guidance in last 2-3 months back. We had given the guidance. Let quarter 2 results come out. We may see some revision in the numbers at that time.
And the last time let's not talk about this year also. FY29, you had said that you're on track for 4,000 crores. It seems like you'll have to revise that guidance back to FY28 as well. Is that possible?
Let's see, business dynamics keeps changing. So yes, first quarter had been really good, and it's more than our expectations, but we do maintain the ambitious guidance which we had kept in the year with respect to both top line and bottom line. Okay. So let the quarter, further quarter numbers follow. We'll obviously get back on how the year unfolds.
Okay, what's the cash in books? Cash in books, what is the current cash in books?
So we have healthy liquidity position. So cash and cash equivalents is around 80 million at present.
80 million. All right. Because there is some buzz that probably you'll go for some inorganic growth. Is there something that we should hear about in the coming quarters? Because you'll have said in the past, you're always on the lookout. There are some competing companies, I believe, from India as well, and it could be quite a sizable one. Any clarity on that? Should we hear a big announcement on the inorganic side in the coming month or the coming quarter?
We continue evaluating, the growth opportunities by way of either greenfield expansions or by way of acquisitions or by way of investment in startups. We see that if, they have a long-term value creation and sustainable business and add value to our business, we surely go further. So once, something materiality comes up, we'll share with our stakeholders.
All right, we'll await that as it comes as well, because when we earlier spoke about Premier Explosives, whether you all are interested or not, that deal is now done. So obviously we'll await any other assets in the market which you all may go ahead and wallop as well. But new markets, Africa and Australia, you all are exploring that as well. How much does that account for right now in terms of growth opportunities, and how big could this market be?
Yeah, Australia, South Africa has really been good. So if you remember, we had slog around 3-4 years before finally entering the market. Currently, it's the topmost revenue, giving market for us. So that's a good place, and we are growing both South Africa as well as nearby areas.
Okay, all right. Shalini, you're holding the cards close to your chest. The first quarter was very, very good. But we re-invite you during the course of the second quarter or at the end of the second quarter to revisit the guidance and also probably some inorganic growth, which the street will be watching for very, very closely. Thanks a lot for joining in and giving us all of those details.
Thank you.
Okay, all right. Well, that's the management of solar industry sounding optimistic. I think the stock actually has cut its losses. It was down, I think, close to around 4%, but management sounding reasonably optimistic that they can get to the guidance that they've laid out and probably will hear some revision in the time to come. Stock was down 4.5%. Now it's cut its losses a little bit. But that's it from Mangalam and myself on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting by.
Hello and welcome. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me from the Bangalore studio is Ritu Singh. We are celebrating Independence Day in our Indian finery right now. Ritu, the market, however, is slightly under a wee bit of pressure. Around 24,300 for the frontline index, led lower by the banks. We have seen a decline in the IT pack as well. The IT index is actually currently at the low point of trade. And the mid-caps too, lower by about 350 points. We've been in this range. Every time we move closer to that 24,250, 24,270 thereabouts, there is a bounce that takes place. Currently, as we speak, we're hovering around important support zones for the frontline index. Though, as we move progressively into next week, the triggers will keep getting lesser as well because the earnings season is out. Now, the street will look for more triggers ahead of the festive season.
Well, yes. Good morning, Mangalam. The earnings, thankfully, now coming to an end. It's been a earning-heavy week. We still have quite a few to go through, come the close of Friday. But that said, yes, for the markets, it's out of the last 4 sessions, apart from Monday, we've been very much in the red. So we'll have to see if we're able to flip that trend and close the week in the green. But for now, trading with cuts of about 85 points on the frontline index. The Bank Nifty also just hovering above that 200-day average, now at 57,451 as we speak, still trading with cuts of about 0.3%. Broader markets are seeing the pressure, and look at the market breadth. You have about 1,750 stocks that are declining for about 1,240 stocks that are advancing. So those crisscross lines have not really crossed at all. In fact, they're diverging. More stocks are declining than the ones that are advancing. So all of that, keep that in mind for Brent as well. It's hovering around that $87 a barrel mark, and rupee holding up today. It's trading in a very narrow range, 95.39 to $1 as we speak. Apart from that, look at some of the key names that are, moving the markets. Reliance, that's the big boy. That's been one of the big draggers for the frontline index today. State Bank of India and Infosys as well, adding to the pressure. But on the flip side, you have Airtel, HDFC Bank, Apollo Hospitals, ICICI Bank. These are some of the pullers that are keeping the market afloat. In terms of sectorally, it's red across the screen, but the biggest pressure where you're seeing is on the metal pack, the IT pack, the PSU banks, and, the media pack as well. Relatively better off, of course, is the Realty and FMCG index, but very much in the red. So that's where we stand as far as the markets are concerned. As we speak, about 24,315 on the frontline index, Mangalam.
Indeed, 24,350 for the frontline index. Bharti Airtel is actually a stock which is currently moving higher from the lows, so that is a fair weight on the index that's supporting it as well, up around 2.5%. Remember, yesterday the announcement was that they've curtailed some of their low-priced plans, so as a result of which that could improve their average revenue per user. Bharti Airtel as a stock been doing well yesterday as well, and today too has moved to the high point of trade, supporting the frontline index. If we quickly pull up the contribution chart of the Nifty, you'd probably see the top contributor on the way up would perhaps be Bharti Airtel itself. It's dragged lower, obviously, by the banking index, and you have, Reliance, which is lower by about 22 points on the Nifty. Bharti Airtel, there you have it, 35 points higher on the Nifty. So had it not been for that, we would have been in triple digits as a cut. But one stock which is actually doing well is Honasa Consumer. It's up around 1.5%, but the run of solid results continues. So the stock over the last 6 months or so is up over 80%. So add to that about 2% is what the street's giving it. It's close to its 52-week high as well. 27% jump in the revenue. The EBITDA has actually seen a jump of over 147%. And we've seen the margins come in at around 15% versus 7.5%. So they've doubled as well. And the net profit on a base of 40 crores, the company's reported 90 crores. The important part is that growth has been volume-led, broad-based volumes, 30.5% volume-led growth coming in, and margin expansion has largely been on account of better channel mix. So general trade and modern trade is where they enjoy better margins, and those two channels have grown over 40% as compared to e-commerce, which has grown at around 20%, which is a larger contributor to their overall sales. And they have been increasing their growth in offline sales too. Mamaearth, which is their key brand, has continued its growth, accelerated to about high teens growth in Q1 FY27. The important part is that the younger brands, the companies, focusing on their house of brands strategy, the younger brands have grown over 40%. And Dermaco, which is the other brand of the company, has actually crossed the 1,000 crore annual run rate, along with EBITDA in teens. So all these things doing well for the company. The stock higher by about 1.5% after a big rally that we've seen already. But that's not the only one with good numbers. In fact, Nifty earnings itself have grown 15% in FY27, or likely to grow 15% in the first quarter. That's the word coming in from Motilal Oswal's Gautam Dugar, who joined us this morning, saying that the market has seen the best quarter in the last 3 years with 20% growth. Listen in.
In terms of quality, in terms of quantity of earnings, in terms of the breadth, whichever way you look at it, I have not seen a 20% plus earnings growth for last 12 quarters now. More importantly, the top line growth is at a 3-year high now. So inflation has made a comeback, which is now representing in top line across sectors. 3 years, we are seeing a turnaround in small cap earnings. We were expecting a 30% growth for full year, and the first quarter has given us that confidence that the full year can be met. The first quarter small cap earnings, and we cover a very vast numbers. We have 180 small cap companies under our coverage. They have delivered 32% earnings growth. So we are expecting to end the year on small cap with 30%. mid cap with 22% now, and large cap with 15%. Nifty will see 15% growth after 3 years. The only missing link, as we all know, in the last 2.5 years has been the flows. The FI selling has been massive. We are all aware about the numbers. In fact, on a decadal basis, they've become neutral now. Last 10 years, cumulative flows of FI is zero now. They've bought $69 billion in primary market, and they've sold exactly $69 billion in secondary market. India is a very diverse market. You have 5 big cohorts if you look at it: financials, consumption, tech, industrials, and healthcare. And one common thread running across these 5 cohorts over the last 2-3 years has been the big bellwether stocks in each of these cohorts have done pretty much nothing. When I was looking at bottom-up numbers for Nifty 50, there are 27 companies in Nifty which are almost stopped growing, or maybe growing at 5-7%. So real growth, even in the top 100 companies, is happening beyond Nifty 50. Where are we positive? If you look at financials, we are more positive on the non-bank side, both lending, non-lending, capital market, which is a big overweight in our model portfolio. If you look at consumption, one good thing we did 2 years back was made FMCG zero. We converted all our 15% weight on consumption into discretionary. Right? Industrials also, if you look at it, what is done well? It's not the benchmark stocks which are bellwethers in that segment. It's the power-oriented names, transmission, defense, likes of Dixon. They are the ones which are there in our model portfolio. If you look at tech, we've been consciously away from the traditional legacy large cap tech. We are more towards the new age technology. In fact, our coverage also has ramped up significantly out there, and we expect to have a far broader coverage in that domain.
Interesting comments coming in there from Gautam Dugar of Motilal Oswal. Slip into a short break on that note. But when we return, we'll get you the management of Minda Corporation on their first quarter numbers. It's been a robust set, and their CFO, Ajay Agarwal, will be joining us shortly.
Hello and welcome to Bond Street. Joining me on the studios today is Amit Tripathi. He's President and CIO at Fixed Income Investments, Nippon India Mutual Fund. Amit, hi, thank you so much for joining in. Well, you've been running fixed income at Nippon India for 2 decades now, and it's a long time and a very, very stretched innings in that sense. Yeah. What would you say on what the bond markets have been when you started and where do they stand right now?
So too many differences and too many similarities. I would say in terms of differences, the size obviously has exploded. The number of players, the diversity of players has changed. Obviously, the number of issuers and the kind of issuances that we have seen has also changed. Although I would say that the market still has a lot of similarity as it was when I joined on 27th October 2003, okay. Which is that it continues to remain primarily vanilla, primarily cash-based and primarily high-grade, though things are changing slowly right now.
If you look at the people who park money in their FDs and if you look at the interest rate cycle right now, I mean, that clearly has continued to decline or consolidate at its best. Yeah. What would you tell the people who've been investing in FDs to do something differently today?
So I think this is again a very, very long problem in this and long-standing problem in the sense that FDs by nature are supposed to be offering reasonable returns only for a limited period of time, which is say 1 to 3 years, purely depending on banks' ALM, right? People who want to see more consistency, more visibility in their returns have to find alternatives through routes such as mutual funds or bonds themselves. There are solutions that are available right from 3 months up to 40 years if you are actually looking at direct investments into bonds or if you are coming through debt mutual funds. So I think that is a much better, cleaner, simpler, more visible solution for short-term, medium-term as well as long-term, something that the FDs cannot provide for most of the time periods.
Amit, what would you say to people, to investors, on how long and how much should they be investing in bonds and why?
Oh, that's very simple. I think the bond is the building block for any investment portfolio. I think a lot of people start on the wrong side when they start with equities or commodities or anything. I think bond is the building block, as I mentioned. Bond is the simplest. Bond has the maximum amount of visibility. Bond gives you multiple solutions for multiple issues. And bonds are much more predictable. So I think that is the start of any journey. Most importantly, bond is that part of your portfolio which actually gives stability and visibility to your portfolios, which actually allows you to take risk to build wealth ultimately. So you cannot not have a portfolio which doesn't have bonds in it, is how I would want to put it.
From writing a big check to almost investing just about 1,000. And then, of course, accessibility in sense of OBPs, would you say has made retail investment into this market pretty easy?
Yeah, technology is a big leveler. So I would definitely feel that whatever has happened from the technology side in terms of enabling easier access definitely improves participation. OPPPs are one such big step that the regulator has taken and the markets have grabbed. And I think like with any other fixed income avenue, OBPPs offer that additional window where actually the most important thing, the way I think about it is you can actually marry your tenor, your risk appetite with a variety of solutions that are offered on the screen, right? So to that extent, I think it is a very, very welcome phenomenon.
All right. Nippon India, as we know, runs one of the country's largest debt franchises, from liquid funds to gilts and target maturity products. From where you sit, what would you say, where is the max interest coming in from a retail investor right now?
See, for retail investor, it is pretty simple. It is always to do with the kind of carry that they're looking at their portfolios, right? So it's a very simplistic yardstick with which they look at it, which is essentially maximizing returns or maximizing carry, current carry. In that sense, the credit risk fund category and the short-term bond fund category are the so-called evergreen categories as far as mutual funds are concerned. Although there have been very willing and multiple converters now for longer bonds also, once they understand the concept that in India, there is only one asset which can actually give you visibility for 30 years of a fixed interest rate, which is much higher than what gets offered by the best of FDs. They themselves convert into these long bonds, but that needs a lot of financial literacy and education. Barring that, I would say predominantly investors focus on carry, especially when it comes to retail. So whether it is bonds, whether it is mutual funds, I think the propensity is to come into products such as short-term bond funds and credit risk funds.
Nippon clearly has a lot of reach into smaller towns, SIPs, demat accounts, as that spreads well beyond metros into smaller towns as well. How much time, or would you say, are we already there when it comes to SIPs and demats as the way of Indian saver getting into bonds in some sense?
So I would say we have fallen short, and I think the issue lies actually in financial literacy. I think we need to do much more on a concerted basis, whether it is on your side or from our side or from the association AMFI's side for that matter, to improve financial literacy. Because if we have seen so much of success on the equity side, even on the commodities side of late, there is no reason which an asset class which gives much higher visibility and much higher degree of predictability should lose out in terms of retail reach. And I think it's all financial literacy. The more we do, the more people come around. I know my friends in tier 2 towns have started using OBPPs, have started investing in debt mutual funds regularly. So it is just a matter of reaching out and financial literacy. We should all work towards it more and more is what.
And finally, Amit, with the kind of new products that we're looking at and technology, so what excites you the most about on where the bond markets are headed? What is it that you would want to give as a message to retail investor who's watching you today?
So fixed income allocation has to definitely be part of your portfolio. And as my friend here says, a bond in every hand. So I think that is the dream for all fixed income investors, a bond, a debt mutual fund, a fixed income allocation for each and every investor.
That point is well taken, Amit. Thank you so much for joining in. Really appreciate your time here.
Thank you.
Thank you.
Welcome back. You're watching us here on Trading Hour. The stock on our radar is Minda Corp. But before that, just keep an eye out on this news coming in from Piramal Pharma. It's actually a news coming in from Bloomberg on Piramal Pharma. Carlyle's sell down in Piramal Pharma is cancelled. Will be very interesting to see how this impacts the stock. Right now it's lower by about 1.5%, but it's seen a smidge of an up move, because if Carlyle's sell down is cancelled, then that means that the immediate supply event is out, and as a result of which perhaps there could be some relief rally. But the reasons for which they're cancelled and what happens next is something that the street will track. For now, there's a smidge higher on that counter. But we do have with us the management of Minda Corp as well. Joining in from the company is their leadership right now. The stock is up around 4.5%. Strong performance coming in, the highest ever quarterly revenue that the company has reported. And then there was obviously that one-time gain that came by as well. So to discuss the performance and the strategy, we do have Ajay Agarwal, who is the Group CFO and President. Thanks a lot, Mr. Agarwal, for joining in. Good performance. You always maintain 50% over the industry growth in your company, along with margins of 11 to 12% in FY27. Just wanted to understand if you could give us a sense on after the first quarter's performance, how do you foresee all your other segments to do? Mechatronics, aftermarket, information and connected systems. At what rate do you expect these businesses to grow in the remaining 3 quarters?
Thank you for having us in your channel. Yes, we are truly delighted to see our quarter 1 performance back off what we delivered in financial year 25-26. Speaking about the rest of the quarters and the rest of the year ahead, we believe that there is a strong momentum being built across the platform and the product portfolio we have, whether it is information connected system, mechatronics, aftermarket, as well as the new product launch, which we have slated towards the end of this fiscal year. So we have no reason to believe that, we will outpost the industry average and, deliver a double-digit growth even this year.
Got that, Mr. Agarwal. Just very quickly wanted to understand in terms of, one of the margin headwinds has been the rise in commodity costs. How much of that did you already absorb in the first quarter? And as a result, your margin currently is at the lower end of your guided range, 11.5%. Will you be able to sustain this? Do you see further headwinds? How do you expect to close the year?
Well, we suffered a margin due to commodity inflation to the tune of 50 bips. And also, if you look at last whole of year, we delivered 11.6 average margin. Last quarter margin was about 11.7%. Given that most of the commodity we have pass on arrangement with most of our customers, so I don't see any challenge in terms of maintaining the margin on an absolute manner. However, we may not be able to earn margin on commodity inflation as such. It could be a challenge in terms of passing on the cost on a quarter-on-quarter basis. But we believe that during the whole fiscal year, we will be able to pass on the cost to the customer and we'll be able to recover those as well. So on account of commodity inflation, we don't believe that our margin in an absolute manner should suffer.
All right, so no suffering on the margins. Guidance remains in the 11 to 12% range as well. Your view on passenger vehicle share as well as electric vehicle share. Passenger vehicles obviously has increased to around 20% right now, 19-20%. How much higher can it go from here on? And what does that mean for your kit value, which is between 9,000 to 13,000 rupees? And electric vehicles, at a group level, it's about 14%. Where do you intend for that to go as well?
Speaking about passenger vehicle first, due to consolidation of Minda Vast, our group revenue from passenger vehicle moved from 15% to 19%. For a longer term basis, we have guided the market that by 2030, our intention is to take the passenger vehicle business from current 19% to 25%. And how it will happen? If you look at, we have cluster and instrument cluster business. We have wiring harness business, absolute focus on passenger vehicle market share to grow in wiring harness business. And last but not the least, the sunroof business, which we started from this fiscal year. And there are other several EV-related products we intend to launch along with our current portfolio. All in all, it will help us to take this revenue from current 19% to 25%. Speaking about the electric vehicle contribution, today you're right, at a group level, around 14% revenue, including flash, comes from electric vehicle. And the way we are seeing in the market, electric vehicle adoption is being taking place across India. We believe that we will play a significant role in penetrating EV market as well. Our intent is to take this share of business from electric vehicle from current 14% to about 20 to 25%. We have already announced joint venture with Turntide. It's a UK-based company where we will hold 49%. It will present a significant value in our business insofar as EV penetration is concerned. And we are also parallelly evaluating various other joint ventures and TLAs to ensure that the share of business from a EV contribution grows from current 14% to 20+%.
Okay, so 20% plus share from EV, about 25% from passenger vehicle to get you to that 17,500 crores revenue by FY30. Thank you very much, Mr. Ajay Agarwal, for joining us here. Pleasure having you. We'll move on and get you the latest from the F&O desk. Mangalam has those numbers for us. Mangalam, what are the F&O trends showing?
Well, the market's lower right now. So, there is a fair amount of trepidation in the overall sensibility. So we have actually not just the Nifty Bank, which is underperforming. The Nifty IT index too is had a bad week. It's down about 1.5% for this entire week. And typically these alternate. If the Nifty Bank outperforms, you have a decline in the Nifty IT, the market stays where it is. But right now we're seeing a 75-point downtick. Reliance isn't doing too well as well. The only solace is the support that is coming in from Bharti Airtel. Even in the broader markets, in absence of major cues and a lot of earnings related moves that we're seeing, we have far more number of stocks which are declining than the number of stocks which are advancing, and holding at around 1800 for the red stocks. Nifty is holding close to its 24,322 mark, which is the 20-day moving average. So it's very close to that. Closing above that would make bulls a lot more comfortable than closing below that. And even the Nifty Bank, while it is down 200 points, it's around that 20 and 200-day moving average range, 57,480 to 57,525. Towards the end, recovering and closing above that, again, would be a thumbs up from a bull's standpoint. But, the market's been in a bit of a range, and that's exactly what the option writers are positioned for as well. If you look at 24,400 call, it tells you that any move that we see in the market, there is likely to be a fair amount of, supply around the 24,500 mark. That's the 24,300 put. That was seen a lot of writing. Premium for around 61 rupees, telling you around 24,250 thereabouts. There would be some support coming in. But if you look at, the writers of the 24,350 call and the 24,350 put, those who have written this straddle, they are playing for a premium of almost 170 rupees on either side. Take 170 rupees on either side of 24,350. You have a range on the frontline index of close to 24,180 as support. And on the way up, you will have resistance, which will come by at around 24,520. So 24,180 to 24,520 on the Nifty, especially for the writers of the 24,350 straddle. Individual stocks, a lot of them on our radar. Fresh long seen at Jubilant Foodworks. The management fairly confident of growth recovering in the second quarter. And then we have Apollo Hospitals as well. Was slightly lower in yesterday's trading session. Those shorts are running for cover, now up around 3% on the back of positive management commentary as well. They're targeting margins to improve to about 25%. With that, we'll take a short break, come back, get you more on the markets, a lot more stock-specific action on the other side.
back. You're watching Trading Hour. The market's holding on at about 24,320 as we speak. But the stock in focus, and those are important flashes at the bottom of your screen, is Z Entertainment. A sharp spike coming in the Z Entertainment stock. And why is that? That's because SAT has allowed, SEBI to go ahead, Z Entertainment to go ahead with that warrant issue, that important matter. It has stayed the SEBI order against Z Entertainment, which means the promoters can now go ahead with that 3,000 odd crore rupee warrant issue that had been a bone of contention since that SEBI order had come in against the promoters, including Puneet Goenka. Remember, the board had approved this warrant issue to promoters. That was about 3,143.5 crore rupees. Of this, about 24.95 crores was fully convertible warrants on a preferential basis at 126 rupees per share. 25% paid upfront and 75% within 18 months. Now, of course, after that SEBI order had come, there was some concern whether, the promoters would be able to go ahead with the issue. But now SAT has stayed the SEBI order that had come in against Z Entertainment, which means they can proceed with the warrant issue. So that's an important update on the back of which the Z stock has spiked up in trade. Mangla.
Indeed, it's up around 6% right now. And earlier, the Z had asked SAT to let it sell its mutual fund investments to fund daily operations as well. And they've given that agreement as well. So which is why we've seen a big move on, Z right now. So they've got the nod from SAT to go ahead and sell their mutual fund investments to fund their daily operations as well. We do have HP Ranina who joins us on this. Mr. Ranina, now that the SAT has stayed the SEBI order, do you think the company can go ahead with a fundraise, or is there any legal recourse here as well? Is there any tribunal above the SAT which can perhaps, overrule this?
No, there's no tribunal over the SEBI appellate tribunal. You can only go to the Supreme Court. But I doubt whether they will go to the Supreme Court on a matter like this. But legally they can, if they want to. They can go to the Supreme Court. But then today is a Friday, and the courts will be closed tomorrow and day after, so it will be difficult. So I think they will go ahead. They will respect the SAT order. That's my view.
Mr. Reena, Sunbright is the proposed subscriber to this warrant issue, not Puneet Goenka, not Subhash Chandra. Does that strengthen the case, or you think we could expect some further updates, some further action in this case from SEBI if the warrant issue does proceed?
Yeah, but that is, they can, of course, as I said, appeal to the Supreme Court against the order of the appellate tribunal. But that will take time because you will first have to get a certified copy of the SAT order. And then after studying that, they will have to file an appeal, what is called a special leave petition, SLP, to the Supreme Court. Only then, that will take a couple of days, at least 3-4 days. Maybe in the middle of next week, they will be able to do that. If at all they decide, if at all SEBI decides to go in appeal, file an appeal to the Supreme Court. But if they don't, then this SAT order will go through.
And how does this then impact the fundraise that the shareholders have approved? Do you think that goes through as well, and Z can eventually go ahead with the fundraise?
Yes, it can. Certainly it can.
All right, take that point. Thank you. Yeah. Thank you for the short counsel that you've provided us with this development that's taken place. The street's taken note of this. The SAT staying the SEBI order against Z Entertainment promoters has the stock fairly excited, because now we understand that the fundraise can go through, and at the same time there could be there could be an allowance to go ahead and sell their mutual funds to fund daily operations as well. So all these factors weighing in positively, that stock has surged higher right now. We also have Sachidanand Uttekar who's joined in for a quick view on the market technicals. Sachi, the Nifty has been a bit of a range right now, but the sharp spike that we've seen on Z, do you think technically that calls for any sort of trade here? If you could give us a sense on individual stocks that you're tracking right now and a comment on Z.
Good afternoon, Mangalam. I think Z is in a consolidation phase, and if you look at the overall structure, there has been a significant development on the daily scale wherein a broadening formation has been established. Now, the base of that particular formation is at around 90, and this is the exact point where the prices have turned up. So we may see this particular move getting extended towards 125, 127 zone. So I think if someone is holding this counter, you can retain it and probably accumulate a few more shares with a stop loss at around 90 with a weekly closing basis stop loss. When we look at the Nifty, the Nifty has been gradually trending lower. Yesterday we saw it, closing below its 5-day exponential moving average. Now the immediate support that we are tracking on the lower side is the 50-day exponential moving average, which is placed at around 24,190 thereabout. So we may see this, gradual decline getting continued. We are not seeing any signs of momentum when it comes to Nifty Bank or Nifty itself. So that's why we believe that it is better to focus on stock-specific opportunities. On the higher side, Nifty has a threshold at around 24,420. The moment we see a confident closing above this particular level, then probably we may see a good revival in momentum. But so far, the indices are trending lower. We are seeing lethargic, movements, and that's why we are focused on, stock-specific opportunities. When we look at these two counters, Tata Power and Adani Ports, I think they are presenting good opportunities for fresh long positions. We have already seen good short covering data in both the counters. If you look at Tata Power, it has started trending above its 50-day exponential moving average. It is also challenging its 200-day exponential moving average right now. And the way we are looking at this entire setup, we are expecting a quick move towards 406 levels. Hence, we are recommending building fresh long positions in Tata Power. One can keep a stop loss at 384 on closing basis. A trading move can unfold towards 402, which may also extend towards 420. And the other stock where we are seeing a positive divergence after a prolonged downtrend is Adani Ports. Here, we are expecting a rebound towards its 50-day exponential moving average, which is placed at around 1740. One can create fresh long positions and keep a stop loss at 1665 on closing basis.
All right, Sachitanand, thanks very much for joining in with those views. Slip into a short break on that note, but when we return, we'll get you market views from Chintan Haria from ICICI Prudential AMC in just a bit.
Welcome back. You're watching us here on Trading Hour. Now, we've been hearing about the outperformance of the mid and small caps led by earnings, etc. But is there a divergent view? Well, we do have Chintan Haria in our studio right now speaking about his view on the market. Chintan, you're overweight large caps right now. What makes you, bullish, or rather, what makes you prefer large caps over small and mid caps, where the world has seen a bigger move there and serious underperformance in the large caps?
Yeah, I mean, if you look at within the world, India has underperformed, and within India, of course, the large caps have underperformed massively.
And on that, you're overweight, so it's painful.
Yeah. I mean, logic suggests that we should be overweight large caps. If you look at valuation-wise, we are at less than 10-year valuations in large cap. The flows have been strong in mid and small cap. There has been no major seller in mid and small cap as such. At least in large caps, you had FIs who were selling, who also in July have been buyers in India in general. We've seen tech outperform, and foreigners have been buying in tech in the last few weeks. And in general, if you look at large cap as a percentage of total market cap in India, I mean, it's surprise, but we are at probably our highest market cap at 490 lakh crores. But that doesn't seem to be the kind of flavor in terms of what returns people have made, purely because, one, a lot of new issues have come which adds to the market cap. But also large caps have underperformed massively. Today, the contribution of large caps in India is 57%. Which is at least the lowest that I have seen in my 21-year history in the markets. And that is to do a lot with the fact that large caps have been forgotten, as shown by the fact that for the first time in 3 years, we've seen outflows in large cap mutual funds. It's also a good indicator of being contrarian.
So it's a good indicator of being contrarian. You're looking at large caps right now, but what in large caps? And at the same time, while large caps as a proportion have underperformed, even the earnings of large caps have underperformed.
Correct.
Right? So one would say that mid caps earnings have outperformed, which is why those stocks are performing well.
Yes, so I think the tailwind of a big shakeout like what we saw in March, April, May, where the crude prices went up, leads to a significant kicker in terms of inventory gains across mid and small cap. And there also it's been narrow. It's not like all mid and small caps have done well. But that definitely helps them in terms of a one-time kick-out. Whether this sustains in the subsequent quarter is something which we need to see. But in large caps, you are right, the earnings growth has been tepid, which is where the valuations are also in our favor. So I think underperformance, undervaluation, and under ownership, three things which you look for in something which will do well in the next 2 years, you find that in large caps. So that should ideally be the space where you are. So within the world, India is standing out, and within India, large caps are standing out.
Take that point, Chintan. Hi, this is Ritu. You're overweight large caps, and that's standing out in the markets overall. But, earnings growth as well. Just look at the kind of numbers that these, companies have given. It's probably the best in 3 to 4 quarters that we've seen. Are we yet at that point where earnings start to drive, more moves in the market versus just what's happening globally? And, sectorally, within large caps or otherwise, what stands out for you?
Yes, you're right, Ritu. FY25 and FY26 were slow years in terms of earnings growth, and it was expected that FY27, FY28 will be better years from an earnings growth perspective at India level. And within that, of course, then there will be sectors which will outperform. We've seen very good performance from auto ancillaries, not just from India, also the global export market has been doing well for them. But apart from that, if you look at purely next 2 to 3 years, I think the segments such as consumer, technology, if we can, see the kind of outperformance technology has seen in the last 1 year. If market expectations are met or, slightly outperformed, then that's a segment which is also under-owned and quite cheap. And of course, the mega caps within the energy space, that's something which should also do well. So I think in mid and small caps, we've seen the benefit of one-time inventory gain or the demand being reasonable. Whether it continues going forward, let's see. But the good monsoon or a better monsoon is something which we should be happy about, and that should trigger a positive impact on the consumer side as well.
Chintan, the IT pack in particular, I mean, there's been that bigger debate around AI and the impact and, the valuation questions as well. Is that a theme you would like to play, say, over the medium term, say 3 to 5 years? What's your position there?
So I think it's something where it's the maximum divergence in views in terms of what may happen. But what we should remember is these are cash-rich companies where balance sheets are good. Now screen buybacks are allowed regulation-wise. And I'm sure if this AI capex, which has happened in a big way in the last 2 years, kind of mellows down, that should augur well for the IT companies. And based on whatever we've read, if there is a intermediation required for the implementation of AI across industries, our IT companies stand to gain in terms of their business uptick as well. So a little bit of a move on the revenue side, on the positive side, and you should see these get re-rate because they've been underperforming for the last 2 years very, very starkly.
Underperformance, under ownership, and undervaluation. That's the recipe. What makes you bullish? Is there something in the large caps that you don't like and you think it's run its course?
I think metals have kind of done very well in the last 2 years or so. We've seen significant outperformance globally in metals also on the back of AI. So the price of copper, aluminum have gone up. No doubt, mining them have become expensive. It's no longer as easy to mine them. But I think from a stock perspective or the underlying portfolio perspective, that's where you're seeing over ownership and also a little bit of outperformance. So that's where I would be probably a little bit suspect in terms of ownership. Apart from that, of course, in large caps, I think defense and some of the capital goods power stocks, which have done far too well, we need to be worried about that. So I think if you can strike a balance in the portfolio where you are now tilting incremental money towards the large caps which have underperformed, it should augur well in the next 2 to 3 years for you as a portfolio.
All right, and final question before we let you go. Since there are things in the large caps that you don't like, I'm sure there will be things in the mid caps and small caps that you would like as well. What would they be?
I think in mid and small cap, bottom-up stock picking always is going to help, and any industry. I mean, I was in Kanpur last week and one of the exporters, auto ancillary unlisted exporters, phenomenal job internationally. So I think chemicals, auto ancillaries, wherever there is a global exposure, they can definitely do well. Otherwise, it's mid and small cap, it's always stock pickers market. Yeah.
All right, take that point. Thank you so much for joining in. Arguments well made. What we'll do is we'll monitor the situation as it goes along and whether the FII flows come back or not. They've stabilized for now. Let's hope they continue to come back. With that, we'll take a short break, come back, read more on the markets on the other side. Well, there is some recovery for the market. The Nifty is above 24,330, curtailing its losses to just about 63 odd points. We have Adani and Bharti Airtel, Nestle India, all of them moving to the high point of trade. And we are seeing a smidge of a recovery in the IT pack as well. Wipro's actually raised its hand. It's recovered about 0.4% from the lows, currently in the green by about 0.6%. Let's see whether the other IT stocks follow or not. But it's time for the macro signal. Ritu, take it away.
Well, thanks very much, Manglam. Let's get you all the cues. The oil prices, starting with that, they're holding relatively steady today. If you look at them, they've stabilized after that sharp 2% drop that we saw in the previous session. They're finding a floor, and this, of course, follows those statements from the United States threatening to maintain an indefinite naval blockade on Iran. And that's revived some of the concerns on crude supplies. But the upside remains limited because, earlier in the week, we had both OPEC and the IEA cutting down their global oil demand forecast for 2026. Currently, you have the Brent holding at about 87.82 or 78 against the dollar, NYMEX at 81.96 a barrel. The rupee is holding steady on the back of all of this. It's trading in a very flat, narrow range today. There's been persistent dollar demand, yes, from maturing currency forwards and the foreign fund outflows. All of that is adding to the pressure, but there is near-term continuous dollar selling also that's happening from RBI, and that has capped the losses and limited the volatility to an extent. Look at the rupee today, currently at 95.41 against the greenback. Meanwhile, put up the 10-year, bond GSEC yields. They're trading with a positive bias today, holding steady at around 6.75, 6.76 or so. They're experiencing some downward momentum, and that's tracking the recent cooling in oil prices, of course, that we saw, and that drop in U.S. Treasury yields. So that's the macro setup today. But for the markets, Manglam, ahead of that Independence Day weekend, I guess the only independence the markets want is from all of this volatility.
Indeed. So let's pray for that, and let's hope for a range-bound move to move on one side or the other, and for some sort of stability in oil prices as well. With that, what we'll do is take your leave. Thank you so much for watching from Ritu, me, and the entire team that put this show together. Thank you for watching. We have the team of Halftime Report, which takes the market action forward.
Stocks slip further as worries of supply disruption resurface following strikes on vessels in Strait of Hormuz. Consumer durables eke out some gains, while metals, IT and cement are the big drags.
JLR's sharp drop in sales, the steepest among luxury automakers globally, hit Tata Motors Passenger Vehicle's Q1 show. Margins also came under pressure and could see continued impact in Q2, but JLR holds on to its full-year guidance.
LG Electronics posts a strong Q1 with double-digit growth despite price increases. The consumer goods leader is confident of surpassing its mid-teen revenue growth and early double-digit EBITDA margin guidance.
Tata Trust finds themselves in a fix as they need the Maharashtra Charitable Commissioner's nod to start the search for Tata Sons' new chairman. The trust are expected to seek a go-ahead, failing which appeal in the court is likely, sources tell CNBC TV 18.
In a significant relief for promoters of Zee Entertainment, the Securities Appellate Tribunal has stayed SEBI's order barring them from the capital market. The tribunal allows Zee to proceed with the preferential issue to promoters. The stock leaps.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra, with me Sonal Bhutra and Vinny Motiwala. Well, it is turning out to be a session where we are seeing profit booking turning for the Nifty as well as for the broader markets at this point in time. But on a week-to-date basis, we have the Nifty, which is down around 0.5%, but the mid-cap index, which is managing to hold up with a gain of around 0.5%. But overall, advanced decline ratio on the declining side, so 1,800 stocks advancing to around 2,200 stocks declining at this point. But we do have the WPI data, which has come in below that 10% that we had estimated in terms of the CNBC TV 18 poll. And there's a softness which has taken place on a month-on-month basis, but food inflation has upped its higher on a month-on-month basis. But we do have Lata joining in to break down the numbers for us. Lata, over to you.
No, this is a pleasant surprise that it's not just lower than our poll. Our poll was 10.1, and I think there were other polls in the market at 10. But everybody was at double digits, and the fact that it has come at 9.78, that's not a small undershoot. It's a good, over 20 basis, nearly 25 basis undershoot. Plus, it is lower than the month-on-month number that we got for June. So this is a bit of a consolation. Where WPI comes in important is that it works its way into consumer prices. If it stays high for very long, it gets passed on. The fact that it's come in slightly lower is a bit of a consolation. As Ekta pointed out, food inflation continues to remain higher. That was on expected lines. We saw it in the CPI as well, and it's bound to reflect because there are these El Nino advance fears. In anticipation, traders move up prices, and sugar has been running very high, and as all of you know, you'll have been covering it in the corporates in Balrampur Chini, and everywhere you're able to see that a rise in sugar prices. So food is definitely higher. The manufactured products inflation also is higher at 8.3 versus 7.48 in the previous month. So that is the spot of bother because it will percolate down into CPI if it persists long enough. Fuel inflation has gone down at the wholesale level, and that is a bit of a consolation. Some of the fuel products, because of the, this is wholesale, this is not regulated prices. So here you can see the immediate reflection. If there is a fall in crude prices from the 3 digits to whatever, for a few days we also had $80, you could see the impact in the wholesale price index. But overall, the index coming in lower than anticipated and lower than the June index is a matter of some satisfaction. Joining us is Aditi Nayyar, the chief economist at ICRA. Aditi, anything important to take away? Is it a big relief that it is lower than estimated and lower than June?
Absolutely, Lata. We had penciled in the WPI inflation ticking up to 10%. So this 20 whips undershoot as compared to our forecast is definitely a relief. We were looking at a number around 9.5% for August. We will need to look at the details to understand whether, it needs to be even lower than that in terms of the forecast. Hopefully, June is the peak and the numbers coming in subsequently will not cross back into double digits as what we were fearing. And of course, WPI index, the new base has turned out to be a bit different from what we had initially thought at the beginning of the year. And as we discussed last time, we are looking at an 8.5% kind of WPI average for FY27. And this is one of the key reasons that the nominal GDP growth is now expected to be as high as 13%.
There is also the output producer price index that they are announcing nowadays. The output producer price index is actually flat, if I'm not mistaken. It's 109 in July as it was in June, 109.9 actually. That's the index number. Of course, if you take the April-July producer price index, it is higher. It's at 109.6 compared to 100 a year ago. While April-July is higher, between July and June, the index has not risen. Does that also mean that the deflator will not be terribly impacted when the GDP is calculated?
See, Lata, I think, one thing, of course, is that for the current year, the WPI, either which way, is going to go up from under 1% to a very high number. So that will affect the overall nominal GDP, the way that it is calculated, and that is going to seep into the deflators. We will get the first GDP print with the OPPI this time when we look at the Q1 data. So we're going to try and understand how this is going to be different from the earlier sort of CPI and WPI weighted average kind of deflator that we used to have. So I think it'll probably take us a couple of quarters to really understand how we should start modeling the deflator now. One more point that, we're fine-tuning our GDP projection for Q1 and we'll be releasing it soon. One interesting thing this time around is that both indirect taxes have taken a hit, particularly the excise duty as was expected after the excise duty cut, but also subsidy payouts have been very high in Q1. So we may end up with a situation where the GVA growth is healthy, but the GDP growth ends up undershooting that because of the net indirect taxes.
Okay. No, I was bringing up the producer price index only because they may deflate the GDP with the producer price index. But as you say, we are all going to feel our way. It's a new index that's come instead of WPI. Some of the items could be deflated with the PPI rather than WPI. We are just moving to the international standard.
Okay.
International standards are PPI, like the US announced theirs yesterday.
Right.
So we're just moving towards that. And it is a new index, so people have to get used to deflating with the new index. Maybe the MOSPI will wait for a quarter, but if I remember what Dr. Saurabh Garg said last time when we interviewed him, he said that they will try on August 29th, August 31st, when the first GDP data comes for April, May, June. They will deflate it with the PPI where available rather than with WPI. So we have to keep a close watch. The input producer price index for July has actually fallen compared to June. It's 105.9 compared to 107. Likewise, the output producer price index has remained flat. But for April, July, the output producer price index is higher by about 9.3, as much as the WPI. It's about the same. There's no difference. So maybe, the guesses of the inflation will not be wrong because it doesn't look very different if you took the April-July number. So let's wait and see. Thank you very much, Aditi, for joining us. We are all swimming in slightly uncharted territory and it'll take a while. But the important point is the wholesale price inflation is not running away. It has actually peaked off, at least from June to July.
So positive surprise in July's WPI data. Thank you so much, Lata, for explaining that to us, and Aditi as well for joining us with your insights on this number. We'll do one thing. We'll actually slip into a short break. When we come back, we'll talk more about markets, get some stock-specific action as well. So stay tuned for that. Welcome back. You're still tuned in to Halftime Report. Continues to be a down day for the markets, but a lot of moving parts. We are towards the fag end of the earnings season. I think almost done with that now. But yes, some attempt to recovery on the Nifty and in the broader markets. We do have Zee Entertainment, which is in focus. The Securities Appellate Tribunal has stayed SEBI's order barring them from the capital markets. Devyani joins in with more details. A sharp uptick in the stock. It's up around 7%. Devyani, take it away.
Well, big relief for Zee Entertainment shareholders. SAT has stayed the SEBI order against the company and its promoters, and the company can now go ahead with the preferential warrant issue to its promoters. But this is subject to the deposit of penalty as per the SEBI order, as well as it also allows Zee Entertainment to access mutual fund units for dividend distribution as well as the day-to-day activities of the company. Now, this is regarding the shareholder approval of 3,144 crore preferential warrant issue to its promoter group entity, Sunbright Mauritius, and is expected to raise the promoter holding from the current levels of 4% to 24%. Now, the said SEBI order barred Zee Entertainment from accessing the securities markets for a period of 2 months and restrained its promoters, Puneet Goenka and Subhash Chandra, for a period of 12 months directly or indirectly. Now, this was following findings that the promoters had used the company-owned property to borrow over 700 crores worth of loans without the appropriate approvals and the required disclosures as per the law. But Advocate H.P. Ranina has told CNBC TV 18 that SEBI can take the matter to the Supreme Court, but that's unlikely with the SEBI expected to respect the order passed by the SAT. Now, the company is now likely to go ahead with the warrant issue and get a cash infusion of upwards of 3,000 crores over the next 18 months to fund growth going forward.
Thanks so much for that, Devyani. But let's go across to Vivek now, who's going to tell us which are the stocks that are moving around in the trading session and the news behind that as well. Vivek, good afternoon.
Well, good afternoon. A day largely dominated by sharp moves that you're seeing, either from news breaks or from companies that are reporting their results towards the fag end of the earnings season. First on the list, of course, has to be Galaxy Surfactants, a guidance upgrade coming in on the top line, a 350 basis points margin expansion, stock perched at the upper circuit limit. Praj Industries, after a while, you've actually seen an earnings beat coming from this particular ethanol company, up by almost 5% on good volumes. LG Electronics clearly stands out, especially in terms of the consumer durables pack. It actually managed to beat street estimates marginally, and also the company says they're confident of beating the FY27 revenue target high by 8%. Minda Corporation keeping in the trend with quite a few auto ancillary companies actually beating street expectations. This company too has beat estimates on top line as well as margins, high by 3%. And Zee Entertainment, you just saw the news, on the bottom of your screen, some relief coming about, stock high by 7%. On the other hand, quite a few drags as well. Nalco, clearly the top F&O laggard. The Brazilian company Alunorte has gone ahead and ramped up its alumina production once again, down 5%, down almost 10% in the last couple of trading sessions. Fino Payments Bank, a weak Q1 coming up for this particular company, a loss on the bottom line, down by 7%. Tata Motors Passenger Vehicles, again over here, even the growth was quite good, margins were dampened quite significantly, and on the back of that, you're seeing almost a 5% downtick across this particular Tata company. Supriya Life Sciences, from the pharma pack or healthcare pack, again, very sharp erosion as far as EBITDA margins are concerned, down at one point of time was down 8%, has recovered quite sharply from the intraday lows. And Leap India, one of the recent listings or today's listing that's seen quite a bit of a muted response, stock down 5%.
Okay, all right, Vivek, thanks very much for that. So those are all of the stocks which are in focus in our Buzzing Stock segment. But we're not done yet to tell you about all of the stocks which you should keep on your radar. This is time for our Movers and Shakers segment, where we track a whole host of stocks which are buzzing in trade. Vinny, Praj Industries, the stock is up around 5% but it's still quite far away from its 52-week high. Earnings look good. What are the prospects?
So earnings surely look better than what some of the estimates came in from the street as well, right? We saw revenue was in line, profit and margin, that's where the beat came in. And this is versus the BBG estimates. Now, let's look at what actually led to this improvement. Other income, that's seen a sharp rise. It's come in at 20 odd crores, which is up 131%. Main reason for this was there was some insurance claim that came in this time for the losses that occurred in one of the fire incidents that had occurred in its holding company's plant over there. So because of that, there was this income that has seen an increase. Now, what has done well overall? Revenue is 11% growth. Margins have come in at 4.2% versus 4.8%. Slight bit of a contraction in terms of margins. Overall, segments which are doing well for the company: bioenergy, high purity segment, that's seen a very strong growth. On the flip side, you have the engineering segment, which has seen a decline in terms of revenue of 14%. So that's a bit muted. Apart from that, we're seeing that order inflows are stable at around 1,000 crores. Backlog has increased as well. So seems like a stable quarter, a decent quarter that's coming from the company. And that is why the stock is buzzing in trade and managing to hold on to gains of 5% even as of now in the trading session.
Okay, all right. That is about Praj Industries. Thank you, Vinny, for that. But Nalco also is in focus. Alunorte has, in fact, gone ahead and ramped up alumina production. Nigel is joining us with more details on that one. Nigel.
Well, that's right. You have a Norwegian company which is known as Nox Hydro. They have a facility in Alunorte, which is in Brazil. And just a few days ago, they said that at this Alunorte facility, they will be cutting back or they will be pulling down on their alumina production because of non-availability of gas. However, overnight what they said is that they've resolved some of this issue with the local authorities out there, and they're going to be getting fresh resumption in terms of gas. So Nox Hydro's alumina unit in Alunorte, that has gradually started resuming production. And because of that, they say that the total loss of production is only 1 lakh to around 1,20,000. Remember, the street, in fact, was wondering whether or not this is going to be prolonged. And if that was the case, it would create a bit of a shortage in the alumina market, which currently is in a surplus. So the short point being that alumina shortage, it lasted just a few days. And now again, that facility is ramping up, which is explaining why Nalco was down. Because in case the shutdown was for longer than expected, then what would happen would be that alumina prices would scale up, and in turn, Nalco sells alumina. So explains why Nalco, after seeing a big run a couple of sessions ago, has given up all of those gains. Back to you guys.
Okay, all right. Thank you so much for joining us with all those important analysis, Nigel. Let's talk about Galaxy Surfactants. Earlier today, the MD of Galaxy Surfactants told CNBC TV 18 that the company expects FY27 volume growth of 6 to 8% and a strong finish to the year as well. He also raised the EBITDA per ton guidance to 24,000 to 25,000 versus around 19,000 rupees per ton earlier. Take a look.
With regard to guidance, I would look at a 6 to 8% volume growth guidance for the full year, and the EBITDA per metric ton, we're increasing the guidance for this year to 24,000 to 25,000 per metric ton for the full year.
All right, well, that is Galaxy Surfactants. We need to take a short break on that note with the news that we have the mid-cap index, which is down around 0.4%. But if you just glance at the Nifty, we have Bharti Airtel, which is your top gainer on the Nifty, up around 3%, and Apollo Hospitals, which is doing quite well post the conference call that took place at 3 p.m. last afternoon. So the market is reacting to maybe some amount of positive commentary coming in from Apollo Hospitals in terms of guidance. So that stock up around 3% at this point in time as well. We'll take a short break, but Dharmesh Shah of ICICI Securities will join in with some of his trading calls on the other side. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. As of now, Nifty is moved up to 24,350 levels. But what's happening in the world of F&O? We have Mangalam to take us through those details. Mangalam, hi, afternoon. And today, Nifty seems to be in this bit of a range, right? 24,300, 24,350. What are the F&O cues now?
Well, the Nifty has been in a bit of a range for the last couple of weeks itself. 24,250 to about 24,550 has been the broad contours of those that range itself. And the good part, however, is that the Nifty Bank and both the Nifty are now moving off lows. And the biggest reason for that is that, from a technical standpoint, there is a 20-day moving average. So staying above the 24,322 mark, extremely crucial for the Nifty, and that's something that we're witnessing right now. The important part is that the Nifty Bank as well is a little above the, it's pretty much in the range of 20 and 200-day moving average. So that's an index that I'll be tracking. The IT index, which had been dragging the frontline index along with the Nifty Bank, that too has recovered a little bit from the lows, and Bharti Airtel is a top contributor on the way up. However, the thesis of the market being in a bit of a range continues with both the 24,350 and the 24,350 call and put, basically the straddle, both being equally active. So 24,350 call has a premium of almost 100 rupees, and the 24,350 put, which is up for you on the screen as well, has a premium of almost 70 rupees. Add both of them together, you get about 150, 160 odd rupees. So those who are writing this straddle X of brokerage, etc., are playing for a 150-point range on either side of 24,350. Plug those numbers and you get a range of 24,200 at the lower level to 24,500 at the upper level. And that's exactly what the street believes is likely to play out in absence of major cues starting next week, now that the earnings season is done as well. The only move on the Nifty on either side will now be dictated by geopolitical events and at the same time crude oil prices, which have been moderating from highs but still holding at elevated levels of around $87, $88 per barrel.
Okay, all right. We'll take that breather from earnings season any day. Mangalam, thanks very much for that. So yes, next week onwards, we won't have as much news in terms of earnings, but nonetheless, a lot more to watch out for in terms of geopolitics and what's happening globally. But Dharmesh Shah of ICICI Securities joins in on the show to discuss what he's strategizing today. Dharmesh, end of the week, we're still maintaining that level of around 24,350 odd. But we're off those highs that we saw of around 24,400 plus. What's your sense in terms of how you would approach the second half of the trading session and maybe a range going into next week as well?
Good afternoon. Absolutely. If you look at the Nifty, I think so for last 6 to 7 trading sessions, we remain to be more into the corrective phase in this range of 24,200 to 24,600. Going forward, what we believe, I think so the 1,100 points rally which we have witnessed in last 2 weeks looks to be more of a retracement of that rally, where 24,000 remains to be the very strong support for the next week. I believe the long-term rising trend line joining the lows of April and May and June looks to be the value for the same is placed at around 24,000. So 24,000 is something that key level to be watch out for the next week, where we expect to hold on this current corrective phase. And even if you look at the Nifty trading range, it seems to be getting more for contracting. And whenever we witness such type of contracting, the expectation for the next week likely to be see a major moves on either side. The way the stock seems to be forming a way, the Nifty seems to be forming a base in this range of 24,000 to 24,500. Looks to be, I think so, we should see a breakout on the higher side. We're expecting, I think so, Nifty to head towards 24,900 in the coming months. So yes, it's something a buy on dips should be the strategy, but 23,900 to 24,000 should be a strong support for the Nifty.
About individual names, Dharmesh, you can quickly tell us there is an attempt to recovery from the lows of the day as well.
For the day, I think so, it looks to be, I think so, 24,300 looks to be the very strong support for the Nifty, which we expect to hold. And eventually, I think so, for the intraday purposes, I think so, we should be closing near 23,400 to 24,420 should be the level we are looking on the closing.
Okay. Okay, all right. What about individual names, Dharmesh?
As far as names are concerned, stocks recommendations are concerned, Sonal, we remain to be constructive positive for the auto space as a whole. Where inside the auto space, again, Bosch Limited remains to be our top pick. However, for Bosch particularly to talk on from the technical perspective, if you look at the chart from the weekly as from the monthly perspective, stock has witnessed 11 months of long consolidation breakout with strong sets of numbers. Looks to be, I think so, Bosch. The breakout seems to be joining the last 2 years of upward rising channel, indicating, I think, so strong momentum to continue going forward. Where Bosch looked for a target of around 51,000, keeping a stop loss of 42,740. So Bosch is something one which we like inside the auto space. Apart from Bosch, again, PSU sector as a whole looks positive, where PSU banks particularly really relatively outperforming this current corrective phase, where again Union Bank of India, if you look from the weekly as well as from the monthly perspective, the stock seems to be witnessing a falling trend line breakout, indicating the end of the corrective phase, supported by strong sets of volume. So for Union Bank of India, we expect the stock to head towards 200, keeping a stop loss of 179. So Bosch Limited and Union Bank remains to be a top pick at the point.
Okay, Dharmesh, I think we've snapped the line also, but Bosch as well as Union Bank are the two picks that are coming in from Dharmesh as well. So Dharmesh, thank you so much for joining us on the show and giving us those ideas as well as the levels in terms of the market. On that note, we're going to slip into a very short break. After the break, we'll have Manisha Gupta, who's going to be in conversation with Atul Chaturvedi of Sri Renuka Sugars as global sugar prices surge. Stay tuned in.
Welcome back, and joining us on the show now is Mr. Atul Chaturvedi. He's Executive Chairman at Sri Renuka Sugars. Mr. Chaturvedi, hi, thank you so much for joining in. First of all, your sense on the sugar prices, which we have seen run to a one-year highs when it comes to the raw sugar prices. The whites are trading at a 15-month highs. The Indian sugar prices in the matter of last 1 month also have gained up on a higher single-digit percentage. How are you looking at, first of all, this run-up in prices that we are seeing across the globe?
Frankly speaking, I don't understand why sugar prices should remain laggard. With everything, all commodities across the world moving northwards, and there was no reason why sugar should remain downtrodden. In fact, internationally, what has happened is the funds who had shorted the sugar market big time by almost something like 150,000 lots, they have started buying back their shorts. And according to some unconfirmed report, they are close to practically zero and planning to double up or rather increase their longs. So that is one effect which is having its effect on the sugar values worldwide. Secondly, El Nino seems to be having its effect as far as Europe is concerned, because Europe is reeling under tremendous drought-like situation. So we are expecting that the sugar production in Europe might drop by about 2.5 million tons. Even Thailand seems to be looking at the barrel, and they might also be down by about 2 million tons. So, and India doesn't seem to be having a fantastic crop expectation. So all that puts the world sugar values on the upside. And in fact, now we are looking at a deficit of about anywhere between 2 to 2.5 million tons on the world. As far as India is concerned, so the writing was already on the wall as far as Indian sugar values are concerned, because our stock levels were coming down. And obviously, with exports happening and a lower crop, so all that effect is now getting reflected in the lower values. So my take is that next month or so,
absolutely,
we should remain elevated as far as Indian values are concerned. Yep.
Absolutely. As you said, whether it's about Europe, UK, Thailand, India, we're looking at lower crops. But Ms. Chaturvedi, how are you also looking at Brazil? Because more and more cane seems to be going in for ethanol. And then Brazil also has increased the mandate of blending. Would you see that as a very, very bullish segment as well?
I don't see that as a bullish segment, because in Brazil now, a lot of ethanol is getting made from corn. In fact, sugar is losing out to corn as far as ethanol mandate is concerned. But having said that, we are penning a crop of about 40 million tons in Brazil, but they're having rains, which is affecting the crushing operations. So that is also having a bearing. And as far as the white sugar is concerned, the Middle Eastern problems and the Middle Eastern refineries not running full blast, and that is also having an effect on the whites. So white sugar is also moving on that account. So overall, internationally, also sugar is moving upwards. Yeah.
It is. Ms. Chaturvedi, when you talk about Indian markets then, and it's soon going to be festival season, and the sugar demand does increase at this point. So a couple of questions here. One, are you looking at an additional quota coming in from the government during this festival season? And two, there has been a lot of conversation on how some of the sugar mills perhaps will prepone their crushing, maybe by from third week of October onwards. How are you reading into both of these things?
I have a slightly different take on this. October, I don't see, if you look at the Indian consumption story, about 65% of sugar consumption on a monthly basis or on an annualized basis is by the institutions. And institutions, I'm sure, work with about a month's quota with them. So October, they might actually reduce their purchases, which might have somewhat of a salutary effect on the prices. And as far as early crushing is concerned, I'm not too gung-ho about that, because in any case, UP crushes a little later. It's Karnataka and Maharashtra which could have gone in for early, but the biggest problem would be getting labor. Labor doesn't come before Diwali, and Diwali this time around is on the 1st, or I think 7th or 8th of November. And the other thing is, who is going to bell the cat in terms of the losses as far as recoveries are concerned? So my take is some stray mills might start, but I don't see big sugar crushing taking place as far as October is concerned. But having said all this, I don't see any reason why, if you even look at the crop of the carry out of about 3.5 million tons, Our consumption cannot be more than 2.4 or 2.5 million tons at the max. So where is the problem? I think in November onwards, you will have a normal supply. Yeah. There's only sentiments which are driving the market.
Thank you, Mr. Chaturvedi. I get that. But I take your point well as well that, as you said, that the sugar prices are expected to stay elevated going forward from here. And since everything else has been rising, why not sugar? I get your point on that. Thank you so much, Mr. Chaturvedi, for joining in. And thank you for weighing in. And, of course, on global sugar and the Indian sugar fundamentals as well. With that, we'll go for a break. When we come back, we'll talk about the crypto corner. We'll be joined by Kevin from Borderless.
CNBC TV 18 presents Crypto Corner, powered by Binance.
You're still tuned in Halftime Report. Well, of course, we'll talk about the crypto corner and the conversation there in just a bit. But before we do that, we have to take a look at what the markets are doing. There was an attempt to recovery, and that got sold into. The Nifty, as we speak, is down 60 points right now. The mid-caps are falling further, 0.3% lower on that one. And the Bank Nifty is falling in line with the mid-caps as well. Let's do one thing. Let's go across to our colleague, Manisha Gupta. She's joining us with her conversation on the crypto space. Manisha, over to you.
Well, thank you so much for that. And joining me is a special guest. Kevin Latinity is co-founder and CEO at Borderless. Kevin, hi. Thank you so much for joining in us on Crypto Corner. Well, you have had a pilot with Masterclass where you're using Masterclass's crypto credentials to cross-border payment. You deal with nearly 100 countries therein. Would you say that this is a pure case of trust and credibility and regulations that Masterclass has, and of course you using the crypto, or rather the stable coins, in maneuvering that?
You know, really what we do well at Borderless is we provide the connectivity layer that connects all of these stablecoin enabled PSPs together for rails and liquidity. And we're great at the technical infrastructure, we're great at the operations infrastructure, but we're not necessarily great at creating compliance frameworks and governance that can scale globally. So what MasterCard has done through this pilot with Borderless is they've said their core business is creating governance and trust that scales globally, right? Whether it's products like MasterCard Move or the card networks. So they're bringing that into the stablecoin world in this pilot with us. So instead of having to go and KYB or KYC with a dozen different locally regulated entities for payments companies or financial institutions or fintechs that want to move funds into 60 different countries, now they can go and they can get their compliance program reviewed by MasterCard. And as long as that compliance program meets the governance standards, then they can be part of this crypto credential ecosystem that's connected into Borderless. And through that ecosystem, they can transact with any of the locally regulated counterparties that are also part of that same governance standard. So outside of the stablecoin world, right, imagine a world in which the banks had to KYB with every other bank they ever wanted to send money to. That doesn't work, right? Reliance is how we do compliance at scale in financial systems. And with the MasterCard pilot, we can finally bring that to stablecoins.
Kevin, we get what you're saying, that Masterclass does bring in the traditional card franchisee governance into the stablecoins right now. How are you looking at this hybrid approach, really, where you have Mastercard bringing in a traditional way of doing business while you bring in the stablecoins here? How is that working in compliance? As you said, you're working with 60 countries with this one right now.
So the compliance aspect is actually incredibly similar. If we step back from the stablecoin layer for a minute, ultimately, what MasterCard's core business is, I would argue, and granted, I don't work at MasterCard, I would argue it's not cards. I would argue that it's franchise rules, right? And yes, we have decentralized assets in the sense of stablecoins, but we still have centralized market participants. And what I mean by that is the on and off ramp in the US, right, is often licensed by the OCC, or at least has money transmission licenses. The on and off ramp in Brazil is licensed by the Brazil regulatory regime. The on and off ramps in India are licensed by the Indian regulatory regime, et cetera, et cetera. So while the settlement asset itself is decentralized, something like USDC, USDT, OUSD that you could theoretically take into unhosted wallets and things like that, when you're at the perimeter of stablecoins and the local banking rails, that on-ramping and off-ramping activity, that's not decentralized, right? That's done by centralized, locally regulated players. And those are the perfect types of companies that you can bring franchise rules to.
Kevin, would you say it's not about basic token moving? What the consumers perhaps right now are demanding is a more sophisticated, automated Forex routing right now. Is that what you're working on?
I think when we look at what our customers are doing, they're starting from very, very simple pilots, right? And we sell primarily into enterprise scale PSPs, corporates, fintechs, and then banks a little bit now. And what we've seen is a lot of this started with exploration, and a lot of this started with pilots. And the pilots all came with tremendous skepticism, right? I've been moving money around the world using correspondent banking or using fintech infrastructure, right? Think of like the AirWallexes of the world for a very, very long time. Are stablecoins and is blockchain technology actually going to accomplish anything for me? Or is this just another fad that's going to die off like so many others? And what we're seeing now around expectations is that people are getting actual money movement. And it all depends on the corridors, right? A lot of what we spend our time on is, does this corridor actually make sense for stablecoins? Let's take something like EU-US, makes absolutely no sense. Most traded FX pair in the world. SWIFT settles T0 in most of those corridors. There's really not much value proposition. But when you get into emerging markets and when you get into exotics, that's where we look at what is the cost of pre-funding these balances and what is the cost from an FX perspective of being in a volatile currency or forward hedging that currency away. And that's where we start to see that, wait a minute, if I have a way where I can move value 24/7 in near real time, now all of a sudden, instead of a week's worth of float that I need to hold in this country in order to pre-fund my transactions, now all of a sudden that cuts down to a day or even to a few hours. And that's where we're seeing the cost savings from corporates. And ultimately, what they care about is reliability, security, and compliance, more so than anything else. And that's part of why this pilot is such a big deal for the stablecoin world, because reliability is really solved at the local layer. Security is solved in part by companies like Borderless, but also by the wallet providers and that part of the industry. And now compliance and trust, to have a player the size of MasterCard step into it is really an incredible milestone.
A final question then, Kevin, and when you look at the remittances market, perhaps India is the largest one in the world. But when you look about moving monies in India, it is about digital banking rails. It also is about very strong forex or currency controls herein. How are you approaching India as you work with so many countries outside?
So India is, I think, one of the most challenging markets from a remittance perspective to use stablecoins. What we've seen is in a lot of other markets, and granted, the world is 195 local markets, so it's hard to make sweeping generalizations. But what we've seen in general is in most markets, stablecoins are treated as a currency on a blockchain. And many places are starting to regulate stablecoins differently from cryptocurrency and other digital assets like Bitcoin, Ethereum, etc. The challenge with blockchain-related or stablecoin-related remittances into India is that India still applies the 1% tax on the sale of digital assets. So if we look at India as one of the largest kind of payouts markets of remittances that are coming from, the US, Europe, and other parts of the world, let's be honest, the Indian diaspora is probably the largest in the world from a consumer remittance standpoint, right? But this 1% tax that's government mandated makes it really, really expensive to use stablecoins to send money home. When we look at the Indian market in particular, I think, one, there's probably a need for regulatory change that needs to happen sooner rather than later, as India is regulatorily falling behind other markets when it comes to the innovation that is stablecoins and adopting more blockchain technology. But secondly, the way that the corridor effectively happens today is that you have to liquidate all the stablecoins offshore. If you want to charge an extra 100 basis points or 1% transaction fee on a remittance, that's 1% or 100 basis points that should be going into the bank account of the recipient, not that should be being charged as a tax. So what ends up happening is the stablecoins are liquidated offshore, and the funds into the INR into India is transmitted in traditional PSP and banking rails. So there's a huge opportunity in India to really embrace stablecoins, but it's been really held back by the regulation.
Okay, point taken there, Kevin. And thank you so much, for joining us on the show. And Manisha, thank you so much for taking us through the conversation as well. Thanks to both of you all. But on that note, we're going to slip into a very short break. We'll come back after the break and talk more in terms of stocks, more in terms of markets as well. Stay tuned in.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Well, a little bit of an intraday recovery, you'd have to say, for the markets, but just about subdued with the Nifty at around 24,350. Just watch out for a couple of these stocks within the broader space, though. LG Electronics, it's the strongest quarterly revenue growth that they've shown since listing. So that stock is up around 8.5%. Vodafone Idea is up for the 6th straight day. Remember, it's gained around 10.5% on a week-to-date basis. And we also have Nefrocare. That stock is doing well in today's trading session. In fact, it's gained 49% this year. Revenue growth was strong. Over 20% came out earlier this week. Well, on that note, we need to wrap up on this show. And thanks very much for watching Business Lunch. We'll take all of the action forward.
Stocks slip further as worries of supply disruptions resurface following strikes on vessels in Hormuz. Consumer durables eke out gains while metals, IT and cement are the big drags. JLR sharp drop in sales, the steepest among luxury automakers globally, hit Tata Motors Passenger Vehicle's Q1 show. Margins also come under pressure and could see continued impact in Q2, but JLR holds on to its full-year guidance. LG Electronics posts a strong Q1 with double-digit growth despite price increases. The consumer goods leader is confident of surpassing its mid-teens revenue growth and early double-digit EBITDA margin guidance. Tata Trust finds themselves in a fix as they need the Maharashtra Charitable Commissioner's nod to start the search process for Tata Sons' new chair. The trusts are expected to seek a go-ahead, failing which an appeal in court is likely, sources tell CNBC TV 18. In a significant relief for promoters of Zee Entertainment, the Securities Appellate Tribunal has stayed SEBI's order barring them from the capital market. The tribunal allows Zee to proceed with the preferential issue to promoters. The stock leaps. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan. Hi guys, good afternoon. The markets are in the red today, seeing some losses there. The Sensex and the Nifty about 0.3% lower. The mid-cap index and the Nifty Bank also falling in line with the blue chips. Both of those indices also 0.3% in the red. So what's pulling the Nifty lower? We've got that metal pack. It's a top sectoral loser today. If we can bring that up for you, it's about 0.7% in the red. We're seeing Nalco with cuts of over 5%. We're seeing Hinzing falling over 3% and Hindustan Copper over 3% in the red. The other pack that's not doing well is the oil and gas pack. That's about 0.6% lower. Also under pressure for a second straight day. Hind Petro seeing cuts of over 5%. Oil India over 2% lower, and ONGC over 1.5% in the red. But what's on the higher side? That's the media pack, about 1% in the green. We've got Zee Entertainment that's soaring 5% after the relief that they got, almost 6% in the green. And that's what's helping the media pack stay in the green. We've got Nazara Tech and DB Corp also gaining 0.5%. The other index that's also doing well is consumer durables. We've got Voltas. That index is 1% higher in trade. We've got Voltas that's up nearly 3%, Havells 2.5% higher, and Bata India about 4% in the green. So that's how the markets are shaping up this afternoon. A whole host of other stocks are also buzzing in trade on the back of their first quarter number and some news flow. Ananya joins us now with all of those updates. Ananya?
Well, yes, it's a very stock-specific session today, starting with Zee Entertainment, which is in green after SAT stayed SEBI's order allowing the 3,144 crore promoter warrant issue to proceed. Now, this could raise promoter holding from around 4% to 24% here. Now, coming to Tata Motors PV, they are under pressure after a mixed Q1. Consolidated revenue rose 9%, but here EBITDA fell 20%. And margins dropped to 6.5% here. Now, more importantly, the JLR volumes fell 9% year on year and 17% quarter on quarter basis, while higher raw material cost and forex losses added to the pressure here. Now, Wellspun Living, they are reacting, they are rallying. Revenue up 24%, EBITDA up 42%, and profit up 84% with FY27 guidance maintained here. Now, Nalco is weak as the hydroalumina refinery in Brazil ramps production back up, easing global supply concerns and putting alumina prices under pressure here. Now, LG Electronics India, they are surging after strong growth and margin expansion. Now, management here is also confident of surpassing its FY27 targets of mid-teen revenue growth and early double-digit EBITDA margins. Now, Sammaan Capital, they are under pressure with a PPOP down 91% year on year, while Fino Payments Bank, they slipped into a loss with a sharp collapse in digital payments revenue. And finally, Honasa Consumer is positive, revenue up 27%, profit up 119% with strong 31% volume-led growth here. So these are the stocks buzzing in trade today.
Ananya there with all of the stocks that are on the move today in the trading session. Thank you so much for those details, Ananya. Galaxy Surfactants hits 20% upper circuit after the management raised its FY27 guidance. Speaking to CNBC TV 18, the managing director of the company, K. Natarajan, said that the company expects FY27 volume growth of 6 to 8% and a strong finish to the year. He also raised EBITDA per ton guidance to 24,000 to 25,000 rupees. Take a look.
With regard to guidance, I would look at a 6 to 8% volume growth guidance for the full year, and the EBITDA per metric ton, we're increasing the guidance for this year to 24,000 to 25,000 per metric ton for the full year.
Nifty earnings to grow 15% in FY27. That's the word coming in from Motilal Oswal's Gautam Dugard. He also says that the market has seen its best quarter in the last 3 years with 20% growth.
In terms of quality, in terms of quantity of earnings, in terms of the breadth, whichever way you look at it, I have not seen a 20% plus earnings growth for last 12 quarters now. More importantly, the top line growth is at a 3-year high now. So inflation has made a comeback, which is now representing in top line across sectors. 3 years, we are seeing a turnaround in small cap earnings. We were expecting a 30% growth for full year, and the first quarter has given us that confidence that the full year can be met. The first quarter small cap earnings, and we cover a very vast numbers. You know, we have 180 small cap companies under our coverage. They have delivered 32% earnings growth. So we are expecting to end the year on small cap with 30%, mid cap with 22% now, and large cap with 15%. Nifty will see 15% growth after 3 years. The only missing link, as we all know, in the last 2.5 years has been the flows. The FII selling has been massive. We are all aware about the numbers. In fact, on a decadal basis, they have become neutral now. In the last 10 years, cumulative flows of FII is zero now. They've bought $69 billion in primary market, and they've sold exactly $69 billion in secondary market. Where are we positive? If you look at financials, we are more positive on the non-bank side, both lending, non-lending, capital market, which is a big overweight in our model portfolio. If you look at consumption, one good thing we did 2 years back was made FMCG zero. We converted all our 15% weight on consumption into discretionary, right? Industrials also, if you look at it, what is done well? It's not the benchmark stocks which are bellwethers in that segment. It's the power-oriented names, it's transmission, defense, likes of Dixon. They are the ones which are there in our model portfolio. If you look at tech, we've been consciously away from the traditional legacy large cap tech. We are more towards the new age technology. In fact, our coverage also has ramped up significantly out there, and we expect to have a far broader coverage in that domain.
On that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Sources tell CNBC TV 18 that Tata Trusts is exploring legal options to ensure the succession process can proceed. Rachna Dhanrajani is here with all of those details. Rachna, what are you picking up?
Tata Trusts are now exploring their legal options, and that could mean going to the Bombay High Court. That is what our sources are telling us this morning. Now, yesterday, the trustees of the Sir Dorabji Tata Trust met and adopted the resolution on N. Chandra not seeking reappointment. The trust also had to appoint a joint nominee for the upcoming AGM. And that could not happen because Sir Ratan Tata Trust, the trust with which it has to appoint the nominee jointly, cannot participate in meetings owing to the Charity Commissioner's freeze. And since there is no update on that front, the restraint order of the 15th of May continues to apply, which is why the next option is the High Court, the appellate authority on Charity Commissioner's orders. Now, we've gone through Tata Sons Articles of Association, and they tell you exactly how tight this is, because until yesterday, this was about one nominee being jointly appointed. From today, it's about 4. Article 86 is the first one. Quorum at a general meeting needs at least 5 members personally present, and that must include one authorized representative jointly nominated by Sir Ratan Tata Trust and Sir Dorabji Tata Trust. But now look at Article 118, which governs succession at Tata Sons. The moment a chairman has to be chosen, a 5-member selection committee has to be constituted, and 3 of those 5 are nominated jointly by the same 2 trusts. The chair of that nominee also, the committee also comes from those 3. So 1 joint nomination for the AGM, 3 more for the selection committee. Sir Ratan Tata Trust cannot take a board decision right now. So in all likeliness, the AGM is also expected to be adjourned if no legal relief comes for the Tata Trust.
All right, Rachna, many thanks for those details. And moving on, the Ministry of Heavy Industries has received 20 bids under the scheme to manufacture rare earth magnets. Shivani is here with all of those details. Shivani?
Well, yes, the government has received 20 bids from companies looking to set up rare earth permanent magnet manufacturing facilities in India. The Ministry of Heavy Industries has now opened the technical bids under its rare earth permanent magnet manufacturing scheme. And among the bidders are some of the country's major industrial names, including Larsen & Toubro and Coal India Limited, along with 20 microns as well. The list also includes companies in consortia with a focus on rare earth and recycling advanced materials as well, including Atero Recycling, Loham Magnets and Energy Solutions. Midwest Energy is in joint venture with Midwest Advanced Materials. PRND is also there. Protrial India is also there. There are also bids from Neo Performance Materials of Singapore, Prozeal Green Energy, Renew Power is also among the bidders. So the government is now expected to evaluate these technical bids and select beneficiaries under the scheme of the Government of India. Now, the scheme has the financial outlay, remember, of 7,200 crore rupees and aims to establish 6,000 metric tons per annum of integrated rare earth permanent magnets manufacturing capacity, with 5 beneficiaries eligible for up to 1,200 MTPA each. These magnets, remember, are crucial for industries including EVs, wind turbines, electronics, aerospace, as well as defense. Back to you.
All right, Shivani, but stay with us. You know, Airbus has submitted initial assessment of Air India A12379 altitude loss incident on August 4th. Tell us more about that.
Well, yes, sources tell us that Airbus has submitted its initial assessment to Air India on the August 4 Phuket to Delhi flight incident, and the dossier now gives us a glimpse into what happened during those critical few seconds when the pilot struggled to get the aircraft back under control. According to the Airbus dossier that CNBC TV 18 has assessed, the aircraft saw a sequence of hydraulic pressure losses. First, the green system, followed by the blue and then the yellow system. These hydraulic systems power critical flight controls, including the elevators at the tail and the ailerons on the wings. Airbus says that the loss of hydraulic pressure temporarily affected these control surfaces. As the ailerons moved, the aircraft pitch increased, sending the nose of the aircraft upwards. The dossier then records that the autopilot 2 disconnected and full nose down input began from the first officer's side, but there was initially no direct response from the flight control surfaces. The hydraulic system subsequently recovered, followed by a recovery of the flight control surfaces as well. Aviation experts say that the loss of hydraulic pressure across all 3 systems is an extremely rare occurrence, given that the A320 is designed with 3 separate hydraulic systems to provide redundancy. Importantly, Airbus document is an initial assessment and does not identify the definitive root cause. It has sought further checks of the hydraulic system, pressure switches, sensors and associated wirings from Air India as well. We have reached out to Airbus, Air India and DGCA for their comments. Airbus has responded to us saying In accordance with ICAO Annex 13, Airbus is providing all technical assistance to the relevant investigating authorities in India. Air India and DGCA's responses are still awaited.
All right, Shivani, many thanks for those details. Now, on to the latest updates from West Asia. U.S. Vice President J.D. Vance outlines Washington's key objectives in the Iran conflict as keeping energy prices stable for Americans, preventing Tehran from acquiring nuclear weapons, and securing a stronger U.S. position. Meanwhile, U.S. Defense Secretary Pete Hegseth warns that Washington can continue with its naval blockade of Iranian ports indefinitely and for as long as needed. CNBC's Dan Murphy gets us the latest updates. Dan?
The U.S. promising to maintain its pressure on Iran. The U.S. Defense Secretary Pete Hegseth telling reporters on Thursday that the U.S. naval blockade on Iran could go on indefinitely. Plus, the Treasury Secretary Scott Bessent saying on Fox News that Iran could face even further economic isolation as the Trump administration mulls measures that have, quote, never been seen before. Meanwhile, Vice President J.D. Vance also telling Fox the U.S. will still emerge from its standoff with Iran in a stronger position.
I think this ends with the United States in a stronger position, with Iran not having a nuclear weapon, and with the Strait of Hormuz returned to a place where oil and gas prices are stable for the American people. I think the issue here, Will, is that the Iranians sometimes make commitments that they don't honor. They make a deal, they don't honor the deal. And I understand your point about the seesaw nature of this, but I think what that reflects is that we have a lot of tools at our disposal to compel action.
Meanwhile, here in the UAE, ADNOC says 2 of its vessels were attacked while crossing the Strait of Hormuz on Thursday evening, with no injuries reported. The UAE has blamed Iran, condemning what it called a hostile Iranian attack and accusing the Revolutionary Guards of targeting commercial shipping. It's the second such incident involving ADNOC-linked vessels in less than a week, adding to security concerns for commercial ships in the Strait of Hormuz. Axios is reporting this morning that Jared Kushner, President Trump's son-in-law, is planning to travel to Israel next week for talks on the next phase of the Gaza plan. According to 5 sources with knowledge of the plans, Kushner is expected to meet Prime Minister Benjamin Netanyahu and other senior officials, with the White House trying to keep momentum behind a plan to disarm Hamas and transfer control of Gaza to a new Palestinian technocratic government. Axios says Kushner is also expected to travel to Cairo for talks with mediators from Egypt, Qatar and Turkey. Netanyahu has publicly rejected the current U.S. plan for disarming Hamas, but U.S. officials told Axios the 2 sides still agree on the broader strategic goal.
So Dan there with the latest from West Asia. Many thanks for those details. On that note, it is time for us to head into another short break, but more news and updates coming up on the other side. Stay tuned. Welcome back. It's with us on Business Lunch. The Supreme Court expresses strong disapproval of the directions issued by the Bar Council of India to stop enrollment of the students of the Nalsar University over a protest campaign against the Chief Justice of India. Ashmit Kumar joins us now with all of those details. Ashmit?
Well, at the heart of the issue essentially is a group of students in Nalsar who had essentially protested against the CJI, the Chief Justice of India, being summoned as a chief guest for the convocation ceremony of the outgoing batch of 2026. Now, since that protest, last evening, we had the Bar Council of India issuing a directive. That directive essentially directed the Nalsar to ensure that there is no enrollment of the outgoing students as an advocate in any state bar association. That's one. And second, the Bar Council of India had instituted an inquiry against the student as well as faculty members. That led to a huge outcry from the legal community, from members of the youth, from members of the student community who had flagged this as an overreach by the Bar Council of India. Subsequently, within hours of issuing that first directive, this was watered down by the Bar Council. The Bar Council watered it down by saying that there is the students can continue to enroll, but there will be an inquiry. This led to further outrage against the Bar Council of India, especially their president in question, which subsequently led to a statement from Manan Kumar, the president of Bar Council of India, where he said that neither will there be any inquiry, nor is there any standing directive for barring the enrollment of the student activists, of the student who are graduating this year, 2026, from Nalsar. This issue was flagged before the Chief Justice of India today. He said that this issue of protest is one that exists between the students and the CJI, that the students have even written to the CJI that Bar Council of India has no role to play, asking why is the Bar Council of India intervening? Not just that, the Supreme Court has also asked very tough questions of the Bar Council. Was there any meeting convened for there to have been a conscious decision taken by the Bar Council as a whole? So tough questions being posed, but essentially the CJI is saying that this is a matter between the students and the Chief Justice, that they are already in conversation. Bar Council has absolutely no role here going forward.
All right, Ashmit, many thanks for taking us through those details. But with that, it is a wrap on this edition of Business Lunch. Midcap Radar will take all the market action forward.
Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Markets have been consolidating. We're just at the 24,330 mark. The attempt to recovery was sold into. The midcaps are underperforming as well. And we do have the Bank Nifty, which is also contributing to the losses that we are seeing, largely in line with what we are seeing at the benchmark as well. But Vivek, it's Friday and we are done with the earnings season. Let's celebrate.
Absolutely right. I'm completely with you. Wherever you say, given the fact that, especially in the last week, you see the number of results that come about, especially in the broad end of the market,
Yes.
very tough to keep track and keep top of most of them. But a lot lined up on the show, some important corporate conversations as well. So let's start off with the top headlines. So, stocks continue to trade with cuts, with the Nifty trading around the 24,300 mark. Metals, IT and cement are the big drags, while consumer durables ekes out gains.
Street cheers a strong first quarter from Galaxy Surfactants. Stock logged in a 20% upper circuit after profit doubles in the first quarter. The management, speaking to CNBC TV 18, has also raised its EBITDA per ton guidance for the year.
LG Electronics posts a strong Q1 with double-digit growth despite price increases. The consumer durables leader is confident of surpassing its mid-teens revenue growth and early double-digit EBITDA margin guidance.
Brazil's Alunort ramping alumina output back up after gaining self-import approval for gas and a temporary access deal with supplier Selba. Nalco trades with cuts of over 5%.
In a significant relief for promoters of Zee Entertainment, the Securities Appellate Tribunal has stayed SEBI's order barring them from the capital market. The tribunal also allows Zee to proceed with the preferential issue to promoters. The stock leaps.
All right, those are top headlines that we are tracking. Midcaps are underperforming the benchmarks as we speak. So we have to talk about all the midcap movers, the earnings that are trickling in as well. Ria is here for our special segment, Midcap Movers. Ria.
Well, yes, a lot of movers in today's trading session and a whole host of earnings reactions as well. So let's start off with the positive earnings reactions first. We have the likes of Apex Frozen Foods, Wellspun Living, LG Equipments, KRBL, Praj Industries, all seeing strong gains of anywhere between 5 to up to 18% in today's trading session. On the losers end, we have Aditya Infotech, Electra Green, Saman Capital, Fino Payments Bank, as well as Axis Gates. All of these reacting to weak set of numbers in quarter one. We have Aditya Infotech as the biggest loser, hitting a lower circuit of 5% today, and Axis Gates as well on the lower end at with a 2% cut. In terms of the other movers in today's trading session, on the gainers side, we have Chem India Projects as well as Asahi India seeing strong gains today of nearly 4 to 5%. And on the losers end, we have Allied Blenders as well as Emcure Pharma taking a hit in today's trading session.
Okay, all right. Thank you so much for joining us with all those details, Ria. So some of those stocks which are on our radar today. Let's talk about more earnings and more conversations now. Max Financial reported a strong set of quarter one numbers with AP and retail APA growth coming in strong. My colleague Yash Jain caught up with Axis Max Life CFO Amrit Singh and began by asking about the quarter gone by and whether the strong momentum will continue or not. Listen in.
We have been indicating this, that given the distribution muscle and the granularity of distribution that we have built, we would like to outpace industry growth anywhere between 300 to 500 basis points. And if you see the numbers that we have delivered in the first quarter, we have grown at around 17% on the individual adjusted basis, as against a market growth rate of 15%. As the July numbers trickled in, this was further consolidated. We have grown now for YTD July 16, and the market has grown 13%. But more importantly, first quarter is actually a strong quarter for us given the base that we had. If you see a 2-year CAGR, we have grown at around 20% as against a market growth rate of 10%. So we've almost doubled that pace. We are hoping that we continue, being this 300-500 basis point faster than the market.
Can you do better than what you did in FY26 on the margin front? That is better than about 25.2%. And if yes, then what is the kind of expectation that you have here?
Yeah, I think from a philosophy perspective, given the nature of the industry, it's important to keep strengthening your position on distribution. So the focus on sales growth and sales growth actually remaining strong is the predominant focus. But at the same time, we want to operate in a healthy margin trajectory. But for the full year, I think the way you should read from our aspiration is that we would like to consolidate our sales position, continue going faster than the market, and possibly at the margins have some improvement on the margins as well. And hence, this value of new business should grow marginally faster than the sales growth as we look forward during the year. As the year looks forward, I mean, we're not guiding the fact that, this 300 basis point, absolute 300 basis point outperformance and margins will sustain, because a few things will normalize on both annuity protection products as the run rate progresses. And also, yield curve is always a temporary phenomena. There is competitive intensity, and you would want to pass on some of those benefits to the consumers as well. But rather than giving a specific number guidance, I think it's a range guidance. We were 25.2. So we will remain in this 25-26 corridor as the year progresses.
Now that Axis has completed, the amount that it wanted in the company, the stake that it wanted, that is about 19.99%. Now that is behind the company. When do you start the process of the reverse merger now? And at what stages would those milestones come in terms of filing it before NCLT, taking the regulatory approvals, and finally concluding that reverse merger and having Axis Max Life listed on the exchanges?
Yeah, I think, and you must have seen from our past disclosures, both at MFSL and Axis Max Life board levels, we have been fairly clear that there is keen interest to simplify the structure. The structure does not have a long stage to it. We would like the insurance company to be directly listed, and enough and more disclosures around that has been made by both the boards. And that's what even the regulator also wants. They are looking forward towards more insurance companies listed, because it not only improves their access to capital, but also helps on governance aspect as well. We have a major hurdle behind us. The Insurance Act was amended in December 25, which actually created way for a non-insurance company to merge into an insurance company. And just a few days back, the regulator has actually drafted regulations around it. At this stage, we are in the process of internally consulting with our key stakeholders here, because there are certain technical aspects from a formalities perspective that exist. So you'll have to allow us some time before we come back and indicate specific timelines around when we will, bring the scheme document.
Do you expect it to happen in FY27? Can I have that answer and that clarity at least?
I think let's wait it out. Maybe we will have better clarity in a few more months to give you a specific timeline on that.
Okay. One question, Axis Bank is looking to raise stake in Axis Max Life Insurance by another 10%. This is something which we at CNBC TV18 had reported. What are the conversations on that front? The team from Axis Bank, has the team reached out to you at Axis Max Life Insurance exploring this particular intention?
I think this specific conversation is internal to Axis at the moment. What we understand also from possibly the same disclosure that you are reading is Axis has indicated that they feel that there's an opportunity which has opened up, and they are internally assessing the pros and cons of that opportunity, whether they can increase the stake further. So we'll have to wait for them to do their internal assessment before we can comment on this topic. But again, I think going back in history, when the original deal was constructed, Axis was keen to take almost up to 30% stake. But we'll have to wait and watch how Axis kind of internally deliberates this topic. Okay. I must just add that I think any such step should be seen in a very positive light. Axis Bank is a keen promoter, and them consolidating that position into the life insurance company says a lot about how they look at the franchise and the potential of the franchise, if there is any such conversation.
In case if Axis Bank also decides to increase its stake by another 10%, does it not have to happen before the process of the reverse merger happens? Because then the company would be listed. So naturally, that move will come, which is Axis Bank's move to increase stake, will happen before the reverse merger, correct?
Yeah, I think that's a correct technical understanding. So yes.
Well, that's the confirmation coming in from Max Financial as far as Axis Bank looking to raise its stake further in the company. But we'll now slip into a short break. Up next, we will connect with the management of Engineers India to discuss their Q1 numbers and the road ahead. Stay tuned. Welcome back to Mid-Cap Radar. Well, Engineers India Limited reported a strong set of Q1 numbers with a healthy order book and a very strong operational performance with significant margin expansion. The sore blip, though, was the fact that order inflows remained quite muted. To discuss the quarter and the road ahead, we are joined by Mr. Atul Gupta, Chairman and Managing Director at Engineers India, who joins us. Good afternoon, Mr. Gupta, and thank you so much for joining us. Well, first up, congratulations on becoming the CMD at Engineers India Limited. So very briefly, what are the targets you've set for yourself, at least FY27, FY28? If you could quantify the targets that you've set for yourself, as soon as you've taken over at the helm.
Yeah, thank you. Thank you, Vivek. And also, it's a pleasure to be there on your channel. Of course, after taking over, this is a very normal and natural question. But as far as Engineers India Limited is concerned, we have mapped our company's growth path on various pillars. The first pillar is the business growth and diversification. The second one is with respect to operational excellence. Then third one is technical excellence with the digital transformation, and then the human excellence. So in these areas, if we see on the business growth, apart from consolidating on our oil and gas sector, we have mapped a very robust diversification plan, which we have been working in last 2 to 3 years very aggressively. So we have now diversified into the upcoming sector, which is a metal sector, which is very, very promising in the next several years to come. We have already mapped into the nuclear. Nuclear, we have started several assignments. It's going to further enhance our order book as well as the revenues. On the infrastructure front, we are in the niche infrastructure, including the large complexes, infrastructure projects, as well as on the data centers and also in fertilizers, as well as in our maritime sector. Also, we have been very strong. So definitely, while going along, we would like to mention that the guidance we have provided with respect to our revenues, we are further going to make it better. The last year, it has been around the order book of 3,870, around something that plus, and that we understand we are going to further enhance it. And we would like to take a guidance of around 10% in this particular year. Of course, we are in the first quarter, but we will definitely be able to make that guidance and to this year. And the year
10%,
ahead,
so 10% growth is in the order book guidance, Mr. Gupta, for FY27?
Yeah, this is on the, I'm telling you, on the revenue, on the turnover front. Yeah. So that's also, we are very much robust with the sort of order book and the execution excellence which we are carrying out.
Yes, we wanted to ask you on margins as well. A strong expansion is what you saw in Q1. Will this continue in FY27? What is the guidance on the margin and the bottom line? 10% on revenues. What about margins going forward?
See, the operating margins, as we know, in the last quarter, it has been 14%. And this quarter also, we have maintained a very healthy operating margins, and we are going to maintain those operating margins as well throughout the year. And maybe, let's say, if we can further make it better, or maybe up to 60% also we would like to target. And that's what the internal plans, we are very much focused.
Okay, Mr. Gupta, as far as Q1 is concerned, you did say that margin expansion on a sequential basis has been quite strong. When we look at the segmental breakup, the contribution that is coming from the consultancy segment has been much higher. On the other hand, EPC contribution has been lower. So going forward, what will, number one, be the revenue mix? Will consultancy continue to remain higher? And even when you take in new orders, will that be the higher margin orders that you will be accreting as far as your own order book is concerned?
Yeah. If you see the trend, generally we have been 55% is something which generally is there from the consultancy segment and around 45% from the EPC segment. This particular year, this particular quarter, what we have declared the results, in this, the ratio is around 62% and the rest with the EPC. The reason is basically with respect to the EPC jobs which we are running, those were already under closure. But the year ahead, now in the next quarters to come, we will be able to realize the EPC segment ratio. In the same fashion, we understand that we will be able to.
So in that case, from Q1 levels, should we expect EBITDA margins to slightly moderate going into Q2 and H2?
No, EBITDA margin also we will be able to maintain the same.
Okay. I wanted to speak to you about the oil and gas space. Did see a lot of disruptions because of the West Asia crisis. Are you qualified for Aramco, ADNOC tenders or contracts? What's the pipeline in that particular segment for you?
See, with respect to the geopolitical situation which has emerged, though there were certain projects, they have gone slow with respect to because they were concentrating on the crisis. But still, we could able to manage the order book, quite a significant order book, around 500 crore in the first quarter from these particular countries. So while going forward, we understand even if the situation eases a little bit, we feel the main infrastructure projects, which has been earlier put on hold by them, will further get accelerated, and we will be able to do better than the last year's business in that particular segment. So we are quite upbeat, and also in Aramco in Saudi Arabia, there also we are going to. We hope that we will be able to get the better better order book in the second or third quarter. I think the third quarter will be something which we hope that we will be able to give a very, very robust order book from those segments.
Okay, so Mr. Gupta, so from what you've said, what we understand is that as far as Aramco is concerned, we believe you're already qualified, and right now you're waiting for the ordering activity to begin. What is the status as far as ADNOC is concerned? And Q4 of last year, Q1 of this year, and Q2, how has ordering activity been? Has there been a pickup post the crisis, or it continues to remain subdued on ground?
No, we understand that in the first quarter, despite the crisis from ADNOC, we could able to get the order of around 500 crore. So going further, when this particular situation eases and they are now embarking on the infrastructure, which they will be able to, because they want to bypass this Hormuz and to other sectors. So those pipelines and other projects and terminals, they are going to come in a big way. And we understand those are a very big opportunity. Apart from the regular jobs, which ADNOC has earlier gone a bit slow, those will also pick up in the quarter 2 and quarter 3 as well. Okay. So we understand it will not be subdued. It will further, we will be able to get better on that particular segment.
Okay, so the street likes what you're saying, Mr. Gupta. The stock has recovered from the lows of the day, but we wanted to understand two blips in the quarter gone by was top-line degrowth due to low turnkey and muted order inflows. Can you talk to us about the mix that we'll see in FY27, and what was the reason for that lower inflow of orders in quarter one? Because the expectation was between 7,000 to 8,000 crore rupees. So the ask rate for next 3 quarters is going to be really steep. Give us a number on order inflows and what led to this lower than expected order inflow in quarter one.
We would like to mention that the quarter one order book generally as a trend, it remains on the lower side as compared to further quarters. So we have not done, we have definitely on the figures, if we see in the mathematical terms, it is the adding up will be a bit different, but the trend definitely is very clear. Q2, Q3 and Q4, the order book, whatever it will pick up, it will definitely, we are going to reach to the last year order book and even maybe better than particular that. We are very much working.
Sticking to the 7,000 to 8,000 crore order inflow guidance that the street is working with. Is that something?
Yeah, maybe a bit more also we will be able to garner with the sort of business efforts which are going on. As we already know, I can also mention the sort of diversification we have carried out. Not only in those segments which I mentioned just now, but also we are very much in the international segment also. Okay. We are further accelerating our efforts, even in the coal gasification area, upcoming areas, and as well as, so we are very much in the thick of the game for these sectors where the huge investment is coming in India as well. Apart from the international outreach, we are expanding.
Thank you, Mr. Gupta, for joining us today and giving us a sense of what the business would look like in FY27. Strong margin guidance of around 16%, 10% revenue growth, and sticking to the order inflow guidance of 7,000 to 8,000 crore rupees. Maybe they'll do better than that as well. The stock has recovered from the lows and attempting a recovery as well. By the way, the markets have also recovered sharply from the lows of the day. When we started the show, Nifty was down around 60 points. It's down just 10 right now. A major recovery coming in on the Bank Nifty. That index should come up for you on the screen. It's now down around 0.2%. Was down around 0.4% when we started the show. So a major recovery coming into the Bank Nifty as well. So pick out some of these Nifty banking names. We do have ICICI Bank, which has recovered from the lows of the day. There's SBI as well, and the other names which are attempting that recovery. So 90 points recovery from the lows of the day. A lot of it led by the Bank Nifty, which is off around 140 points. So we'll keep tracking the market moves for you. Slip into a short break and come back with more on the markets.
Welcome back to Mid-Cap Radar. Well, with the news that there has been a very sharp recovery in the last 20 minutes of trading session, the Nifty, as you can see, is up almost 0.4%, and the Bank Nifty too, doing quite a bit of the heavy lifting, down up almost 0.3%. And with that note, it's time to call a wrap on.
It's a Friday cheer. We are ending MCR with a Friday cheer. Okay, we'll take your leave on this edition of Mid-Cap Radar. Stay tuned. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati as well. Arundhati, a very good afternoon to you. And market surely, the previous show ended saying it's a cheer coming in on Friday. That's what it's continuing as of now as well. 24,400 is where the Nifty stands at as of now. So moved to that green territory as of now. Whether this continues in terms of an up move is something that we'll watch out for. Now, other than that, let's look at what the broader end of the market is doing, right? Whether the mid cap and the small cap, where they are headed, it will be key to watch out for as well. Mid cap is still in the red. Small cap is also still in the red. So we're seeing actually the benchmark indices, which are managing to see a very good gain in the trading session, a very strong recovery that's come in for the benchmark indices. Apart from that, Nifty Bank also is significantly recovered from the day's low. So let's pull up the Nifty Bank chart as well, trading somewhere around 57,590 around. That is what the Nifty Bank is at, and moving towards the side of the green even as of now. An advance decline ratio today, that was at one point of time more in the favor of declines versus advances. Now also that continues to be more in the favor of declines versus advances. But seems like that gap is narrowing. Now, if you see the broader end of the market recover, Arundhati, then maybe that could converge at some point of time.
Absolutely, a 200-point recovery there on the Nifty that we are witnessing. We've got the media and consumer durable pack leading from the front, but we've got pharma and commodities as well as the oil and gas sector on the lower end. But joining us today to answer all of your stock queries are Shaina Mukaddam, independent market expert, and Ajit Mishra, Senior Vice President Research at Religare Broking, to answer all of your stock queries. So, good afternoon. Thank you so much for joining us. But let's get into the first query today. Sriram Raghuraman is writing to us from Chennai. He holds 30 shares of Syrma SGS at 784 rupees per share and 50 shares of Sterlite Tech at 471 rupees. He is making a profit there on the Syrma investment, and the other one is also a profit for him. He wants to know the fundamental view for both these stocks from a long-term perspective. Shaina, what's your view on both of these stocks, Syrma SGS as well as Sterlite?
Well, I think both of them have very strong prospects if you take a little longer term horizon. For the shorter term, there is some bit of consolidation likely because in terms of valuation, both of them are slightly expensive. If you look at it on a EV by EBITDA basis, 1 year forward, both of them are around 25 times. So, which gives limited scope for up move in the shorter term. But the prospects for both of them are so strong that I would suggest the investor continues to hold it through for the longer term. If you see the order book position for Syrma, in FY28, they're talking of 9,000 crores, which I think they can easily do given the momentum that they did in the first quarter of the current year. And if this momentum continues, which we expect, also in the capacity expansion that they're going in for PCBs, the components, I think all these factors put together, Syrma should do well for the longer term. In fact, the other one that you mentioned is Sterlite Tech. Sterlite Tech also valuations are slightly expensive, but there also the order book position is very good. And that's more of a turnaround stock. After making losses for 2 years in FY26, they moved into profits. And the current year order book position is very strong. So I think the growth momentum for the current year also should be strong. Of course, the stock has run up very fast, Sterlite, in the last 6 months. So consolidation is likely, but I think for the longer term investor, it makes sense to hold.
Okay, that's the view on the fundamentals, can hold for the long-term perspective. But Ajit, on the technical front, Syrma SGS as well as Sterlite Tech, what should the viewer do with this? Long-term targets for this?
Yeah, good afternoon, Vinay. So, Vinay, what we are seeing is that both these stocks are trading at the record highs. Means Syrma has made a new record high of late, and we are seeing just a marginal breather. But the overall momentum is intact. So, in case if the view is short term, definitely one should stay put. 1410, 1420 is the area basically where we have the immediate support. So, with that as a stop loss, one can definitely look for adding more in case if somebody is looking for fresh buying opportunity when it comes to Syrma. And for Sterlite Tech, since here also we are seeing that the stock is around the record highs and trading in a very tight band. So here consolidation may continue at least in the near future. So avoid any fresh buying at current levels. For the existing position, 600 is the area basically where one should maintain stock.
Okay, that's the levels that one should keep an eye out on. Let's move on to the next query for today. This one is coming in from Sunil, who's writing to us from Bangalore. He is holding 2,500 shares of Netweb Technologies, and he's bought it at 4,670 rupees per share. Wants to know the future prospects of this company and the outlook going forward from here on as well. Shaina, what is your view coming in for Netweb Technologies, a stock that has run up, a stock that is related to the AI side, and because of that play, it started moving up much faster than the others. What is your word on the fundamentals?
Yeah, absolutely, Vinny. The stock has moved up, but here also valuations, while they are expensive, if you look at it from a shorter term perspective, if you look at it 1 year forward, it's about 30 times, EV by EBITDA. So it is not cheap. But having said that, I think here again, the sector it is in, the order book position from Nvidia, which continues to remain pretty strong customer for the company. And here also, I believe the opportunity for the medium to longer term is very strong, as you mentioned, given the fact that a lot of investment is going into the data center capacity addition, etc. So I would say here also a long-term investor should continue to remain invested.
Ajit, what do you make of Netweb Tech? In just 1 year, it's seen a rise of over 130%. So what's your view on the company?
So certainly, in fact, if you see that the stock has been maintaining the steady uptrend, though there have been phases of marginal pullback and consolidation, but broadly the trend is up. Today also we made a new record high. Is just the marginal profit taking that we are seeing in the mid cap and small cap space that is basically currently weighing on the sentiments. But broadly, we expect this overall momentum to continue. And after this, fresh move, potentially 5,800, 6,000 is something the stock might test in a month or two. So with stop at 47, one can definitely stay put.
All right, one can definitely stay put. That's the view coming in there. The next query coming in from Anita, who writes to us from Pune. She has 200 shares of Muthoot Finance at 3,400 rupees a share. And she has 250 shares of MCX at 3,035. And she wants to know the outlook for these shares for the rest of the year. So she's making a loss on both of those counters that she has. Shaina, what's the fundamental view for both of these stocks?
See, of the two, my view is that she can take some loss and book some loss from Muthoot Finance and continue to hold MCX for the long term. See, Muthoot Finance, while the quarter numbers were very strong, and the management has maintained that, yes, that even during the rest of the year, the growth is likely to continue to remain strong. I believe valuations to an extent are on the higher side. It's about 3 times price to book. And the second factor is that RBI is likely to come out with some guidelines, for restricting flexi loan type of movements for retail. So, to an extent, we need to really watch out what will be the final outcome of this proposal and how it will impact Muthoot's finances in terms of either their profitability or growth. So, I would say Muthoot Finance, given the fact that it's slightly expensive, one can take, I would say, book half your loss. And MCX, of course, strong growth that we've seen. There has been some moderation in terms of margins, but I believe that the prospects remain very strong. There is going to be increased competition from NSE in a lot of its segments, but I think the opportunity is good and valuations are reasonable, the stock having corrected. So MCX, given the prospects, long-term prospects, I would say continue to hold for the longer term. Muthoot Finance, book half the loss.
Book half the loss for Muthoot and continue to hold MCX for the long term. That's on the fundamentals. On the technicals, Ajit, Muthoot as well as MCX, what's your view?
So Vinny, after this corrective phase, we are currently hovering around the 100 EMA mark on the weekly charts when it comes to Muthoot Finance. And in case if it fails to hold this 2800 mark, then probably we are set for another 10% kind of a cut. So in case if somebody is having a short-term view, definitely they should avoid any fresh position. And for the existing trade also, a close below 2800 definitely warrants that one should exit their longs. Upside to negate this pattern, we need a close above 3050 mark. So once let's say we cross that barrier, then possibly we can inch toward 3300, 3400 mark. So as of now, it's a hold, but with a strict stop at 2800. MCX, after this recent corrective phase, has rebounded very sharply this week. Means we are up roughly around 12%. Volumes are almost double to the previous week average. So this definitely indicates that a possibility of further trend continuation seems high. 30, 50, 30, 70 is basically an immediate barrier area. So once we cross that, then probably we are set for retesting of the record high zone close to around 3,300, 3,450 plus. So as of now, it's a hold with 2,750 as a stop.
Okay, keep an eye out on the stop losses for both the names as well. On that note, we're going to slip into a very short break. We'll come back with more of your stock-related queries on the other side. Stay tuned in.
Welcome back. It's with us on Your Stocks. We still have with us Shaina Mukadam, independent market expert, and Ajit Mishra of Religare Broking to answer all of your stock queries. The next query is coming in from KS Rao, who's writing to us from Andhra Pradesh. He holds 100 shares of Tata Motors PV at 330 rupees per share. He is making a nominal profit on that stock. He is a long-term investor and is looking to add more shares, and he's seeking advice on the same. Shaina, what should he do with this investment? He wants to know if it's a good bet in the long term. Should he still stay invested?
Yeah, Arundhati, I think he should stay invested, but not add as of now, in my view. Let the stock settle. Basically, of course, as you know, like the first quarter numbers were a washout and very disappointing. Not that it was totally unexpected. I mean, it was expected that the JLR numbers, both in terms of volume, some discontinuation of some of the products, in terms of higher costs, and then also you're going to have some forex impact. So all those things were expected to affect the profitability. But I think, when you finally see the numbers, they were very disappointing. Of course, the domestic business supported the growth, and so they still managed to grow about 9% overall in terms of revenue, with profits really taking a beating. So I would say wait, in terms of valuation, it is for the longer term investor, it's not that expensive. But for shorter term, of course, given the numbers, it looks pretty expensive. So you continue to hold, but do not add as of now. Wait for the stock to settle.
Okay, do not add as of now. That's the view coming in there. I just want to, before we go to Ajit for his view on the technicals, just take a quick look at Natco Pharma, right? A sharp fall has come in the stock after they reported their numbers. We're seeing the margins have seen a very, very sharp contraction, 25.4% versus around 43% last time. You have the board that has approved a fundraise of up to 2,000 crores. This would be via issuance of shares and securities. Profits are down. Revenue is down for the company as well. We'll wait out and see if there's any one-off that is impacting it specifically in terms of profits and margins. But as of now, this is what it looks like. The stock is trading at the day's lowest point, down 6% now in the trading session, was managing to hold on to green before its numbers, but now has given up those gains. So that's Natco Pharma. But going back to the query that we were talking about, and that is on Tata Motors PV, where KS Rao has bought it at 330 rupees per share. Ajit, what is it that they should watch out for in terms of levels? Can they look to add more? If yes, at what levels would Tata Motors be a good bet to add at furthermore?
So in my opinion, since it's been almost 2 years now that we are seeing this stock underperforming, and he has bought it at, I guess, at the current levels. So in my opinion, the best thing is to stay with the leaders or the performers which are showing relatively higher strength. Among the top names, M&M, Eicher, TVS, they are leading that pack. So instead of adding or holding to this position, I would recommend alternatives to invest in case if his view is only to invest into auto. For Tata Motors to change its course, we need a close above 400 mark. Prior to that, I doubt that we will see any meaningful reversal or any gains.
Okay, let's move on then to the next query. This is coming in from Prasad, who's writing to us from Hyderabad. He is holding 1 lakh shares of Bank of Baroda. Price is 250 rupees per share. Wants to know whether he should continue to hold or look to sell this one. They're making a loss on this one. So, Shaina, on the fundamentals, is Bank of Baroda a better bet, or would you suggest any other name?
Well, Bank of Baroda looks okay after this correction. I mean, the first quarter was a washout for them, given the fact that they had to write off the complete settlement that they did for litigation with the UAE-based company for I think more than 5,680 crores. So it was a complete washout for them. But after that, and now if you look at valuations, let's say that's the past history. I think valuations at 0.8 times price to book, not too expensive. And if you look at the overall performance, excluding this one-time item, was pretty reasonably good, both in terms of deposit growth, in terms of loan book growth, and even for the rest of the year, I think they should do pretty well on both these factors, given the fact that even in the FCNR deposits, they are the second only after SBI in their fundraise. So things are positive for Bank of Baroda for the longer term. This year actually could be flat because of the first quarter. But because of valuations, if you're a long-term investor, the bank is throwing up a lot of cash on an annualized basis. So in terms of valuation, even if you look at it, the cash throw compared it to the market cap, it's not expensive. So I would say continue to hold Bank of Baroda for the longer term.
All right, so continue to hold Bank of Baroda for the long term. Ajit, would you have the same view? What should he do with his investment in Bank of Baroda? Hold or sell, and any targets and levels to watch out for?
So what we are seeing at present that banking is sitting on the sidelines amid all this consolidation, and we are seeing that select stocks from the PSU banking basket are witnessing recovery. Bank of Baroda is currently, after retesting its previous swing lows, consolidating in a very tight band. So as of now, definitely it's a hold, because this zone close to around 235, 230 is where we saw the consolidation last time before the strong reversal pattern. So after retesting, we are seeing a breather, and possibly the stock may witness a rebound towards 260 to 265 area first before we see the next leg of hurdle. So as of now, it's a hold with the 230 as a stop loss.
All right, all right. The next query is coming in from Raj, who's writing to us from Jaipur. He has 100 shares of Bombay Burma Trading Corporation at 1,754 rupees. He is making a loss on this investment. He wants to know whether he should hold, exit or average from the long-term view. Shaina, what should he do with this investment?
No, Arundhati, this stock is very difficult to understand. One is because if you compare pure valuations, it looks too cheap. Like, for example, it holds about 50% through its subsidiary into Britannia. Now, the market cap of Britannia is about 1,35,000 crores. And if you compare the Bombay Burma, the market cap is about just 10,200 crores. So even if you factor in a lot of discounts, take 50% of the 135 crores, 135 lakh crores. Also, after that, if you take the company holding discount, after all those factors, also it looks very attractive, very cheap. So I would say you can average at current levels. I think the major issue here, actually, which may be impacting sentiment, is the loan that is still pending for repayment for the Go Airlines. But there also, I think the Wadia Group is selling off some of its real estate. They have got a lot, I believe, in Thana to cover up some of these loans. So to that extent, I think the overall, the liability on them could be limited going forward, and valuations are attractive. So if you're a long-term investor and you can take a little bit of risk, because I think it will be low, volumes will be low, liquidity is low, but still you can add.
Okay, I can add if you're ready to be invested for the long term, liquidity could be low, so that is at some bit of a risk. But otherwise, add is a word coming in from China. Ajit, what would you say? Bombay Burma, what should the viewer do? Last 1 year, we're seeing a decline coming in of around 20-30% for the stock. Would you also say it's an attractive level, or maybe we should expect some bit of further downtick and buy then?
So Vinny, what we are observing that it's been almost like 3-4 months that the stock is doing nothing. Means it's a very tight band, 1,400, 1,600 is something that the stock has been hovering in, while holding below its major averages on the multiple time frames. So this indicates it's maybe more of time-wise correction that the stock is currently experiencing. And to change its course, we need a close above 1,600 mark. So as of now, I would not advise to buy fresh because the stock has already retraced roughly around 60-70% from the record highs. But for any meaningful recovery, we need some sign of reversal. So the better part would be that once the stock resumes its recovery above 1,600 mark, then probably one can look for a fresh long position, not at the current levels.
Okay. Thank you so much for that. Ajit as well as Shaina, thank you so much for joining us on the show as well. That was the last query for today. And viewers, just keep a check in terms of the last day for earnings season. Your Tube Investments also, which just reported its numbers. You could see it flashing at the bottom of your screen, and the stock has seen a fall as well. But with that, we are absolutely out of time. So thank you so much for tuning in. Up next, we have Closing Bell to take you through the last hour of trade.
on market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
We saw Taiwan index, which has opened up with gains of 0.2%.
Look at a 6 to 8% volume growth guidance for the full year.
Nifty Bank is down about 0.16. The Sensex is down about 0.3, 0.4%.
We have seen a 2% earnings upgrade for our broader coverage.
Ambitious guidance for this year had been 14,000 crore.
Market, however, is slightly under a wee bit of pressure, around 24,300 for the frontline index.
The promoters can now go ahead with that 3,000 odd crore rupee warrant issue.
But everybody was at double digits, and the fact that it has come at 9.78, that's not a small undershoot.
Markets have been consolidating. We're just at the 24,330 mark. The attempt to recovery was sold into. The mid-caps are underperforming as well.
Okay, well, that is the day so far. This is Closing Bell coming to you from the CNBC TV 18 Motilal Oswal studios. I am Prashant. Nigel and Rima are with me, guys. Hi, good afternoon. And how's everyone feeling? Charged up for the weekend? No.
Come on.
Do that again. Okay, let's just have some water, Nigel. Okay, take a quick look at what the markets are doing, indices are doing, and then we will move on from there. I think 25 points lower, which means that we are off the lows of the day. And flattish. And you got the Sensex, which will come up on the screen, mid-cap, small-cap indices. So quiet, whimperish kind of close into the weekend. And why not, right? It's the weekend after all. The market breadth, I think, is the last I checked, it's not sort of terribly instructive in the way it is trading. So 1,400 stocks are higher and about 1,900 stocks are lower. So more down than up. And it's all kind of quietened out, right? And even names, I mean, there are a bunch of names, and you heard from the managements early on, LG and Galaxy, and those are all up and about still. But many have cooled off since after strong starts. I mean, Max Financial is a case in point, and a few more, which are not lasting. So it's about individual names that we will tackle here over the next 60 minutes. Rima.
Hi, there was a sudden burst of activity starting 1:30 when markets moved up about 70-80 points. So from levels of about 24,330, we shot up to 24,400. But other than that, and then it quietened down a bit as we speak. So it's off about 30 points from that level. But things have been very, very quiet. Now, week to date, as we stack up, the Nifty is down close to about 0.8%, while the mid-cap index is up 0.6%, but the small-cap index has a bit of a cut going for itself. Cement is your top loser this week, nearly 3% lower for the Nifty Cement Index. FMCG is down 1.7%, metals are down 1.6%, autos have retreated 1.3%, gone for the auto and the healthcare index, and on the way up, you've got Realty, which is doing pretty well, and the defense stocks too managed to clock in some gains.
Well, that's right. There appears, though, there is some good amount of buying actually at lower levels. A couple of stocks that popped up. I think Sudarshan Chemicals was another stock that, in fact, did see a bit of a spurt, intraday basis. I think that con call got over at around 11 a.m. or thereabouts, and that stock, in fact, has suddenly seen a bit of a spurt out there. So we'll keep an eye on that. But Rima, let's run the viewers through what we have on the show.
Okay, we've got an action-packed final hour coming up on Closing Bell. So we'll talk about the market. Stocks have staged a little bit of a reversal, moved to the day's high, cooled off from there. So now it's 24,370 on the Nifty. Broader markets, though, are underperforming. Metals, autos are the top sectoral drags. Shares of Axis, Max Life and erstwhile Max Financial are seeing steady gains on the back of strong June quarter numbers. Brokerages turn bullish. Apollo Hospitals has upped the FY27 hospital top-line guidance to 20% versus mid-teens earlier. What's giving the company confidence? A deep dive into that. And we've seen a stellar move on Galaxy Surfactants. The stock is locked in an upper circuit of 20%, strong Q1 and an FY27 guidance rate. A chat with the management that we had earlier on the show is coming up. But how should you position yourself in the last hour of trade? Mitesh Thakkar is now joining in with a few closing strategies. Mitesh, another quiet session. What's the trade?
Yeah.
Good afternoon. I think it's as you rightly put, a very quiet session. But again, what has happened is that yesterday we got a low of 24,311. Today was 24,96. So we are kind of trying to bounce back and hold these levels, 24,250, 200 being a key support area. In case we can do that for a couple of more days and then start getting past 24,400, then I think Nifty might show some momentum on the upside. It's now, since the cash started, it's now, I think, the 10th trading session and the market hasn't yet cleared the closing of the first cash section. So, it's still been under pressure, but now is the area where a lot of moving averages are converging around this 24,250, 200 zone. So if you can hold them, I think there is a chance of a reversal on the upside. On the stock side, I have a buy on Bharti Airtel with a stop at about 1975 for targets of 2055. And a sell on Biocon with a stop at 421 for targets of 400.
Okay, well, individual names and some trades coming in from Mitesh. Let's tackle the first one on a fundamental basis. Max Financial, right? So numbers were strong. We have the management commentary now as well. But what are the brokers saying? Yash is joining in with that. Yash, take it away.
Well, a quick, comment on the numbers. The numbers were, of course, strong. What came as an added positive is the way the company delivered a beat when it comes to the value as well as margin. Margin was good, 300 basis points ahead of what the street was anticipating. So that came as an additional positive. As far as the brokerages are concerned, we have a brokerage coming from Bernstein, which has an outperform rating with the target price of 2,080 as far as the stock is concerned. HSBC also has a buy call on the stock with 2,100 as the target price. Jefferies has a buy call again with about 2,100 as the target price. The management, of course, spoke to CNBC TV18. In that interaction, very importantly, they've laid down what FY27 looks like for the company. They expect the company to have a 200-300 basis points outperformance when it comes to growth. This is versus the industry. They expect margins to remain around 25 to 27%. Importantly, on one story which CNBC TV18 had reported, which was with respect to Axis Bank exploring the possibility of acquiring additional 10% stake in Axis Max Life Insurance. They already own about 19.99% stake. The story was about them looking at acquiring additional 10% stake. We asked the CFO of Axis Max Life Insurance on those conversations, and here's what he had to say.
Okay, well, Yash, we will play that out a little later. Thank you very much for running us through what the brokers are making of the numbers really coming through. Dilip Bhatt is with us, founder at Pedigree Advisory. Dilip, great to have you with us here on the program. Thanks very much. First thoughts on, if you have a view on life insurance or Max in particular, actually the two names which have done well is Max and SBI Life over the last few years. HDFC Life has been, in a way, the dud. These two are the ones, and SBI Life to a larger degree, which have taken HDFC Life's share. What's the view?
Good afternoon. I think the view on this particular sector of the business still remains very upbeat. There, without any doubt, I think there is good scope even to, to get more business in a very big way in the times to come. Having said this, I think the three companies that really stand out certainly is Max is one of them, HDFC Life, and third, of course, I will say that SBI Life. LIC is an outlier, as what I would call it. But I think looking at even the initial numbers of Max Life, I think it certainly looks like the things possibly is going to get even much better as we go forward. So I would say that in this particular life insurance business, I think some of these companies really stand out in a big way. I think Max particularly takes the cake, in my opinion. They've got a very good backing and a tie with Axis at the moment. And in times to come, I think we'll see a better ROE and better improvement on an overall parameters.
Dilip, telecom stocks are making a big move today, whether it's Bharti Airtel, a Vodafone Idea, or even a Bharti Hexacom. Now, 2 days back, Bharti has discontinued one of its popular cheaper plans, the 299 rupee plan, prepaid plan, which basically nudges people, subscribers, to upgrade themselves. So many would, and that would provide an ARPU lift for companies like a Bharti Airtel. And assuming Vodafone Idea follows through, even Vodafone Idea gets that benefit. Yesterday, I was wondering why Bharti Airtel didn't react to that news, but today it seems to be 3% up. And now you've got the Jio IPO also upcoming. Where do you stand on telecom? Any stock that you like here?
So, the headline statement that I would like to make in this is the capital intensity of the business for the telecom space continues to be pretty high. The competitive intensity is also there, but the number of players, as we all know, are just about a couple of them, not more than that. And only it's basically Jio and Bharti Airtel. I think Bharti has already moved up quite a bit and has been one of the best performing stocks. So if I'm holding it, I will not buy anything further from the current levels. Maybe I'll just hold on to it. For buying, I will wait for a good dip in case if that happens. So I think that's where we stand. And Vodafone, of course, I think as what we said, there has to be a good corporate outcome or a culmination of some corporate event in Vodafone if that really has to go up on a sustainable basis from the current levels. It can be anything that we can just imagine. But otherwise, Bharti Airtel still is the best, but I would not buy this price.
Yeah, Bharti Airtel has done well in the last 5 years. It's given a CAGR, a stock CAGR of nearly 25-26%. It's been a steady compounder. The last 1 year, it's consolidated. But let's talk about Apollo Hospitals. That's doing very well. And the company has given a strong guidance for FY27. Ekta, give us the numbers.
Well, yes, Apollo Hospitals has done well in today's trading session. Remember that the conference call was held at 3 p.m. yesterday during market hours, so is reacting to that commentary. They've raised FY27 hospital revenue growth guidance to 20% from mid-teens earlier. FY27 new hospital EBITDA loss is guided at 140 to 150 crores, so that's unchanged. The digital vertical, which is basically Apollo 24/7, is guided to reach break-even in the coming quarter. Insurance business, they're expecting it to reach break-even in Q3 of FY27. Diagnostics target to reach 20% plus margins over the next 6 to 8 quarters. Expansion through FY31 will be funded largely via internal accruals, and the management is reiterating a comfortable balance sheet debt position as well. So overall, looking good, especially for the hospital business, and for the digital business, they're expecting to break even as well.
On the call or otherwise, Ekta, have you heard them talk about this, the recommendations on the rates, etc.?
Well, yes. In fact, I tuned into the Max Healthcare call today, and they were quizzed about the recommendations. Basically, the reply was that, one has to come to a consensus, one has to come to an agreement in terms of what the way would be going forward. Remember that Tier 2 expansion, Tier 3 expansion, a lot of it is not going to be possible unless you have heavy, deep pockets which are supporting you. And that would come through factors such as FDI within the entire hospital space. So one needs to come to a common ground, but there are certain things which are going to be inevitable in order to encourage that capex growth in the hospital space.
We chatted with the management of Apollo when we spoke to Ms. Reddy. She said, I think they've got a conversation, a dialogue lined up with the government to discuss these.
Post this? Post the
call just yesterday in the morning on Bazaar. So before the call. It was pre-conference call, but it was post the numbers.
Yeah. Okay. And they said that, in fact, they have 100,000 bed shortage in the country. So that is something where, the gap needs to be met somehow.
Okay, well, that's the Apollo story out there. And Natco is the other one, right? I think it's lower following a weak showing in the first quarter. Why don't we address this one as well? Ekta.
Well, yes, they do not have Revlimid generic anymore, and that's the reason why you're seeing the numbers come off. So the revenue is down 44%, the EBITDA is down 67%, margins have come in at 25.4% versus 17% Q-on-Q and 43% on a year-on-year basis, and the profit has come in at around 206 odd crores. The API business 66.7 crores, so that's grown year-on-year. Domestic formulations has also grown on a year-on-year basis, but the key reason for the downtick is the international formulation aviation business, which is basically mainly the US, which is coming at 477 crores versus 1120 crores. The crop sciences business is an interesting diversification that they took a couple of years ago, and that's generated around close to 41 crores in terms of sales.
Okay, all right, got that. Thanks a lot for that, Ekta. Well, Dilip, we discussed quite a few stocks right now. Anything on your list? Do you have a view on any of these names?
So I think if you're talking about Natco Pharma, I think it has been pretty inconsistent in terms of its performance over the last couple of years, without any doubt. And there is no visibility as such in terms of how the things are going to pan out. No wonder that the stock really doesn't go up at all. Though I personally own this stock and I like it very much, but been pretty disappointed with this particular one. And this is not something which I would recommend anybody to buy from the current levels. Maybe one should wait and watch. But otherwise, if I will say that in the pharma space, I think pharma stocks continue to do pretty well. Maybe in the front line, I will still look at Lupin. I will still look at Divi's. I think even the mid-cap farmers have done pretty well, whether it is Venus, whether it is Orchid. I think all of them have done pretty well. So all in all, I think the pharma space continues to look pretty interesting, pretty strong, and pretty consistent over the last 2 years, and promising to do that over the next 1 or 2 years too.
Got that. So that's, since we are on the subject of pharma and we've spoken about Polo and we've spoken about other hospitals and Natco, etc. One name which I've not been able to figure out is this company called MediAssist, and I think we've spoken about this in the past as well. It's a TPA, basically sits between the insured and the hospital, and it's a market leader. Number one player, no competition. It's gobbled up the second largest player, which is Paramount, but absolute, dud of a stock, not done anything. And in a way, can you really call this a platform stock? Maybe at some level, but not really. But there are shades of, it being like a platform entity. But maybe the idea would be to invite the management and ask them what's happening. We used to speak with them, post the numbers, but I'm not sure if we've done so after Q1 results. Have you looked at this one, Dilip, at all? MediAssist?
No, not really. Haven't really.
That's the problem. That's why the stock is where it is at, because you've not looked at it, and I don't think many have either. But anyway, as I said, we'll try and invite the management. Yeah.
But I think the stock is where it is because you all are not part of management.
You've not looked at it and we've not spoken to the management. Anyway, we will do both, Dilip. We'll get the management on and then you look at it and we'll talk about it. Anyway, so the other big debate that we had this morning, of course, was this a conversation between large caps and mid and small caps. So earnings is, of course, the earnings momentum is all with small and mid caps. There's no doubt about it. And we had those numbers, right? 30% earnings growth for the small cap space, which Gautam said. And of course, the Nifty earnings growth has been about 15%. There's a big divergence. But, valuations are quite high in that mid and small cap space relative to where large caps are trading. And so we actually had two views come through today. And both on the institutional side, but why don't we take it with Mangalam first to break it down? Mangalam, take it away.
Well, that's correct. Divergence of opinion is what makes a market, right? And today we got both of them. Surprisingly, on the same day, in the same, within a span of 2 hours or so, first we had Motilal Oswal's Gautam Dugar, who said that obviously the earnings momentum is with the mid and small caps, and as a result of which we've seen over 30% earnings growth in the first quarter small cap earnings. Add to that, not only this, they believe that this is likely to continue. It's the beginning of the acceleration of earnings in the small and mid caps, and which is why they've increased their position size towards mid cap by about 700 basis points. And they believe that the earnings acceleration, which broadens out from large caps to small caps, is the theme that they are extremely bullish on. The same time, within an hour or two, we had Chintan Haria joining in from ICICI Pru AMC. He said that their thesis is overweight large caps. Why is that? Because large caps' current contribution of 57% has withstood a lot of challenges, including the mass exodus of FII selling and a lot of low earnings growth. At the same time, this 57% mark is at a 21-year low when it comes to large caps contribution. And mid caps, which is 43% owned right now, is consensus call, right? So if that changes, if there are redemptions, then that narrow exit door could provide a bigger gash as well. So they're contrarian, and their belief is that large caps right now are under-owned, undervalued, and performed as well. So these three are the troika that makes for them to mean revert and outperform from here on as well. So that's their key driver here. So divergence of opinion makes a market. One believes that earnings growth in the mid and small cap space is increasing and going to accelerate, which is why more capital chasing that. The other believes that because they are under-owned, undervalued, and having underperformed, along with the fact that their over-ownership right now is at a 21-year low, it tells you that maybe if there was mean reversion, you back that.
Thank you very much for that. Let's listen in to both the opinions.
3 years, we are seeing a turnaround in small cap earnings. We were expecting a 30% growth for full year, and the first quarter has given us that confidence that the full year can be met. The first quarter small cap earnings, and we cover a very vast numbers. We have 180 small cap companies under our coverage. They have delivered 32% earnings growth.
Wow.
We're expecting to end the year on small cap with 30%, mid cap with 22% now, and large cap with 15%. Nifty will see 15% growth after 3 years.
Logic suggests that we should be overweight large caps. If you look at valuation-wise, we are at less than 10-year valuations in large cap. The flows have been strong in mid and small cap. There has been no major seller in mid and small cap as such. At least in large caps, you had FIs who were selling, who also in July have been buyers in India in general. We've seen tech, outperform, and foreigners have been buying in tech in the last few weeks. And in general, if you look at large cap as a percentage of total market cap in India, I mean, it's surprise, but we are at probably our highest market cap at 490 lakh crores. But that doesn't seem to be the kind of flavor in terms of what returns people have made. Purely because, one, a lot of new issues have come which adds to the market cap. But also large caps have underperformed massively. Today, the contribution of large caps in India is 57%, which is at least the lowest that I have seen in my 21-year history in the markets. And that is to do a lot with the fact that large caps have been forgotten, as shown by the fact that for the first time in 3 years, we've seen outflows in large cap mutual funds. It's also a good indicator of being contrarian.
Dilip, you want to weigh in on the debate? Will mid-cap, small caps, led by earnings recovery and strong earnings, continue with the momentum, or it's time for large caps to make a comeback?
So what I would say over here is that as far as the big caps are concerned, I would say one headline statement which I would like to make is the sheen or the USP some of the large caps had for the FIs, I think they have gone. The sheen is gone. I mean, that's what it may sound pretty strong, but the sheen is gone. Whether it is HDFC Bank, whether it is IT sector or the leaders in the IT sector, they were considered to be some of the banks with the world-class comparable parameters. I think somewhere those parameters have got considerably diluted against the Indian top companies. And in a way, they are very well owned by FIIs. Now, the question comes is that the real performance is there in the mid cap and the small cap. The caveat over here, as what I would always say, is that a lot of mid caps in the aerospace, whether it's in the defense, I think all of them are doing pretty well. Their top line is growing, their profitability is growing. But I think the balance sheet certainly doesn't look very interesting. I think that is where the challenge would come. In the balance sheet, if you were to look at the cash flow from operations, or if you look at something like the inventories and receivables and stack it up against the top line, I think it's a lot more worrying. So I think whereas the interest and the performance is coming in the mid cap and the small cap, one has to be very careful what you're buying at these levels, because some of these mid cap and small caps are pretty expensive and at exorbitant valuations.
Okay, got that. We will, we'll take a leave. Dilip, thank you very much for joining us. Good conversation as always. Come back and get you more market opinion and coverage as well. Stay tuned. Okay, welcome back. I think the markets, are still there. I mean, kind of subdued, tepid, not very much by way of action. So 15 points, by the way, just 15 points lower, 24,380 coming through. We have Mithun Aswath, Managing Partner, Kiva Advisors, joining in. Mithun, good to have you with us here. Thanks for joining in. We had Gautam and Rajat from Motilal Oswal with us in the morning as their conference kicks off. And I mean, there was a full earnings discussion, and Gautam lay out the numbers for us, which I'm sure you're well aware. Numbers have been pretty strong, especially in the smaller companies list. But one data point he addressed, Mithun, is the fact that, the one thing missing, of course, is foreign flows, right? And quite startling that over the last 10 years, according to them, the net foreign inflow into the market here in India is actually zero. Some 69 billion in, 69 billion out. Between primary and secondary. So just, I don't know if you have any thoughts there. I mean, Gautam and Rajat's point was that, that'll be the additional kicker whenever that turn happens. We don't know when.
Yeah, sorry, Prashant. I think bad line here, but I think you mentioned about the earnings growth for the small cap sector.
Sorry, yes.
I think,
No, can you hear me, Mithun? Better? No.
Yes, I can hear you.
Okay, my question was, look, earnings have been pretty strong, but the gentleman in the morning with us from Motilal were pointing out that the additional kicker will essentially come in when the foreign flows start to turn, and we don't know at what point will that happen. The data point which really which stood out was that over the last 10 years, net flow from foreigners into the market here is essentially next to nothing, close to zero. That's very, very startling, isn't it?
Yeah, I think having said that, Prashant, if you just look at the last 3 or 4 months, there have been a lot of specific stocks which have performed. And I think these are the pockets where maybe there is under ownership. There's a lot of action beyond the Nifty and the large caps. And I think you need to really, do bottom-up investing. There are opportunities galore if you are able to go and look at the companies beyond the top 100 companies. There are several, I think, the whole mid-cap and small-cap space itself this quarter has grown earnings between 20 to 30%. So I think that's where the action is. And that's where I think the domestic individual investors, the HNIs, as well as the family offices, as well as the mutual funds are gravitating their attention towards, because that's where the growth has been. Having said that, the valuations in the large caps do look very attractive. But is there growth across the large cap universe? That may not be actually true.
Mithun, stay on. We just want to put some data out there in terms of the FI outflows. For the last 10 years, we've pretty much seen zero inflow. Sudarshan has compiled the details year after year, and he joins in with the analysis.
So will you believe if I say FIs have put almost no money into Indian equities in the past 10 years? Well, you do or not, the answer is big yes. Here is what the last 10-year data from 2026, from 2016, September 2016 to August 2026 says. Now, from September 2016 to December 2024, that's 100 months, and FIs have pumped nearly $46 billion into Indian markets. And in the next 19 months, that is from January 2025 to July 2026, that entire $46 billion has been withdrawn. So net-net, no inflows. Some silver lining though, the last 2 weeks of August have seen the inflows of nearly $2 billion. Now let's break that flows data year-wise and the events that likely to have played a major role. In the second half of 2016, the rate hike by US Federal Reserve and the liquidity shock led to outflows of nearly $3 billion. Now breaking the year-wise flows in 2017, emerging market basket had seen a major rally. MSCI emerging market had surged nearly 38% against 11% in 2016. And because of this, Indian market too saw inflows of nearly $8 billion. But nearly 50% of 2017 inflows got reversed in 2018 as crude oil surge weighed on emerging markets. But come to 2019, Modi government came back to power for the second term and the government announced cut in corporate tax rates. And we closed the year with inflows of more than $14 billion. But 2020 was a different year. We started the year with COVID fear and had seen continued market fall in the beginning of the year. But no one had expected that recovery would be much sharper. And the recovery was so sharp that we at the end saw inflows of $23 billion. In 2021, we saw recovery even in global economies. Global GDP had recorded growth of almost 6% against contraction of 3 to 4% seen in 2020. And in process, we saw inflows of nearly $4 billion. In 2022, global inflation shock driven by pandemic supply chain snarls and the war in Ukraine forced the US Fed into its most aggressive monetary tightening cycle in decades, raising interest rates from near 0 to 4.5%, and US consumer prices hit 40-year high of 9.1%. And the impact we felt here too. FI outflows of more than $16 billion. But it didn't take much time to reverse those outflows. Very next year, FIs have gone all gung-ho on Indian equities as just a year ahead of election, government too went aggressive on capex front by announcing an increase of almost 33%. And the result? FI inflows of nearly $21 billion. In 2024, Indian equity market hit record highs in September, driven by strong retail momentum. But shortly after, October 2024 marked an unprecedented reversal with a record-shattering FI net outflow of over $11 billion. But we managed to end the year with minor inflow of $0.1 billion. Now, FI outflows starting in October 2024 continued till recently, and that led to total outflows of $46 billion till July 2026, nearly $19 billion in 2025, and more than $27 billion in first 7 months of 2026. But if there are some positives, it's the last 2 weeks. FIs have infused nearly $2 billion in August so far. So the key question now, does August mark the beginning of a sustained return of foreign capital or just a temporary pause in a broader global reallocation? We'll better wait for a few months before reaching to any conclusion.
What a lovely link, Sudarshan. Takes you back. You end up forgetting what happened in 2017, 2018. So thank you for recapping that so beautifully. Mithun, we spoke about the FI outflows. The other question that I had was on earnings. Now, FY25, FY26, we saw earnings downgrades. But in Q1, we've actually seen more upgrades than downgrades. Do you think we could be potentially at the start of an earnings upgrade cycle, or do you think the worst of the downgrades is behind us?
Yeah, hi. I think, earnings expectations were anyway quite low coming into Q1. And we're likely to do double-digit earnings growth on the Nifty itself in this quarter. And Q2 and Q3 should be, reasonably good as well, considering we're coming into the festive season. So I think, just looking at valuations and, the large caps have not really performed, and you've not seen FI flows, I don't think we have too much of a risk of a large downside in the market, at least at the index level. While, I think the market, or at least individual investors and domestic institutions, will be focused on where the growth is. And I think that's where money is getting gravitated towards.
Mithun, you always give us one stock, one new idea. What is it for today?
Yeah, hi, Rima. I think over the last few weeks, we've come with an idea on a beaten down space, which is a QSR space. There was one company where there was a little bit of a corporate action where there's been a change in the promoter, a company called Restaurant Brands Asia. They basically run the Burger King franchise in India, as well as they have some presence in Indonesia as well. So there is a new promoter, basically the family office of the Ajanta family group, Ajanta Pharma. Basically, the son has taken over this business. He has got some experience in the QSR space. The company is called Lenexis Foodworks, where he runs the Chinese Wok franchise of restaurants. I think at those levels of around 70 rupees, I think the company was looking quite attractive. And the first quarter results have been quite good. They've had record, same-store sales growth of over 12%. and they've guided for good traction in the rest of the year as well. So this is something that we think there's been a fresh infusion of capital. There could be even some more restructuring in terms of their operations, and it's an interesting bet where they continue to add close to about 80 restaurants every year on the domestic side.
Got it. All right, Mithun, we appreciate you joining in and giving us that view. As you said, yes, the stock from 70 has moved very, very swiftly to around 98. All of this in a matter of around 20 days, I think so. Just pull up the last, I think, 15 days or chart, and that'll tell you the picture. But thanks a lot, Mithun, for joining in. Wishing you a good Friday and a solid weekend ahead as well. Quick check on the F&O market. Then, well, in today's trading session, if you look at the couple of strikes, it appears the buy zone now has become this 24,250 to around 24,300. Last few trading sessions, we visit there and we see a bit of a bounce, and today as well was no different. Now, the premium out there actually has, come down to around 47 rupees or thereabouts. That's from around 63 rupees approximately. So I think we should get that up for you. The 24,400 call, the premium out there, well, it's holding at around 100 rupees. So it appears there is a fair bit of writing at both those two strikes. So in the near term, we continue to remain in this range, close to around 20 as well as 200 DMA on the Nifty itself. Yeah, now the correct strikes have come up for you. There is some writing that is seen at that particular level. So the 24,500, 24,550, that becomes the first level of resistance. And then all eyes are on the 200 DMA, which is ballpark around 24,750. Reference point on the downside, you don't want it to break, is around 24,250, which incidentally is the recent lower as well. Individual stocks that I'm looking at, Voltas, that's seeing fresh buying actually in today's trading session. So interesting move is what we're seeing out there. Vodafone Idea, for the last few trading sessions, it's quite a bit of long build-up, as well as there is, delivery-based buying. Now, in today's trade, it appears there is some shots that are getting squeezed out on that particular name. So we'll keep an eye on that. It appears the street believes promoter entity has some bit of liquidity that's coming in, and hopefully they get a part of that chunk. So explains why the shots are getting squeezed out. And the other one is solar industry is normally not very, very active in the F&O market. But today there are some shots that are getting into the system. And the stock made a low of around 19,500. And it appears some of those shots, if the stock can get back to its momentum, those shots would get squeezed out. So in terms of, number of contracts, not very, very large, but much larger than what we've seen in the last many trading sessions. So keep an eye out on that name as well. Time to slip in a short break though. As always, technical expert is waiting for us on the other side. Welcome back. Well, a couple of stocks actually that have come off the highs of the day is Bharat Dynamics. I recall the stock was up close to 3%. It's seen some kind of profit taking from the top in reaction to its numbers. So keep an eye out on that particular name. But Mitesh Thakkar is back with us. Mitesh, help us out with a fresh trade.
Yeah. So I'll take one BTST and one STBT. On the BTST side is BPCL bouncing back from all its averages. Buy with the stop at 315 for a target of 323. CAMS is broken down. That's for STBT with a stop at about 770 for target of 745.
Okay, thank you very much for that. One more stock that we'd like to highlight is Galaxy Surfactants. Now, came out with the Q1 numbers, strong numbers. Revenue growth 38%, margins expanded, drove a doubling of the bottom line. So we had a chat with the company earlier. We asked them that after such a strong Q1 performance, what's the outlook on the margins going ahead? Will they raise the EBITDA guidance? And this is what the management had to tell us.
With regard to guidance, I would look at a 6 to 8% volume growth guidance for the full year, and the EBITDA per metric ton, we're increasing the guidance for this year to 24,000 to 25,000 per metric ton for the full year.
Well, so that is a guidance raise. Earlier, they were talking about 19,000 to 21,000. Now they're saying 24 to 25,000. So in Q1, it was 35,000. So it will normalize compared to the Q1 levels, but it's still higher than what they began the year with. And one of the key things is the Africa, Middle East, Egypt, Turkey region seems to be turning around and improving on a quarter-on-quarter basis. So that's been locked in an upper circuit of about 20%. But also strong numbers coming in from LG Electronics here. It's the premium end of their business, whether it's in home electronics or even in terms of TVs, refrigerators, all doing very well. We had a chat with Sanjay Chitkara of, on the Q2 performance, what the outlook for Q2 is going to be, and exports. Listen in.
So far, it is in line with, or in fact, I can say it's better than what we performed in Q1. And if you remember, last year we had a troubled Q2. This year the things are better. GST completely rolled out, products affordability has improved, and best thing is this year Diwali is in November month, and we have seen last year it was in October month, and we have seen whenever Diwali is delayed, we get a much bigger window for our sellout. So we are very confident that we will outperform our guidance. Export is moving in right direction, and in Q1 we registered around 30% growth. And when we did our IPO, we were exporting to 47 countries. Now we are doing export to 65 countries. And once our new plant in Shri City that will be operational, we will further expand our export because we will have more capacities.
Okay, we also had a rarely seen management with us in the morning. Page Industries, after they reported a strong first quarter, we had the CFO with us and basically talking about the confident of maintaining the EBITDA margin between 19-21%. A fair bit of commentary around the athleisure segment as well, which is where they're focused on in terms of marketing spends and more. Listen in.
While we did see a bit of an increase in input costs, especially cotton and all petroleum-based products in the mid of Q1, things are improving. And if the Middle East situation remains as it is now, we think that the input costs will remain at the same level. So we are fairly confident that the EBITDA margins of 19 to 21% will be retained for the entire year. We don't exactly share the category-wise numbers, but we are definitely seeing a very good growth as far as athleisure is concerned.
Sudeep Bandyopadhyay is now joining in on the show. Sudeep, Page Industries is a stock which hasn't done too much. Even in terms of earnings, they're losing market share. Do you think it can turn the corner? Can it make strong inroads in the athleisure space?
It's a good company, that much I will tell you. And yes, there's been too much of competition in that segment recently, and that's why probably they have lost a bit of market share. Performance also hasn't been great, but it's a very strong company with strong brand recall across the world. Unfortunately, the trade ties with US haven't been anything great. The US trade agreement hasn't happened yet. And one is not sure when it's going to happen. That would definitely help Page Industries significantly. But in any case, I think the UK and UK and EU trade agreements will help Page Industries going forward. Fundamentally, it's a strong company. It's going to give the investors return over a long period of time. But at this stage, I think one has to wait before I think things can start turning around and showing exceptional numbers. So for me, I think it's an avoid at this stage. But from long-term investors who are already invested, they can remain there.
Got it. Okay. All right. Any view, Sudeep, on solar industries? Fantastic start to the year. I was looking at a Goldman Sachs note. They are working with 2,300 crores of PAT for the year. In the first quarter, they've done 650 crores. So the run rate is already ahead. But the management is saying, for now, we're not revising our guidance. They're sticking to that 14,000 crores of revenues overall and 4,500 crores of defense. What is your view on them? They've been very, very good executors, but the stock is fairly expensive. It's not giving any big dip.
That's the only issue, Nigel. I think it's a fantastic company. Management has delivered, really delivered, like what we normally don't see. It came from out of nowhere, and from backgrounds of the promoters was different, and they created a fantastic company. And they have now beaten pretty much everybody who was in this space earlier. I think the growth potential is significant. They are, the kind of work they're doing is phenomenal. And the only challenge is the valuation of the stock, which I think you also mentioned. But even now, I would say from a long-term point of view, if an investor is willing to wait for 1 year plus, he can enter solar even at current levels.
Got it. Okay. All right. Solar industries, 12 months up more than 30% after compounding, for many, many years. Any view on Sudarshan Chemicals? They had their results that came out yesterday. Then there was a presentation that came out in the evening. And this morning there was a con call. The stock was actually in the red. Suddenly it spiked up. You have a view on them? They've gone ahead, taken that big bite inorganic growth. And the street is a little bit skeptical about them turning around. But it seems commentary as well is good. Your view?
Management commentary was very good. I think that's what the market liked, and that's why the stock spiked today. I think the consolidation will be the key. How they go ahead and digest what they have acquired will be the key to the future. The market is believing the commentary of the management, and for the time being, giving them a thumbs up. And I would also tend to go with that. The space in which they are operating has a lot of traction. The environment is conducive for their business. So I would go with a buy on Sudarshan Chemicals. May not be immediately, but keep an eye. And if there is a dip again, I think it will be good to buy.
Yeah, but big spike actually, as Nigel pointed out. Started at about 140 or so. Was at about $1,040 at about 1120 right now. So I think the management likes what it heard. That's the spike up that we're talking about. By the way, the cash session is back, and the cash. You can punch in the orders in the cash session starting in about a minute or so. 3:20 is when that will start, and it goes on till about 3:28. So that, of course, there's no expiry today. So I guess the options side of the things will continue. Unchanged or at least unaffected by what's happening on the cash side. Yesterday was pretty consequential because you opened up you left off at 315 at a certain value, and then suddenly the rate which you saw was 200 points higher on the Sensex, and it was the Sensex weekly options expiry. So option prices did actually go a little haywire in many cases. So that is the activity which, people like Anant Narayan have spoken with him on the program, and they were kind of sort of talking about the fact that India being the few markets where open interest keeps rising into expiry days. In the last 15 minutes or so. So people are essentially taking, just a bet, one way or the other. It goes right, otherwise it's zero. Those kind of, that kind of bets are being taken. And the aim, according to Anand when he was on the program, was that all this will go away. We wanted, in a way, it's not the first aim why cash has been introduced, but if it is discouraged, why not? But I think it may not be encouraging that kind of behavior, but it certainly is leading to big swings on option prices on expiry days, on both, of course, on Tuesdays and Thursdays as well. And yesterday, of course, was what happened as far as Sensex weekly expiry is concerned. Well, just to take a quick look at what else is going on with regards to the broader market today. By the way, LG, any thoughts? LG Electronics, it's almost a 10% pop now. LG Electronics. Sudeep?
No, I do like the stock at current levels, Prashant. In fact, I think the management also talked about it. Whenever the Diwali gets delayed, I think it helps these consumer durable companies. And I'm reasonably confident that the way the consumption is picking up and the expectation of consumption picking up even more during the festive season, LG will be one of the beneficiaries. They have a wide basket of products and they are very well positioned to take benefit of increase in consumer durable spending. So LG Electronics, definitely a buy at current levels.
All right. Sudeep, I'm not sure whether you're tracking this one, but Tega Industries, they came out with a set of numbers yesterday. First look at it, there was a big one-off below the operating line, and there was a net loss that came in there. But on closer look, operating performance seemed okay, and that's why the stock saw a big recovery. A sniff that I get is probably there is maybe another round of fund infusion that could be coming. We'll know about that, I guess, in the next few trading sessions. But from yesterday's low, we've seen a sharp recovery. What's your view? I recall they did that fund infusion at around 1,950 to around 2,000 rupees. This is another company that went to bite big in the global markets, and they've taken on some inorganic growth. Your view at around 1,700 rupees?
Well, I definitely think a round of fund infusion will do wonders for them. I think the balance sheet is probably a bit stretched at this stage, and the market will appreciate some fund infusion. Also, I think whenever a company tries to grow through acquisition, the trick lies in how well they consolidate the acquired companies into their core activities and enhance the overall pie. I think that's something which the company needs to do well going forward as well, and raise money continuously to ensure that there is no strain on the balance sheet.
Got it. Interesting to see whether or not that comes through, whether there is a fund infusion on the cards. Sudeep, stay with us for the time being. We'll slip into a short break. Sudeep continues his chat with us on the other side. Welcome back. Well, we're still in conversation with Sudeep. Sudeep, I wanted to ask you about this one. Risky, but I don't know. Those who have their appetite can make good money, I guess. Vodafone Idea. What the promoter entity has done over the last few days is that they've introduced a royalty. So 225 crores multiplied by, say, four entities. So they are close to around 900 crores or thereabouts. And then they sold a small percentage, Pilani Investments, in Ultratech. The street seems to be hoping that something could happen in Vodafone and some kind of oxygen comes in. What's your view on Vodafone Idea? The stock is seeing some buying actually the last few days. Now a 14 rupee stock.
Well, Nigel, I think after many years, I have become slightly positive, marginally positive on Vodafone. There are a couple of reasons. If you look at the entire challenge in Vodafone, number one was, of course, capital, and it still remains capital. But there was another big problem in Vodafone Idea, the way I look at it, was operational performance. They have been consistently losing customers month on month, quarter on quarter. Now is the first time after many, many years where they have started gaining customers, and actually they reversed the negative cycle, that is customer loss every month. So this is a very, very good trend, and I'm becoming positive on the stock because of this. Now the capital, I'm sure if the trend operationally is good and the Birla Group starts taking interest, capital will come and it should not be a problem. Also, the kind of relief provided by the government has. There are still more issues, still more challenges, still more funding required to ensure the 5G network is up and live fully to compete with the likes of Airtel as well as Reliance Jio. But I think it's possible and it's doable, provided operationally they keep improving. And that's where the focus should be. I think that's happening finally. And I am definitely positive now at this stage. Not hugely positive, but one can start biting into Vodafone Idea at these levels.
Okay, all right. Sudeep, we thank you. Have a good Friday evening, good weekend. Catch up next week, Sudeep.
Sure, thank you.
All right, well, time to wind down the markets then for you. We wait by, I think we are almost getting that final rate. I think we entered the CAS session with a 41-point downtick on the Nifty. I think we're ending with a 29-point downtick. So I don't think there's been too much of a move out there, which is good. You want some stability. For the time being, let's do a quick wrap on all the stocks that were bombing around in today's trading session. Vodafone Idea was up close to around 4.5%. So good move is what we saw there. Oracle was up as well, close to around 4.5%. So from the broader markets, both those two stocks stood out. Apollo Hospitals, what a dream performer, right? People thought it was expensive at around 6,000 rupees. It's on the verge of being a 9,000 rupee stock, so that continues to move from strength to strength. Jubilant Foodworks, well, it was biting in today. That stock, in fact, ended higher with a good gain in trade today. On the flip side, Nalco. Eleanor said that they're going to be, Nox Hydro said that Eleanor facility is going to be under, some kind of lower production. Well, in a few days, they've got the required gas and they're ramping up production again. So the shortage of alumina will not be there. So Nalco got hit. HPCL as well was down. Tata Motors PV as well was down, and Ashok Leyland as well was down in trade. The other stocks that in fact did pretty well in today's trading session, Sudarshan Chemicals, con-call numbers, con-call details it seems the street liked, so that stock took out. Apex Frozen Foods was up more than 15%, so super going out there. And Honasa going from strength to strength. I think in the last few months the stock is up 70-80%. So solid move out there. Wellspun Living, the numbers are good, but the stock came off from the top. Saman Capital came in for profit taking actually. The stock was down close to around 6%. And Vedanta Iron and Steel, my colleague Yash had broken that probably the promoter entity could be interested in creeping in. Stock has been moving from circuit to circuit. Today was the day of the lower circuit, but valuation-wise, there appears there is some comfort out there. And Ola was lower in trade as well. As you can see to the bottom of your screen, not too much fluctuation in the CAS session, which is good news. Well, on that note, I'll tell you what, we'll wrap up on this edition of Closing Bell. The team on Editors Roundtable is waiting for you on the other side.
The Nifty snaps a 2-week winning streak with the Nifty and the Sensex ending 1% lower. Metals, FMCG, auto stocks lead the losses. More than 35 Nifty stocks end the week in the red. On today's show on Editors Roundtable, we'll decode the action on Dalal Street. We'll put the spotlight on the Q1 earnings season. Joining us on the show today, and hello and welcome to Editors Roundtable. I am Reema Tendulkar. With me are Nimesh, Nigel and Prashant. And here with us in the studio is also Lalit Kumar, Senior Fund Manager at ICICI Prudential AMC. Guys, finally, Friday and the earnings season is behind us.
Oh, finally. Yeah, I mean, it's a long season, right? But I think the good part is it's a very strong earnings season. I think you'll put out the spotlight on that. But whatever feedback we got across the board, especially the broader market companies, have done a very good job in terms of reporting earnings. So I guess it just sets the tone for maybe the next 2-3 quarters in terms of earnings and in terms of market performance as well.
Well, as they say, right, what drives the markets is earnings and earnings. So, or earnings, I thought it's good, right?
Lalit is first time on the program. Lalit, welcome to the program. Thank you very much.
Thank you so
much. I mean, you know, you run a bunch of funds. So why don't you run us through, since this is the first time for you, I think on Editors Roundtable and I think also on the channel, right?
Yeah, you first time on the media.
I mean, you run the commodities fund, which I think has done phenomenally well at ICICI Pru. There's a mid-cap fund. There is a multi-cap fund. So
and the long and mid-cap fund.
What's the focus like? I mean, just give us a broad sense of what you look at ICICI.
At ICICI, you know, I have privilege of managing these funds. And also many more funds that I have managed past, like business cycle, manufacturing. So pretty good experience of running diverse categories of fund and themes as well.
What are you? Is your heart in commodities? But is commodities?
Yeah, that's a fund that I have been managing quite long. So,
and it's done very well, I believe, as well.
Yeah.
I think I was looking last 1 year returns are almost 17-18% or so. Last 1 year?
But that's a category. Last 3 year CAGR would be what? More than 45-50%?
Yeah, so that's a fund, that's a category which has done much better than the broader market.
Yeah,
so
absolutely.
that's a alpha generation category of fund, I will say.
But is commodities like one of the things you manage, or is that something you really are passionate about?
I am passionate about commodities.
About commodities, okay. I just wanted to get that.
Take it over.
No, so let's get to the chase then. You know, congratulations on the good performance. But our viewers will be asking, Lalit, from here, what is going to do well? So let's break it up first into the ferrous and non-ferrous space, right? I mean, you have arguments on both the sides, both bearish and bullish, and between the two. So as of now, what are you more bullish on, the ferrous space or the non-ferrous space?
So I think from here on, while I'm positive on both of them, but ferrous is better placed. I think their EBITDA per ton for most of these companies structurally has gone up.
Correct.
Right. Cyclically also it will improve, but structurally what we saw in last decade, that is 2010 to 2020, I think this decade they will have much higher EBITDA per ton on a mid-cycle basis. And their capex per ton, because most of these companies are doing brownfield expansion, so their capex per ton will be low.
Correct.
Effectively, their incremental ROC will be high. They will have a very strong earnings growth, and that's why they are getting re-rated.
And as you spoke about that period 2010 till today, their balance sheets is in beautiful shape, you know, in comparison even to 2015-16. So let's drill it a little more, guys, just a little bit.
I can understand your passion for metals.
So on ferrous, you know, you like ferrous more. Will you be leaning more towards the long side or the flat side? The reason I ask you this is the difference between longs as well as flats, it has gone to around 11-12,000. That's the highest we've seen in, you know, many months or maybe a couple of years as well. And that's gradually going to narrow. Now we know it's a seasonally weak quarter. But normally post the monsoon, you'll see those price increases start and you'll have construction activity as well that'll come up. Will you be tilting more towards longs that have underperformed till now?
Nigel, okay, for me, just explain me what is long cycle.
So longs basically
steel you mean steel?
So yeah, steel. So there are long steel which is used basically in construction activity, infra, etc. And then you have flat steel that is used in appliances, in cars, autos, etc. Now the thing is that long steel prices have corrected drastically and flat didn't correct so much. So the gap between the two had widened so much. Now that's expected to gradually narrow. So the question to Lalit is that post the monsoon season, long prices in all probability will start moving up. So if that is the case, are you leaning more towards longs, or will you go in for flats still, you know, which has actually outperformed longs year to date at least?
So in commodities, it's very important to be counter-cyclical.
Yeah.
So anything which has corrected or prices have gone down, that is where I think I will bet on.
Longs.
So long at this point in time is preferred because long prices will, I think, go up. And long steel stocks will do better than flat.
And, and you know, just to tell our viewers, the companies over here among the larger names who are more tilted towards longs will be a JSPL or SAIL as well. JSPL more than the others. Sure. Yeah.
But just one thing on the when you start look at the entire cycle, and it's a cycle, right?
Yeah.
You would agree. Where are we in that cycle? Are we?
That's exactly my point. From a
Early,
global
middle? We are. Because as you said, you buy these things when they are cheap, and you know extremes basically, right? I mean, they go to extremes all the time. So where are we?
So we are still below mid-cycle. And some of the facts to look at it, say for example, 2015 was the bottom of the cycle for steel. That point in time, China's steel export was at around 120 million ton. Their current export run rate is around similar number, 110, 120 million ton. Chinese steel companies, their EBITDA per ton is still below mid-cycle. And that's a difference that in spite of below mid-cycle, still Indian steel companies, even if you look at Q1 result, their EBITDA per ton was much higher than what they made in 2015.
Yes.
So that's why we think that structurally their EBITDA per ton has gone up, their capex per ton has gone down, and that's why they are going to make very good.
When you say mid-cycle, we're in the mid-cycle in commodities. How many more how many more years you feel this rally can continue?
So that I think is also dependent on what happens as far as global demand is concerned, what happens on China policy. So there are a lot of macro variables, so one has to keep track of it, and then whenever that cycle we think that has peaked out, then that's the time then one should get out.
And what are the broad markers to know when it peaks out?
When the most inefficient steel company is making profit, that's the time to get out of it.
Oh, okay.
Yeah. And in India, which stock would that be? If
I think Indian companies will have much better than that. But I think it's better to keep track of what is happening globally. So globally, most inefficient steel companies, when they start to make profit, that's the time.
I'll tell you in the break, Reema. You know which one that is. Because I'm sure Lalit also has those compliance issues.
I know it.
But we'll revisit commodities.
Just one thing, Nigel. I want to just finish that point. In your fund, and we move away from commodities. You own some global names as well, right? In the commodities fund. So are those mining companies? Are those? I mean.
So they are mining companies. They are into copper and uranium.
Okay. So those are, and I think that you own them across your funds. I mean,
no, that's only in commodities fund.
In the commodities fund. Got it. I think first quarter earnings, Reema.
First quarter earnings, and this is data that we've sourced from Motilal Oswal because they're one of the widest coverages. So this is data as per 369 stocks that Motilal Oswal covers, and it's ex-OMC. So if you add OMC's 372 companies. So this is data for 369 companies. A revenue growth of 18%, higher than estimates of 15%, best in the last 14 quarter, and a bottom line growth of 22%, again ahead of estimates of 15%. If you include the oil marketing companies, then 372 companies, then we've got an earnings growth of 11%. Their expectation was for minus 2%. And break it down, Nifty 18%, mid caps 25%, small caps about 31%. The other key takeaway, one, of course, it's a across the board broad-based beat, but the second one is the breadth of the beat. This time, a lot more companies have actually done better and seen upgrades. So they say out of the 369 companies, 207 have posted an earnings growth of more than 15%. Out of the 31 sectors, 20 of them have beaten expectations, 9 of them are in line. So only 2 have missed expectations out of 31. And 75% of the Motilal Oswal coverage universe have either met or beaten expectations. So this time we've seen some earnings upgrades, so 2% for the overall coverage universe and 0.6% in terms of the Nifty EPS. So they've upped the EPS estimates also for the full year. For the Nifty, they're now saying 15% earnings growth. And for next year, FY28 also, their estimate is we will see a 15% growth. Now this follows 2 years of subpar growth. So in FY25, the Nifty earnings growth was only 1%. In FY26, it was 5%. And this year, FY27, we could see a 15% earnings growth. That takes you to an EPS of 1,230, giving you a broad PE of 19.8 times. So Lalit, you can slice and dice the commodity earnings and tell us in that how it's been. But do you think these numbers can be extrapolated? This 15% earnings growth, is this what you all are working with at ICICI Pru for this year and next year?
So beauty of market, I think, is that market does not work in a linear way, and it also does not work on Excel. I think Q1 numbers have been very good across, but I will be a bit cautious in extrapolating these numbers, and the reason for that is, I think in Q1 there was a lot of inventory gain that happened, cost increase that is yet to reflect in the numbers. So that I think will gradually catch up in coming quarters. Even if you look at 2022, 2023, when oil prices went up, during that time also, say for example, cement sector, the earnings, oil price started to increase from January onwards. their actual cement companies EBITDA per ton bottomed out in September quarter. So there is always lead lag between increase in cost and fall in profitability. So I think Q1 will be too early to say that things are going to be good. We have to watch for Q2 and Q3 earnings. At the same time, some of the tailwinds that was there in Q1 earnings, say for example currency, base will start to catch up from Q3, Q4 onwards. So companies which are into export, their earnings, their growth will start to normalize. Some of the sectors which benefited from GST cut, for them base will start to catch up from Q3, Q4 onwards. So point is that at this point in time, it will be a bit early to extrapolate Q1 numbers.
You sound a bit cautious. What are you expecting in Q2, Q3 then?
I think growth will taper off from what we have seen in Q1 number. But at the same time, I think for markets, earnings is important. But at the same time, market will also be focused on what happens to oil, what happens to geopolitics, what happens to midterm elections. So these will be some of the other catalysts which actually market will...
since you brought up oil, and it's not a commodities question, one of the top holdings for you is HPCL.
Yeah.
So talk to us a little bit, what is the bet there with an OMC?
So if you look at oil price, say if I look at last 15-year history of oil, and that gives us a perspective that whenever there is extreme euphoria or extreme pessimism, that does not sustain in commodities market and in oil market as well. Look at 2014, oil price did correct to $30-35, but it did not sustain. That was extreme pessimism. 2018, oil price rallied from $55 to $85. That also did not sustain. 2020, oil price corrected. There was a day when oil price went to negative. That did not sustain. That was also extreme.
Correct.
2022, that oil price went to $120, $130 because of geopolitics. That also did not sustain. And now we are in the next catalyst where because of geopolitics, oil prices have gone up. So point is that whenever oil price goes to extreme, as a contrarian, as a counter-cyclical investor, we prefer to take a contra bet. So when oil is at extreme peak, we'll prefer to play downstream. When oil is at extreme bottom, we'll prefer to buy upstream. And that's the context that I think that we will be constructive on downstream companies rather than upstream companies.
Sure. I think bit of Naren's shadow to come into your investment style. But I think you've over the years, the fact that you manage the business cycle fund, that give you a lot of experience of managing the cycles and identifying the cycles.
Yes.
From here, if I want to ask you 2 or 3 cycles which you feel can be the next cycle to sustain for next, say, 3 years, 5 years, what would be those? I believe textile is one that you are very bullish on. But broadly, if you can explain 2, 3 themes which you are very bullish on from a cycle perspective.
Sure. So,
okay, first start with textile. Why you like textile and what is the thesis there?
Yeah, so textile, I think this is a sector which will do pretty well because a lot of steps have been, because of this geopolitics, I think a lot of steps have been taken by government to make sure that our textile export does pretty well. Textile is one of the big sectors as far as employment is concerned. It can be pretty big for us to earn foreign reserve, and that's why there's a lot of focus by government to promote export for textile sector. India has signed a lot of FTAs, and that basically gives longevity of growth for these companies. And in any sector, any company where longevity of growth actually keeps on increasing, generally those companies, they do well, they get re-rated. So I think this is a sector where...
So in textile, it's a sector bet that every company will do well, or even there you'll have to cherry-pick.
So I think garment-based companies, they will be better positioned because they are the ones who will be exporting it and can have better pricing power.
So your Gokul Das, your those kind of names basically.
Gokul Das, KPR Mills, or whatever, like those kind of names.
Companies which are into garment export.
The apparel exporters.
Yeah.
And to the other question which Nimesh asked, which is in terms of, apart from textiles, which are the other sort of, cycles or themes which are set up in a nice way that will do well from here?
So I think manufacturers, particularly companies which are into export, I think they are going to do very well.
Manufacturing exports?
Yeah. And that is because I think, currency is a big advantage as far as India is concerned. Geopolitics is second tailwind for the sector. And I think most of the companies in India which are into manufacturing and export, they are trying to diversify and get into new categories.
Correct.
Right? Effectively, that means that they will have much better outlook for growth.
So all the auto ancillaries who are getting into different business, like the Bharat Forge is getting into defense,
I think there is Sona BLW, which
Samvarna Motherson is looking at expanding the non-auto business, so to speak. So those kind of businesses you feel will do well.
Yeah, so companies which are into export, diversifying into new categories, trying to do JV and get access to technologies, I think those companies will do very well from a long-term perspective.
But
how are they priced, Lalit?
Yeah, so that was my point. In terms of counter argument, the fact that many of these manufacturing companies are trading at 50, 60, 70 times 1 year, 2 year forward earnings. How do you get conviction on those names? Like what should be the
He's bought them very early, Nimesh, so he has.
But he'll sell also, right? My idea is you're not going to just buy and sit on it. Maybe he'll sell also. So from that perspective, though it's a big cycle, where do you get cautious?
So if we
or you need to be cautious at this point in time in those names.
If we can identify companies where earnings growth is going to accelerate, where consensus is yet to factor in that opportunity, those are companies that will do well. Because
so in those companies, you believe you should not look out for valuations. You should
because in those companies, if consensus estimate is underestimated, then those stocks will look expensive.
Sure.
As in when consensus earnings estimate, they go up, then I think that, that's a time to be cautious on that company.
And with the disclosure, can you tell us the ones which are in your portfolio, some may have been priced rightly by the market. Where is it that you think there is still?
We cannot discuss on stocks. But happy to discuss.
But the portfolio is available.
Some hints are coming on the screen for
us. Yeah, some of the Sona BLWs of the world.
Nimesh has done the needful.
All right, stay on. We'll slip into a very short break. We'll come back and continue this fascinating conversation.
Welcome back. You're with us here on Editors Roundtable, and we are in a fascinating conversation with Lalit Kumar, Senior Fund Manager at ICICI Pru AMC. Lalit, we've discussed, and I was looking through some of the portfolio names that you own. I was looking at Interglobe, I think you own it. I was thinking, does Lalit own it because of commodities, or it's because at the end of the day, it's a kind of an oil play, but I mean, it's a play on consumer, etc. as well. But I want to talk about exchanges. You have both BSE and MCX in your portfolio. MCX is, I guess, what's happening with commodities and all the up and down that we're seeing. What's the idea behind BSE? Is it, I mean, capital markets is a consensus favorite. Talk to us about that.
So when I construct portfolio, I think both from a cycle perspective and a structural perspective. I think exchanges are the businesses which are very good because industry structure is pretty positive. Monopoly, duopoly kind of structure, very good ROC, and they tend to do pretty well from a long-term perspective. So I think these are some of the sectors or subcategories which are structurally very well placed to take advantage of financialization of saving that is going to happen. So I think these are structural businesses to own from a long-term perspective because of industry structure and the compounding that they can generate.
Are you excited about the new one, the big one coming in NSE? I mean, IPO is around the corner.
We have to evaluate and see.
Okay. All right. Since you earlier briefly spoke about cement, I need to ask you about that, right? Rima talks about tech, a colleague of mine, Mangalam, talks about FMCG. It sounds so nice, so many things you can relate to. I track this metals and cement. So it's not so called,
sexy.
It's not, it doesn't.
No, but you also track something else, right?
The liquor, but that will take later. But I'm saying cement, where are we now in that cycle? Because nothing fancy is happening. Only one player is making money for investors. That's UltraTech Cement. The other guys are struggling. Whether it's Mr. Bangur, Mr. Adani, those share prices have given you no returns. And the smaller guys, valuations were attractive. they are attractive also. I don't know whether they'll remain attractive. But what about share price moving up? Where are we in that cycle? And do you think that could be the, the contra trade that you would make, investment you would make, say, for the second half of the year post the monsoon?
So if you look at their EBITDA per ton, and that's one of the metric to identify where we are in the cycle, we are somewhere closer to mid-cycle in the sector. But I think in coming quarters, maybe they will have some pressure on their profitability because of higher energy price that we talked about. But I think this is a sector which is under-earning as far as ROC is concerned. Of course, the companies are going after volume and market share, because of which stocks have not done well. But I think at some point in time, pricing discipline will come in, companies will focus on ROC, and that's a time when I think cycle will turn. So I think from a cycle perspective, cement sector is well placed.
We're heading towards that place, that pivot point.
Yeah.
Lalit, from a large cap perspective, and a courtesy, a friend of mine has shared this, August 14, 2024, Nifty was at 24,200. Last year it was 24,600. Now it's at 24,300. So virtually zero return on the Nifty. You also manage a large cap fund. Time to look at large caps now, and if so, within large caps, what is your preferred bet? What do you bet on?
So, of course, large caps have corrected. Valuations are now at the lower end. But I will prefer to own sectors within large cap where I think companies can deliver growth.
So where is that growth going to come from?
So I think cement will be one of the sectors that I think will do well. Airline will be another sector that can do well. And BFCs, I think they are also doing pretty well.
Okay.
So those are the spaces where I think or sectors, some subcategories that will do well. Companies which are not able to grow, I think that they will continue to struggle. So,
but then that will be a problem, right? If IT doesn't do well, if large banks doesn't do well, then Nifty will again be like a same thing. Maybe next year also Nifty would be around same levels because there is no growth in some of those names, right? So you mean within Nifty also you have to identify which companies which are going to grow?
So I am a believer of sectors, and that is what I learned from Business Cycle Fund.
Yeah.
Identify sectors which will be in upcycle. Identify sectors which I think will have good earnings growth. Okay. So those are the sectors to bet on.
So you spoke about textile, you spoke about manufacturing as a theme, cement to a larger extent. Tell us other way around. Which are the few sectors which you think are at the peak or too much of pessimism, and people are ignoring this pessimism, and you should be cautious?
So some of the sectors where I think margins have peaked out. So for example, hospital is one of the sectors where we are a bit cautious because margin is at all-time high. Sure. Multiples are at also closer to their peak. So from a counter-cyclical investing perspective, sectors where margin are peak, I will try to avoid those sectors.
Okay. But within hospitals, I mean, they go through this phase of a lot of capacity addition, and then they earn, and then they again go into, isn't that capacity addition phase coming to an end now? I mean, and now is the time to...
So you are absolutely right. So the way cycle plays out, that at peak of the cycle, operating cash flow will be very high. Companies will invest, supply comes in, cycle turns. Then at the bottom of the cycle, companies, OCF actually dries down. They will not add capacity, cycle then turns, right?
Correct.
In case of hospitals, margin is at the peak. Companies are adding capacity. So over next 3 years, we will see significant capacity addition that is going to happen.
I see. Just one area which I think gets discussed all the time is these new age platform companies, and many in the industry are convinced that, well, these are high growth areas and you must have exposure. I don't know if you have any strong thoughts on this space, because you've got many listed now in that space.
Yeah, so I think, see, as a house, we are always open to ideas. We evaluate each and every company. Few companies will do very well, but one has to be cognizant of the fact that every company does not have moat.
Yeah.
And only within this pack of new age companies, it's better to identify and play companies which have long-term moat so that they can compound and do well. Companies without moat, I think they will struggle at some point in time. So we will be selective rather than trying to buy as a basket.
Lalit, this has been such a good conversation. We need to continue it. We need a part 2 with Lalit Kumar. So you need to come back again very soon. Thank you.
Thank you for coming.
Thank you very much for joining in. Thoroughly enjoyed it. But that brings us to an end in this edition of Editors Roundtable. From the entire team, thank you for watching. Don't go anywhere. More news and updates will follow.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening. Crude oil prices edge higher as the Trump administration threatens to economically isolate Iran. Secretary of War says the U.S. can sustain its naval blockade indefinitely. The Treasury Secretary threatens economic pressure like never seen before. Tehran rejects Washington's assertion that maritime traffic is flowing smoothly through the Strait of Hormuz. The Sensex and the Nifty down 1% this week after a lackluster session on Friday. Metals, auto, FMCG leads the decline. Rupee remains on a tight leash above the 95 mark against the dollar. India's net FI inflows over a decade stand at near zero. Sustained selling in the last 2 years has offset the cumulative money foreign investors added to the market over the previous 10 years. A CNBC TV 18 analysis finds foreign money increasingly pivoted towards AI-exposed markets like South Korea and Taiwan this year. The board of Tata Sons is likely to be recast after Chairman Chandrasekaran's exit in February. Money Control reports senior executives within the group could be inducted. Meanwhile, Tata Trust is seeking an urgent hearing before the Maharashtra Charity Commissioner and is even exploring legal options, including moving the Bombay High Court. The Air India flight from Phuket to Delhi, which suffered an altitude drop mid-air, briefly lost some controls, including hydraulics, according to an analysis by Airbus. But the analysis does not establish the cause. Airbus asked Air India to conduct further checks. U.S. launches a fresh trade salvo. White House accuses more than 40 nations, including India, of helping China to get around U.S. tariffs. Estimates losses between $19 to $26 billion due to what it calls a transshipment scam. Names India, Mexico and Vietnam as China's biggest enablers. The Chief Justice of India, Surya Kant, slams the Bar Council over a short-lived directive asking state associations to not enroll any 2026 batch graduate from the Nalsar Law University. Says the circular was absolutely uncalled for and a dialogue between him and the students should not have led to this. Over 450 Nalsar students had signed a letter opposing Chief Justice Surya Kant as the chief guest at their convocation. 7 people dead, 3 others are missing after an under-construction tunnel was flooded with water and debris in Uttarakhand. 19 workers have been rescued so far after landslides caused the incident at an hydroelectric project. Days after pulling Jamshedpur FC out of the ISL, Tata Steel sells its legacy football club to Churchill Brothers for a nominal 100 rupees. The transfer is subject to clearance from the All India Football Federation. Jamshedpur FC, which saw a turnover of over 32 crores last fiscal, has never won an ISL championship. Well, let's go straight to the top story this evening. Tensions between Iran and the U.S. continue to be high as the Trump administration threatens to economically isolate Tehran. Here are today's developments. U.S. Vice President J.D. Vance has said that the U.S. will prevent Iran from obtaining a nuclear weapon while maintaining stable energy prices. Vance told Fox News the U.S. would emerge from the standoff with Iran in a stronger position. He also said the Trump administration is using diplomatic, military and economic tools to secure its objectives. U.S. Treasury Secretary Scott Bessent echoing Vance's views in an interview to Newsmax. Bessent warned that the U.S. will apply unprecedented economic measures to isolate Iran, adding that the move will be part of a 1-2 punch that includes the continued blockade of Iran's ports. U.S. Secretary of War Pete Hegseth has said the U.S. military has enough assets to maintain the blockade indefinitely, also disputed reports about poor conditions aboard the USS Abraham Lincoln aircraft carrier in West Asia. Now, 2 military-focused publishers and Reuters report that sailors tried to jump overboard the ship, which has been at sea since November last year. The Wall Street Journal reports the U.S. is sending USS George Washington carrier to replace the existing Lincoln aircraft carrier. Now, Iran maintains that its Revolutionary Guard Corps controls the Strait of Hormuz. The RGC claimed that no ship can safely pass through the waterway without Iran's permission and supervision. In the oil market, Brent crude prices remain near the $90 per barrel mark. Kepler data shows commodity vessels transiting at Hormuz has picked up, but only slightly, still lower than the month's daily average of 12 in August so far. Let's talk about the day's market action. Now, the market's ending lower after a muted session. The Sensex down 71 points. The Nifty dropped 30 points. Mid-caps bucking the trend today, up by about 330 points. If you take a look at the story for the week, the markets have snapped a 2-week gaining streak with the Nifty and the Sensex falling nearly 1%. So that's the picture for the markets this week. The mid-cap index closing, though, in positive territory. Staying with the markets, India's net FI inflows over a decade now stands at 0. Sustained selling in the last 2 years have offset the cumulative money foreign investors added to the market over the previous 10 years. Sudarshan joins us now with a detailed analysis. Sudarshan, so FII inflows virtually 0 over a 10-year period?
From September 2016 to December 2024, that's 100 months, FIs had pumped nearly $46 billion into Indian equity markets. And in the next 19 months, that is from January 2025 to July 2026, that entire $46 billion were withdrawn. So net-net, no inflows. Some silver lining though. The last 2 weeks of August have seen the inflows of nearly $2 billion. Now let's break that inflows data year-wise and the events that likely to have played a major role. In the second half of 2016, the rate hike by US Federal Reserve and the liquidity shock led to outflows of nearly $3 billion. In 2017, emerging market basket had seen a major rally. MSCI emerging market had surged nearly 38% against 11% move in 2016. And because of this, Indian market too saw inflows of nearly $8 billion. But nearly 50% of 2017 inflows got reversed in 2018 as crude oil surge weighed on emerging markets. Come to 2019, Modi government came back to power for the second term, and the government announced a cut in corporate tax rates, and we closed the year with inflows of more than $14 billion. But 2020 was a different year. We started the year with a COVID fear and had seen a continued market fall in the start of the year. But no one had expected that recovery would be so much sharper. And the recovery was so sharp that we at the end saw inflows of nearly $23 billion. In 2021, we saw recovery even in global economies. Global GDP had recorded growth of almost 6% in 2021 against contraction of 3 to 4% seen in 2020. And in the process, we saw inflows of nearly $4 billion. In 2022, a global inflation shock driven by pandemic supply chain snarls and the war in Ukraine forced the US Fed into its most aggressive monetary tightening cycle in decades, raising interest rates from near 0 to 4.5%, and US consumer prices hit a 40-year high of 9.1%. And the impact we felt here too. FI outflows of more than $16 billion. But it didn't take much time to reverse those outflows. Very next year, FIs gone gung-ho on Indian equities. As just a year ahead of election, government too went aggressive on capex front by announcing an increase of almost 33%. And the result? FI inflows of nearly $21 billion. In 2024, Indian equity market hit record highs in September, driven by strong retail momentum. But shortly after, October 2024 marked an unprecedented reversal with a record-shattering FI net outflow of over $11 billion. But we managed to end the year with minor inflow of $0.1 billion. Now, FI outflows starting October 2024 continued till decently. And that led to total outflows of $46 billion till July 2026, nearly $19 billion in 2025, and more than $27 billion in first 7 months of 2026. But if there are some positives, it's the last 2 weeks. FIs have infused nearly $2 billion in August so far. So the key question now, does August mark the beginning of a sustained return of foreign capital, or just a temporary pause in a broader global reallocation?
The only missing link, as we all know, in the last 2.5 years has been the flows. The FI selling has been massive. We are all aware about the numbers. In fact, on a decadal basis, they've become neutral now. Last 10 years, cumulative flows of FI is zero now. They've bought $69 billion in primary market and they've sold exactly $69 billion in secondary market.
Well, that's FI data for you, the trend over the last 10 years. And because of the outflows that we've seen, it over the 10-year period down to zero. India's wholesale price index eased marginally to 9.78% in July as prices of fuel, power and food items have cooled. However, manufactured products saw an uptick in inflation at over 8% against 7.48% for the month of June. Shares of Piramal Pharma down over 3% in trade after Carlyle's exit from the company hit a roadblock. Sources tell CNBC TV 18 the private equity major's block deal to sell a 6% stake worth 1,750 crore rupees has likely been called off due to tepid investor demand. Shares of Zee Entertainment surging in trade, this after the Securities Appellate Tribunal that SAT granted interim relief to the company in its case against SEBI. The SAT has stayed SEBI's order against Zee Entertainment and allowed the company to proceed with its proposed preferential warrant issue worth over 3,100 crore rupees to promoters. The tribunal also allowed the company to access its mutual fund units for dividend distribution. Adani Birla-led Swatantata Microfinance has filed its draft red herring prospectus for a 300 crore rupee IPO. The offer has been split evenly between a fresh issue and an offer for sale. Adani Birla and her firm Antimatter Media together hold nearly 60% in Swatantata Microfinance, so heading to the Lal Street. The latest in the Tata Sons succession saga, the Tata Sons board is likely to be recast following Chairman N. Chandrasekharan's exit in February next year. Sources tell Money Control that the holding company is likely to induct senior executives from within the group to its board. The changes are expected to be considered as part of the transition to a new chairman, with some existing directors potentially retiring or even leaving. Discussions are still preliminary. No final decision has been taken on either the size of the board or potential new members. Meanwhile, the Tata Trust is seeking an urgent hearing before the Maharashtra Charity Commissioner and is exploring legal options, including moving the Bombay High Court. Rachna joins us now with the latest. Rachna.
Tata Trusts are now exploring the legal options, and that could mean going to the Bombay High Court. That is what our sources are telling us this morning. Now, yesterday, the trustees of the Sir Dorabji Tata Trust met and adopted the resolution on N. Chandra not seeking reappointment. The trust also had to appoint a joint nominee for the upcoming AGM. And that could not happen because Sir Ratan Tata Trust, the trust with which it has to appoint the nominee jointly, cannot participate in meetings owing to the Charity Commissioner's freeze. And since there is no update on that front, the restraint order of the 15th of May continues to apply, which is why the next option is the High Court, the appellate authority on Charity Commissioner's orders. Now, we've gone through Tata Sons articles of association, and they tell you exactly how tight this is, because until yesterday, this was about one nominee being jointly appointed. From today, it's about 4. Article 86 is the first one. Quorum at a general meeting needs at least 5 members personally present, and that must include one authorized representative jointly nominated by Sir Ratan Tata Trust and Sir Dorabji Tata Trust. But now look at Article 118, which governs succession at Tata Sons. The moment a chairman has to be chosen, a 5-member selection committee has to be constituted, and 3 of those 5 are nominated jointly by the same 2 trusts. The chair of that nominee also, the committee also comes from those 3. So one joint nomination for the AGM, 3 more for the selection committee. Sir Ratan Tata Trust cannot take a board decision right now. So in all likeliness, the AGM is also expected to be adjourned if no legal relief comes for the Tata Trust.
Yes, that is the important question, and the uncertainty continues. Rachna, many thanks for joining us. Now, CNBC TV 18 has accessed an analysis by Airbus on the Air India flight from Phuket to Delhi, which suffered an altitude drop mid-air. The analysis shows the aircraft briefly lost some controls. However, the analysis does not establish the cause. Shivani joins us now with details. Shivani, take us through the preliminary report, the initial assessment by Airbus.
Well, yes, sources tell CNBC TV 18 that the Air India Phuket-Delhi flight did briefly lose some of its key controls, including the aircraft's hydraulic systems. But Airbus's initial assessment does not establish why that happened. We have accessed the dossier sent by Airbus to Air India in response to the airline's queries after the incident. And according to the assessment, the aircraft first lost pressure in one hydraulic system, followed within seconds by the other 2. This meant the aircraft temporarily lost control of its elevator elevators and ailerons for around 4 seconds. The surfaces that help pilots control the aircraft's movement up, down and sideways. Aviation experts tell us that a simultaneous loss of pressure in all 3 hydraulic systems is an extremely rare occurrence. The reason aircraft have 3 separate hydraulic systems is precisely to provide redundancy, so that even if one system fails, the others can continue powering critical flight controls. Sources say the pilots struggled to get an immediate response from the aircraft during those crucial seconds. The hydraulic system then recovered, allowing the pilots to regain control. Importantly, Airbus analysis shows does not establish the cause of the simultaneous loss of hydraulic pressure. Now, Airbus has therefore asked Air India to carry out further checks of all 3 hydraulic systems, including the relevant pressure switches, transmitters and other components. It has also sought additional maintenance information and inspection of the aircraft. The incident took place at around 9:32 a.m. on India Standard Time on August 4. Airbus's response to Air India was submitted later that night at around 1:59 a.m. IST on August 5. So Airbus has now given Air India a clearer picture of what happened during those crucial seconds, but what triggered the hydraulic failure is still under investigation. Back to you.
Shivani, many thanks. Now, the Trump administration has accused over 40 nations, and this includes India, of helping China to circumvent U.S. tariffs. The White House has estimated losses of between $19 to $26 billion due to what it calls, and I quote, transshipment scam. Abhimanyu joins us now with more details. Abhimanyu, take us through what the U.S. is alleging and what does this now mean for India and the current trade negotiations? Has there been any response from the Indian government?
Well, a response is yet to come formally as well as informally from the Indian government on the allegations which have been leveled by the United States. They have accused several countries, including India, of helping China evade tariffs through shadow transshipments. And the US is possibly going to use artificial intelligence to detect such shipments. The US has also indicated that such practices became much more common after 2018 when the US had levied Section 301 on China over the issue of unfair trade practices. Now it remains to be seen what kind of a bearing this is going to have on India's trade negotiations with the United States, since the terms of reference which already have been finalized between India and the United States for a possible BTA cover 19 chapters which include issues like rules of origin, customs facilitation, tariffs, goods and non-tariff barriers. So the issue of rules of origin is very much there between India and the United States as far as the terms of reference of a BTA are concerned, which will possibly prevent any transshipment from India into the United States. Now, it remains to be seen what kind of a response would formally be provided by India, either by the government or by India's exporters. Now, meanwhile, the GTRI has indicated that India should seek a shipment-level evidence to protect legitimate exporters from any action from the American side. It has also cited data that US's imports from China had fallen from $525.8 billion US dollars in 2017 to $227 billion in 2025. However, the global imports had still increased by the United States, which clearly indicates that if not China, goods were certainly coming into the United States through several other geographies, and China had countered US tariffs by supplying more intermediate goods to manufacturers participating in global value chains. So it remains to be seen what kind of an action is going to be taken by India's exporters, as well as what kind of a response will be given by the Indian government as part of trade negotiations, which already cover the ambit of rules of origin, which is possibly going to check any such concerns on the American side.
All right, many thanks, Abhimanyu, for joining us. We'll head into a break, but up next, days after pulling Jamshedpur FC out of the ISL, Tata Steel sells its legacy football club to Churchill Brothers for a nominal 100 rupees. That and more when we return. Chief Justice of India Surya Kant slams the Bar Council over a short-lived directive that asked state associations not to enroll any 2026 batch graduate of the Nalsar Law University. Over 450 Nalsar students had signed a letter opposing Chief Justice Surya Kant as the chief guest at that convocation. Now, the Bar Council's chairman, Manan Mishra, said that the order was issued suddenly and in haste, but it was withdrawn within 40 minutes.
ये अचानक थोड़ा आनंद फानन में एक ऑर्डर हुआ, उसको तुरंत 40 मिनट के अंदर उसको विड्रॉ कर लिया गया, उसको मॉडिफाई किया गया और फिर रात में काउंसिल का थॉरो डिस्कशन हुआ। हम लोगों ने सब में मिलके ये किया कि ये ऐसा मामला है कि इसमें कोई इंक्वायरी की जरूरत नहीं है, वैसे कोई, इसलिए दैट चैप्टर स्टैंड्स क्लोज नाउ। पूरी तरह वो कंप्लीटली जो है सो चैप्टर बंद है।
Well, that is Manan Mishra there on the order, which was withdrawn within 40 minutes. Ashmet joins us now with more on this controversial order. Ashmet, the Bar Council backtracking after outrage and some harsh words today from the Chief Justice himself to the Bar Council.
Indeed, the Chief Justice was not in the mood to be kind as far as Manan Kumar Mishra is concerned, especially that order that he passed, which initially had said that no enrollment of Nalsar students in 2026 as advocates, and number two, had also instituted an inquiry. Now, this issue was flagged before the Chief Justice of India. He essentially said that, look, this is an issue that lies between the students, about 450 of them, who have written to him and saying that this is an issue that exists between the students and I. What business does Manan Kumar Mishra, what business does the Bar Council of India have in terms of intervening and intervening in the fashion that it does? The petitioners before the CJI raised the question that there are various Bar Council members who themselves were not privy to this decision having been made by Manan Kumar Mishra, and towards that end, that is what led to the outrage, that is what led to a recall of that entire order. So as of right now, no enrollment bar as far as the students are concerned. Also importantly, there is no inquiry that is being instituted, and towards that end, the CJI has passed preventive orders saying that no punitive action is to be taken either against any of the students or against the faculty members. The CJI making it clear that, look, even if the students may be wrong in opposing his invitation to Nalsar, they still have a reason to make their voice heard, that the right to protest, as long as it's peaceful, is in fact a constitutional right, and that there is no room here for the Bar Council of India to pass such sweeping orders.
All right, Ashmit, many thanks for joining us. Now, the Supreme Court has quashed a criminal complaint and summons issued against Congress MP Rahul Gandhi over his remarks against Hindutva ideologue Vinayak Savarkar in 2022. Cases filed in UP over comments made by Gandhi during the Bharat Jodo Yatra. The Apex Court observed the criminal proceedings lacked a particular sanction required under the law to prosecute Gandhi in the case. Now, days after pulling Jamshedpur FC out of the ISL, Tata Steel has sold the team to legacy football club Churchill Brothers for a nominal 100 rupees. Matthew Thomas joins us now to explain what is going on here. Matthew, Jamshedpur FC being sold for all of 100 rupees?
Well, Tata Steel has officially approved the divestment of its entire stake in Jamshedpur Football and Sporting. That's the entity behind the ISL club Jamshedpur FC. Churchill Brothers Sports Club is acquiring the club's 4 crore equity shares for a nominal cash consideration of just 100 rupees. This deal includes the transfer of the club's Indian Super League sporting license and the existing contract for 12 players and 2 coaches. So this means Churchill Brothers will officially take over the contracts for all Jamshedpur players and coaching staff. Jamshedpur FC saw a turnover of 32 crore rupees in the last financial year. Now that represents 0.01% of Tata Steel's consolidated turnover and carried a negative net worth of 5.8 crore rupees as of March 31st. Tata Steel previously told CNBC TV 18 that they would not reconsider the club's decision to withdraw from the ISL. But Tata Steel is not transferring its physical infrastructure. Instead, they will maintain their facilities in Jamshedpur, repurposing them for grassroots football. This comes as Jamshedpur FC reached the quarterfinals of the Durand Cup. Churchill Brothers is a storied club with 2 I-League titles and nearly 40 years of history. And they're expected to complete the transition by the 31st of August, pending final approvals from the AIFF. Before this dramatic takeover, Churchill Brothers spent years locked out of the top flight of Indian football, culminating in 3 separate rejections by the Federation and rival clubs in a single month. But the big question now is, will the two entities merge into one new identity, or will Jamshedpur FC live on?
All right. Many thanks, Matthew, for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to this special show. The 22nd Motilal Oswal Annual Global Investor Conference will kick off on the 17th of August. That is this coming Monday. As always, for the curtain raiser, we are joined by the two gentlemen who run the conference, who arrange it, put it together. Rajat Rajgaria is the whole-time director and CEO of institutional equities at Motilal Oswal Financial Services. And with him, as always, is Gautam Dugard, managing director and head of sales for institutional equities at the firm. Rajat and Gautam, great to have both of you here on the program as always. Before I bring in both Rajat and Gautam, let me quickly take note of the first quarter earnings season, which is now largely behind us. We'll just do Nifty, mid-cap, small caps in the broader universe. The data, of course, very helpfully has been provided by Motilal Oswal themselves. Now, the broad picture is becoming clear. Growth has held up, but the real story is the strength of earnings delivery versus what was expected across all the segments, large, mid and small caps as well. Profits have surprised on the upside with the strongest momentum coming through lower down the market cap curve. So let's start with the Nifty. Nifty companies have delivered a healthy 19% year-on-year revenue growth broadly in line with expectations. The surprise came further down the P&L, where EBITDA growth grew 11%, which was about 4% ahead of what Motilal Oswal expected. Profit growth at 18% beat expectations by around 7%. Let's get to the mid-cap universe. Now, this is, of course, excluding oil marketing companies. Revenue growth came in at 16%, which is exactly in line with expectations, but earnings delivery was stronger. EBITDA grew 19%, 2% ahead of estimates, and profits jumped 25%, which was a sizable 6% beat. Small caps have delivered the strongest growth and the strongest earnings surprise of the three buckets. Sales grew 21% here, which was about 4% ahead of expectations. EBITDA rose 18%, a 5% beat there, and profits surged a supersized 31%, a full 7% beat over and above what the expectation was. And if you look at the full universe of what Motilal Oswal covers and where numbers have come so far, again, excluding the oil marketing companies, the quarter has been better than expectations, particularly at the bottom line level. Sales are up 18, EBITDA is up 15, and profit growth came in at about 22%, which was about 7% ahead of expectations. So that's the sort of wrap out as far as the quarter is concerned. Rajat and Gautam, once again, thank you very much for being with us here. Congratulations as your sort of, quarter kicks off. Rajat, I want to start by asking you, the data is all out there. How much of the numbers, how much of this beat is already in the price according to you?
I think that's fair. If you look at our markets, 2-3 years index is quite range bound. The range is 3,000 points, but range bound. And two reasons I can think about it. First, the overall earnings has been little patchy. Only in the last 1 quarter, 2 quarter, you have started seeing things little better. And I think secondly, the narrative of global flows has always been more towards some dominant theme in the rest of the world, not towards India. And our markets, you can spend a lot of time on top down, but this market has become very bottom up. For the same index, if you can keep plotting charts or stocks, you will see many of the stocks just moving higher and higher and higher. So we are a very growth-oriented market. Wherever there is a growth, there is a demand. So that's point number one. Point number two, the two trends which I think are very visibly common. First, the retail money, the domestic money will keep coming in, not letting the market go down. And the primary market will keep supplying paper, not letting the market go up.
Correct.
So these two trends are also very common, right? And I think third thing is we have started seeing now trends of earnings getting better. And I think this quarter, Gautam can speak more details, but this quarter has been where earnings have started becoming more broad-based, right? We don't differentiate too much like large cap, mid cap, small cap. We think growth is growth, whichever bucket they fall into, right? But we have started seeing breadth of the earnings being very good. So that's a good sign. This could just be a trend where after 2-3 years of consolidation, you may start seeing India again taking
You've given me the perfect segue, Rajat, so let me take it to Gautam. Do you think we're at the phase where earnings acceleration can happen, or this quarter is more of a one-off? Or you think, we're set for, as Rajat put it, broadening of the earnings, and it's showing up in many places, but also continued acceleration?
So, Prashant, look at it this way. Last 1 year, we've had a lot of improvements in macro. Multiple steps that the government and RBI has taken in the last 9-12 months. You had interest rate cuts, GST cuts, right? And of course, government cut the income tax rate last budget. The cumulative impact of all of that is now getting manifest. You look at auto numbers data, credit growth, power, whichever segment you look at, GST collections. Despite the rate cuts, the GST collections were at a new high. And that is now transmitting into micro numbers. This has turned out to be the best quarters in last 3 years. In terms of quality, in terms of quantity of earnings, in terms of the breadth, whichever way you look at it. I have not seen a 20% plus earnings growth for last 12 quarters now. More importantly, the top line growth is at a 3-year high now. So inflation has made a comeback, which is now representing in top line across sectors. So for our coverage as of yesterday, 350 companies have reported numbers ex-OMCs. The growth is 23% in earnings against expectation of 15.
350 companies, 20% earnings.
23%.
23% top line growth.
So this is earnings I'm saying. Top line is also 18-19%. Right? For Nifty, it is 18%. We were expecting 10%. look at the other factor. We are seeing earnings upgrades now after 12, 13 quarters. We have seen a 2% earnings upgrade for our broader coverage and about 1.5% for Nifty, right? Like Rajat mentioned, it's a bottom-up market, right? After 3 years, we are seeing a turnaround in small cap earnings. We were expecting a 30% growth for full year, and the first quarter has given us that confidence that the full year can be met. The first quarter small cap earnings, and we cover a very vast numbers. You know, we have 180 small cap companies under our coverage. They have delivered 32% earnings growth.
Wow.
Mid cap 25%, which is why market is also representing that. You know, from the bottom, if you look at the March bottom, Nifty is up 9%, but mid cap 150 index is up 21%, and small cap is up 25%. And I think this trends will strengthen as we move forward.
But Gautam, for the full year, can we extrapolate these numbers for FY27 and FY28? 18-20% large cap growth, 25% mid cap growth, 30% small cap growth. Because in the current quarter, there was also that benefit of repricing of low priced inventory. So are these numbers sustainable for not just this year, but even say FY28?
So Rima, there is an interplay of that. Some sectors benefited because of inventory gains, and some sectors lost out because the inventory input cost went up. But when I look at the 31 sectors that we cover, 20 have beaten our expectations. 9 have met expectations. Only 2 have disappointed. I have not seen such a strong breadth in last 3-4 years. Now, moving forward, when we started the year, we were projecting 14% growth for large cap, 21% for mid cap, and 30% for small caps. And like I just said, we have seen an earnings upgrade. So that basically means our expectations, which were there a month and a half back, have actually got more reinforced. So we are expecting to end the year on small cap with 30%, mid cap with 22% now, and large cap with 15%. Nifty will see 15% growth after 3 years. I mean, look at FY24, we did 1,000 rupees of EPS. FY26, we ended at 1,065. So in 2 years, we got 6% earnings growth cumulatively. And market has been absolutely fair. In 2 years, the Nifty market cap went up 5% from 181 lakh crores to 192 lakh crores. So market has respected only one thing in the last 3-4 years, which is earnings. Whether you look at last 3, 5, 10, whichever construct you create, we've looked at 5 different indices and their moments on last 3, 5, 7 and 10 year basis on EPS and index movement. It is matching 100% to the earnings growth. So if we are expecting a 15% earnings growth in Nifty this year and 20-30% in mid and small cap, I would think market is looking very constructive, and more so after 2 years of a very strong time and price consolidation. The only missing link, as we all know, in the last 2.5 years has been the flows. The FII selling has been massive. We are all aware about the numbers. In fact, on a decadal basis, they've become neutral now. Last 10 years, cumulative flows of FII is zero now. They've bought $69 billion in primary market, and they've sold exactly $69 billion in secondary market. So as and when that changes, you will see another tailwind coming in for the markets.
All right. Hi, gentlemen. Good to have you all in the studio. Well, a valid point, right? With regard to the flows, the FIs, they have not come to the party. Hopefully, that trickle that's been seen, that, just goes up from here. The other problem is when mood gets better, earnings get better, the market sentiment changes, then you'll have more amount of supply of paper. Could be good for business, but otherwise, that weighs as well, right? Barely in the last few days, we've heard a lot of IPOs, a lot of OFS, a lot of promoter sales as well. How big a problem is that? It could be good for business, I'm saying yes. But a bit of an issue for market sentiment, right?
Look, I think both yes and no. Yes, because of course things get bunched up. So if you look at from January to May, the primary market was almost very low. You hardly had paper. And suddenly things get bunched up. Now you are seeing maybe weekly basis, 3-4 IPOs, 3-4 QIPs, half a dozen, and this pace will continue. But it does very good to the markets over a medium to long term because of 2 things. First, the quality of companies which are getting listed now are truly representing what this country is growing. Point number 1. Point number 2, the wealth impact is getting more widespread because now you have bigger participation. Please remember, from a 2-3 crore demat accounts, today you have 25 crore demat accounts. Yeah. And with every one large IPO, you see more demat accounts being opened into the system. And lastly, I think for a lot of the money that offshore investors will put in, primary market will be an important source to attract that money. Some of the recent IPOs, you see FIIs being anchor, QIPs, blocks, they participating. So I think bunching up is an issue. Primary market supply is not. You need, in India, if you still look at a $5 trillion market cap, the free float is still relatively low compared to the rest of the world. But phasing out is what ideally needs to happen. It may not happen.
And I remember talking to Ramdevji earlier in the year, and he said that this year IPO, and that's the kind of market like last year was great for IPOs, and we were talking about, the capital market business, and well, maybe this year is not going to be all that great, but look how it's turning out, right? It's back to being as busy as ever in terms of primary issuances, taking companies public, etc. Right, Rajat?
Yeah, I think
phenomenal.
Prashant, I always think this is very healthy for our market. Yeah. And look at the kind of companies which are getting listed, from the largest asset manager to the largest exchange to the largest telecom company.
I mean, imagine a scenario where we were just talking about the same old 100 companies, right? Yeah. So the breadth, actually it's also the size, so the variance is amazing. Very large companies, smaller companies, but also the kind of companies, right?
Yeah. I also wanted to highlight one point. When you look at the credit growth today at 18%, it needs to supplement with an equity capital markets, because for all the capex that we are beginning to see to happen, you need equity contribution to come. So that's why you are now seeing QIPs coming up big time, and QIP is the primary capital into the company for funding the growth, right? So I think primary markets are very supportive and important for the overall economy to grow. As I just said, we ideally phasing out is important, but our markets may not do that. So we'll weather this phase.
We have 4 or 5 managements waiting, so I'm going to rush you guys because I want to get just 2 more things. Gautam, earnings, right? You're a numbers guy, and you're looking at, and you said that, well, that's the only thing which matter, and markets have been very fair in judging stocks and what to do, what does well, not does well, based on numbers. Where are you most confident about? And in terms of earnings acceleration, based on what you've heard from management in calls, etc., where there will be steady increase in earnings.
So, Prashant, that has not changed for us in the last 1.5 years.
Just revise it for us.
Yeah, of course. So, and that's also part of what we are trying to represent at our 22nd annual conference in the CEO track.
Yeah.
Right? India is a very diverse market. You have 5 big cohorts if you look at it: financials, consumption, tech, industrials, and healthcare. And one common thread running across these 5 cohorts over the last 2-3 years has been the big bellwether stocks in each of these cohorts have done pretty much nothing. When I was looking at bottom-up numbers for Nifty 50, there are 27 companies in Nifty which are almost stopped growing, or maybe growing at 5-7%. So real growth, even in the top 100 companies, is happening beyond Nifty 50.
Yeah.
So you have to dig there a little more. So where are we positive? If you look at financials, we are more positive on the non-bank side, both lending, non-lending capital market, which is a big overweight in our model portfolio. If you look at consumption, one good thing we did 2 years back was made FMCG zero. We converted all our 15% weight on consumption into discretionary, right? Industrials also, if you look at it, what is done well? It's not the benchmark stocks which are bellwethers in that segment. It's the power-oriented names, it's transmission, defense, likes of Dixon. They are the ones which are there in our model portfolio. Some of them are obviously representing in our CEO track starting Monday. If you look at tech, we've been consciously away from the traditional legacy large cap tech. We are more towards the new age technology. In fact, our coverage also has ramped up significantly out there, and we expect to have a far broader coverage in that domain. And lastly, Prashant, if you look at healthcare, the traditional top 5 large pharma generic companies which were there 10 years back, cumulatively over a 10-year period, they have compounded earnings at 7% and market cap at 8%. So if you have made money in healthcare in the last decade and maybe in the years to come, the money was made outside of the traditional generic names. So you have CDMOs, you have hospitals, you have diagnostics, all kind of names. And as a top-down thought, what we have done essentially recently in our own portfolios is we have moved almost 700 basis points of weight in our model portfolio from large cap towards mid and small cap. So largely consumer discretionary auto, non-bank financials and industrials. That's where we are more constructive.
Rajat and Gautam, thank you very much, both of you, for being here on the program today. Best of luck as you go ahead with the conference starting this coming Monday. Really appreciate your time. We'll take a quick commercial break here. We're going to come back and get you some interesting data, which Rajat and Gautam alluded to, especially with regards to foreign investment into India over the last 10 years being essentially zero. Stay with us. Welcome back. You just heard in the previous segment from Gautam Dugar and Rajat Rajgaria on the Motiro Oswal conference, which kicks off from the coming week on Monday. And they made a bunch of interesting points with regards to earnings, but also with regards to how foreigners have not put any money, essentially, if you sort of, net out the primary and secondary market activity from them over the last 10 years or so. The net flow into India has been essentially next to nothing. Actually, Suris worked the numbers and looked at this data in some detail, and he's here with us to take us through exactly those numbers. So over to you.
From September 2016 to December 2024, that's 100 months, FIs had pumped nearly $46 billion into Indian equity markets. And in the next 19 months, that is from January 2025 to July 2026, that entire $46 billion were withdrawn. So net-net, no inflows. Some silver lining though. The last 2 weeks of August have seen the inflows of nearly $2 billion. Now let's break that inflows data year-wise and the events that likely to have played a major role. In the second half of 2016, the rate hike by US Federal Reserve and the liquidity shock led to outflows of nearly $3 billion. In 2017, emerging market basket had seen a major rally. MSCI emerging market had surged nearly 38% against 11% move in 2016. And because of this, Indian market too saw inflows of nearly $8 billion. But nearly 50% of 2017 inflows got reversed in 2018 as crude oil surge weighed on emerging markets. Come to 2019, Modi government came back to power for the second term, and the government announced a cut in corporate tax rates, and we closed the year with inflows of more than $14 billion. But 2020 was a different year. We started the year with a COVID fear and had seen a continued market fall in the start of the year. But no one had expected that recovery would be so much sharper. And the recovery was so sharp that we at the end saw inflows of nearly $23 billion. In 2021, we saw recovery even in global economies. Global GDP had recorded growth of almost 6% in 2021 against contraction of 3 to 4% seen in 2020. And in the process, we saw inflows of nearly $4 billion. In 2022, a global inflation shock driven by pandemic supply chain snarls and the war in Ukraine forced the US Fed into its most aggressive monetary tightening cycle in decades, raising interest rates from near 0 to 4.5%, and US consumer prices hit a 40-year high of 9.1%. And the impact we felt here too. FI outflows of more than $16 billion. But it didn't take much time to reverse those outflows. Very next year, FI has gone gung-ho on Indian equities. As just a year ahead of election, government too went aggressive on capex front by announcing an increase of almost 33%. And the result? FI inflows of nearly $21 billion. In 2024, Indian equity market hit record highs in September, driven by strong retail momentum. But shortly after, October 2024 marked an unprecedented reversal with a record-shattering FI net outflow of over $11 billion. But we managed to end the year with minor inflow of $0.1 billion. Now, FI outflows starting October 2024 continued till decently. And that led to total outflows of $46 billion till July 2026, nearly $19 billion in 2025, and more than $27 billion in first 7 months of 2026. But if there are some positives, it's the last 2 weeks. FIs have infused nearly $2 billion in August so far. So the key question now, does August mark the beginning of a sustained return of foreign capital, or just a temporary pause in a broader global reallocation?
Sudarshan, wonderful data and wonderful sort of way of looking at things, and really took us back on the memory lane with everything which has happened, and consequential, the highs and the lows over the last 10 years or so. Well, you know, from all of us here, Nigel, Rima and me, thank you very much for staying with us. You heard the views, of course, from the Motilal Oswal team. Monday, of course, the conference kicks off, and we'll have Ramdev Agarwal and the others from that conference with you to cover markets and get you more views and opinion. Thank you very much for staying with us.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the anti-Chief Justice of India protest that took a dramatic turn. So what happened here? Well, it all started when Nalsar students opposed CJI Suryakant's proposed participation in the university's 2026 convocation. The students communicated their objections to the Chief Justice. So what happened next? Well, on August 13th, the Bar Council of India issued a directive asking all state bar councils not to enroll members of Nalsar's 2026 graduating batch as advocates until further orders. But it didn't end there. The BCI also asked Nalsar to identify the students who had initiated or mobilized the campaign. The university was asked to distinguish between students who had merely signed or supported a representation and those who had called for a boycott or obstruction. The directive was later modified, allowing the 2026 graduates to enroll with any state bar council of their choice. However, the demand for an inquiry report identifying those involved remained in force. Now, this was followed by Nalsar questioning the constitutional basis of the BCI's action. Amidst the backlash, the Bar Council of India chairman, Manan Kumar Mishra, reacted. He said that the order had been withdrawn and that the proceedings would be closed altogether. He said that the BCI was satisfied that the graduating students had no role to play in the campaign and that no further action was necessary. Meanwhile, the matter reached the Supreme Court, which sought the BCI's response to the circular. CJI Suryakant then questioned the Bar Council's intervention, asking why it had stepped in when the issue was squarely between the students and him. He said that the BCI's action was completely uncalled for and stressed that students have the right to protest. So let's listen in to what the BCI chairman Manan Kumar Mishra had to say about the directive.
ये अचानक थोड़ा आनंद फानन में एक ऑर्डर हुआ, उसको तुरंत 40 मिनट के अंदर उसको विड्रॉ कर लिया गया, उसको मॉडिफाई किया गया और फिर रात में काउंसिल का थॉरो डिस्कशन हुआ. हम लोगों ने सब में मिलके ये किया कि ये ऐसा मामला है कि इसमें कोई इंक्वायरी की जरूरत नहीं है, वैसे कोई, इसलिए दैट चैप्टर स्टैंड्स क्लोज नाउ. पूरी तरह वो कंप्लीटली जो है सो चैप्टर बंद है.
Well, we'll come back to that story in just a bit. But before we do that, important development coming out of West Asia. Tensions between Iran and the US, they remained high as Trump administration threatened to economically isolate Tehran. Here are the latest developments. US Vice President J.D. Vance has said that the US will prevent Iran from obtaining a nuclear weapon while maintaining stable energy prices. Vance told Fox News that US would emerge from the standoff with Iran in a stronger position. Vance also said that Trump administration is using diplomatic, military and economic tools to secure its objectives. U.S. Treasury Secretary Scott Bessent also echoed Vance's sentiment. In an interview to Newsmax, Bessent warned that the U.S. will apply unprecedented economic measures to isolate Iran. He added that the move will be part of a 1-2 punch that includes the continued blockade of Iran's ports. The U.S. Secretary of War, Pete Hegseth, said that the U.S. military has enough assets to maintain the blockade indefinitely. He also disputed reports about poor conditions aboard the USS Abraham Lincoln aircraft carrier in West Asia. Two military-focused publishers and Reuters reported that sailors tried to jump overboard the ship, which has in fact been at sea since November of last year. The Wall Street Journal reported that the U.S. Sending U.S. George Washington carrier to replace the existing Lincoln aircraft carrier. Iran maintains that its Revolutionary Guard Corps controls the Strait of Hormuz. The IRGC claimed that no ship can safely pass through the waterway without Iran's permission and supervision. In the oil market, the Brent crude prices remained near the $90 per barrel mark. Kepler data showed that commodity vessels transits at the Hormuz Strait picked up slightly, but remained lower than the month's daily average of 12 in August so far. Well, meanwhile, the latest in the Tata Sons succession saga, the Tata Sons board is likely to be recast following Chairman N. Chandrasekaran's exit in February of next year. Sources tell Money Control that the holding company is likely to induct senior executives from within the group to its board. The changes are expected to be considered as a part of a transition to a new chairman, with some existing directors potentially retiring or leaving the board. Discussions are still preliminary and no final decision has been taken on either the size of the board or potential new members. Meanwhile, Tata Trusts is seeking an urgent hearing before Maharashtra Charity Commissioner and is exploring legal options, including moving the Bombay High Court. Rachna Dhanrajani gets us the latest.
Tata Trusts are now exploring their legal options, and that could mean going to the Bombay High Court. That is what our sources are telling us this morning. Now, yesterday, the trustees of the Sir Dorabji Tata Trust met and adopted the resolution on N. Chandra not seeking reappointment. The trust also had to appoint a joint nominee for the upcoming AGM. And that could not happen because Sir Ratan Tata Trust, the trust with which it has to appoint the nominee jointly, cannot participate in meetings owing to the Charity Commissioner's freeze. And since there is no update on that front, the restraint order of the 15th of May continues to apply, which is why the next option is the High Court, the appellate authority on Charity Commissioner's orders. Now, we've gone through Tata Sons Articles of Association and they tell you exactly how tight this is, because until yesterday, this was about one nominee being jointly appointed. From today, it's about 4. Article 86 is the first one. Quorum at a general meeting needs at least 5 members personally present, and that must include one authorized representative jointly nominated by Sir Ratan Tata Trust and Sir Dorabji Tata Trust. But now look at Article 118, which governs succession at Tata Sons. The moment a chairman has to be chosen, a 5-member selection committee has to be constituted, and 3 of those 5 are nominated jointly by the same 2 trusts. The chair of that nominee also, the committee also comes from those 3. So 1 joint nomination for the AGM, 3 more for the selection committee. Sir Ratan Tata Trust cannot take a board decision right now. So in all likeliness, the AGM is also expected to be adjourned if no legal relief comes for the Tata Trust.
Well, moving on, CNBC TV 18 has accessed an analysis by Airbus on the Air India flight from Phuket to Delhi, which suffered an altitude drop mid-air. The analysis shows the aircraft briefly lost some controls. However, the report does not establish the cause. Shivani Bajaj brings us more details. Shivani, take us through that Airbus initial report.
Well, yes, sources tell CNBC TV 18 that the Air India Phuket-Delhi flight did briefly lose some of its key controls, including the aircraft's hydraulic systems. But Airbus's initial assessment does not establish why that happened. We have accessed the dossier sent by Airbus to Air India in response to the airline's queries after the incident. And according to the assessment, the aircraft first lost pressure in one hydraulic system, followed within seconds by the other 2. This meant the aircraft temporarily lost control of its elevator and ailerons for around 4 seconds. The surfaces that help pilots control the aircraft's movement up, down and sideways. Aviation experts tell us that a simultaneous loss of pressure in all 3 hydraulic systems is an extremely rare occurrence. The reason aircraft have 3 separate hydraulic systems is precisely to provide redundancy, so that even if one system fails, the others can continue powering critical flight controls. Sources say the pilots struggled to get an immediate response from the aircraft during those crucial seconds. The hydraulic system then recovered, allowing the pilots to regain control. Importantly, Airbus analysis shows does not establish the cause of the simultaneous loss of hydraulic pressure. Now, Airbus has therefore asked Air India to carry out further checks of all 3 hydraulic systems, including the relevant pressure switches, transmitters and other components. It has also sought additional maintenance information and inspection of the aircraft. The incident took place at around 9:32 a.m. on India Standard Time on August 4. Airbus's response to Air India was submitted later that night at around 1:59 a.m. IST on August 5. So Airbus has now given Air India a clearer picture of what happened during those crucial seconds, but what triggered the hydraulic failure is still under investigation. Back to you.
Well, the Trump administration has accused over 40 nations, including India, of helping China circumvent U.S. tariffs. A report by the White House estimates loss of $19 to $26 billion due to what it calls a transshipment scam. Washington alleges that shipments are being rerouted or minimally processed to hide their Chinese origin and hence avoid tariffs on Chinese goods. It also warned that the Trump administration will use AI to detect and penalize such shipments. India has been placed in the top risk category with Canada, European Union, Japan, Israel and Mexico. New Delhi-based Global Trade Research Initiative, or GTRI, has said that China countered US tariffs by supplying more intermediate goods to manufacturers participating in global value chains. It argues that goods substantially processed in India, Mexico or Vietnam are genuine exports of those countries and cannot automatically be considered Chinese transshipment. The think tank also says that aggregate trade data does not prove rising US imports from third countries representing rerouted Chinese goods. It pointed out that the White House report neither reveals India's share or alleged trade, nor does it identify fraudulent Indian shipment. Well, joining us now for more on this is with us Mr. Ajay Dua, former Commerce Secretary. Also with us, Biswajit Nag, Professor of the Indian Institute of Foreign Trade. To both our guests, thank you so much for joining us. Mr. Dua, let me come to you. Strongly worded report, the report which is titled The Great Transshipment Scam, India being labeled as a tier 1 threat when it comes to transshipment of Chinese goods. Mr. Dua.
Yes, I've heard about that report, though haven't gone through it in any depth. I would say that if it is true, it is not a good thing. But how much of investigation on the ground was done by the United States TR before this report came out, I'm not sure that it would have gone into the minute details of 40 countries which have been accused of facilitating Chinese trade with the US only to leverage the tariff rates, the lower tariff rates in these countries compared to the Chinese one. Second, I think the timing of it is also important, the release of this release of this report, because President Trump and President Xi Jinping are supposed to meet early September, and this could become an issue on the US side to accuse China, so-called improvement in its bargaining power vis-a-vis China.
Right.
Fact of the matter is, I just make how much of value added gets added in India, Mexico, Vietnam, Korea, Japan, all of the European Union, the countries which have been accused as facilitating such transshipment, and the whole thing being called a transshipment scam, remains to be defined by anyone. Saying if the addition is 10%, 20%, is it allowed or not? But merely packaging, relabeling probably is covered. But I'm sure that in these countries, there is at the same time, there is also...
That's a very important point that you make, Mr. Dua, in terms of value addition. Now, the contents of this report, if one goes through, it refers to some of the manufacturing operations in countries like India as quote-unquote screwdriver factories needed to support the scam across Southeast Asia, Mexico and India. That's the language used. Mr. Nag, let me get your thoughts on that. This dismissal of the value addition that countries such as India may do, the manufacturing operations in countries such as India, Mexico, Vietnam, other than the fact that this negates the manufacturing work being done here, does that put to risk the broader ecosystem that is geared towards exports here in India, especially when it comes to, say, perhaps electronics, such as the ones that India has been betting on big?
Right, yeah, absolutely. See, these countries are trying their level best to become manufacturing hub. And over the years, if you look at that, when tariff on China is increasing, a lot of other countries are taking the advantage of it. They are trying to develop their own manufacturing base. And while importing the Chinese components, they will do some value addition. Here, the report is actually identifying minimal value addition. So how minimal is this is not very clear. So one important aspect is that India's manufacturing effort, in which China is playing an important role, because we are importing components, we are producing final goods, and electronics is one of the sector. As electronics sectors, our exports are growing up, and US is one of the major beneficiary of that. So we need to see it from that angle. So in absence of WTO dispute settlement or proper understanding between India and US free trade agreement deals what is going on about the rules of origin, these issues will remain unsettled. So it's very important for India to discuss this issue with the United States, that how much value additions you require to consider that as an Indian origin good, because that's the standard practices we were having for many decades now.
Well, let me take that across to Mr. Dua. Mr. Dua, does this add to a long list of issues that India will now have to work with the US to resolve? The US-India trade deal appears to be dead in the water. The US is contemplating passing a bill to levy 100% tariff on India on procurement of Russian oil. Now we're looking at this report called the Great Transshipment Scam. Does this only add to the issues of the two countries when it comes to working out on bilateral trade?
I think so. This is going to be an issue certainly going forward. But is it going to be used against India, or is it more aimed at China? That remains to be seen, how the US president puts it across Xi Jinping when they meet up, because one of the issues before them is to talk about the bilateral tariffs. You know, the fact of the matter is that if China is getting certain amount of work done outside, we have to appreciate that China is no longer a labor surplus country. It is, with its one-child population norm followed for over a generation, there is a shortage. So China is actually sending labor-intensive work to be done elsewhere. And all the three countries talked, whether it's Vietnam, India, Mexico, Canada, may not be Canada so much in terms of labor intensity, but these three major countries are coming in handy for China to undertake the labor intensive work. So it is like a contract manufacturing. Core work may be
that,
done.
of course, is the explanation that India will be heading to Washington with. Whether or not it manages to break any ice, especially on these contentious issues, we, of course, have to wait to see. I'd like to thank both of our panelists, Mr. Dua as well as Mr. Nag, for sharing their insight with us. But let's go back to that story that we began with, which is the action of the Bar Council, which first was to restrain the enrollment of students as advocates and then subsequently also initiate an inquiry, led to a huge outcry and then a subsequent withdrawal by Manan Kumar Mishra, withdrawing that directive. Also importantly, the CJI himself weighing in on the subject, Chief Justice Suryakant saying that this is an issue between him and the students, and there's no role for the Bar Council of India to intervene. For more on this, we're now joined by senior advocate as well as the Supreme Court Bar Association President, Mr. Vikas Singh. Mr. Singh, appreciate you joining us. First question, I'll pose the same question that Justice Suryakant today asked in the proceedings. This is a matter that's between the students and the Chief Justice of India. What role is Bar Council of India trying to play here?
So the more important question to ask is that what kind of statutory authority does Manan Kumar Mishra have as Bar Council of India President or Chairman in such matters? Now, enrollment is to be done by the High Court Bar State Bar Councils. And the State Bar Council do an individual enrollment. There is no question of any batch or any college being debarred from being enrolled. Every person who passes law has to make an individual application, and he can make an application to any state. It's not that he has to make an application to the state where he has studied. He can make an application to Bihar, he can make an application to Delhi or Karnataka, whichever state he wants to practice in. So I don't understand. He has no statutory role in this enrollment process. Under what authority? And this is serious because he's the chairman of the Bar Council. He's supposed to be the top regulator of lawyers in this country. He doesn't know his own authority, and he issues an order saying that this particular batch will not be enrolled at all. So this is something which is, which needs to be seriously debated upon, that can a statutory body which works strictly under the corners of the statute start assuming authority which it doesn't have, which is not conferred on it by statute? It's something.
Let me then also ask another question, an issue that was also raised in the proceedings today. From the record of what happened over the last 12 to 18 hours, what becomes visible is that there were various members of the Bar Council Association of India, Bar Council of India, I beg your pardon, that were not even aware that such a decision is being passed by Manan Kumar Mishra. Does that then raise the question as to how the BCI conducted the operations? Was there even a meeting convened? That's a question that the Supreme Court of India today posed.
So all these bodies, whether it be the Bar Council of India or the State Bar Council, they have a committee. And it is only the committee which meets and takes a call. It's not an individual who takes a call. It's some kind of a collegiality in decision making. Manan Kumar Mishra treats the Bar Council of India as his personal property and his individual property. So he tries to behave like that. Recently, he had also similarly debarred an advocate from practicing just because he had, tried to educate the members with regard to another Bar Council person who was contesting, who was close to Manan Mishra. And without having any authority to do so, he simply, suspended the advocate. I took the matter to the Supreme Court, it was immediately stayed. So this is how he functions. He has, being a member of parliament also, of course, member of parliament he only got because of Bar Council of India. And it's serious that whether a regulator should be permitted to be belonging to any political party and, using the political platform for conducting his regulatory work. And also his continuance for so many years, which is something which is also needs to be questioned. I think these are very, very serious issues. So he can't be permitted to use this organization as his personal property and do whatever he wants.
Supreme Court has posed to the Bar Council. Notice has been issued. The Bar Council will now have to respond. But let's shift our focus as far as students are concerned. Students raising concerns about some of the comments that have been made earlier by the CJI, taking exception to the fact that he's coming for their convocation ceremony. Have we now at least established that there is that space for students to voice their concerns, even if it means going up against constitutional authorities? Not every piece of protest needs to be identified as something that is perhaps anarchic.
The students, what they have done may not be right, may not be justified. But it is entirely their personal call. If they decide to say that they don't want the Chief Justice of India to give them their degrees, there's a completely individual call. There is no stopping from the students from doing that. I mean, it's a constitutional right which is guaranteed to them. But at the same time, I'm not supporting what the students did because, ultimately the Chief Justice of India is the highest constitutional authority in the country, and it is always a matter of honor for every student to get his degree from the CGI. But that apart, I mean, that may be a question whether morally or otherwise they were justified or not justified to do that. And that is entirely in their conscience. You have to ultimately appeal to their conscience. And the Chief Justice of India very rightly said that is between me and the students. If he's able to, do something to instill confidence in them that, yes, he is going to do something about what happened to the protesters in the march, I'm sure the students will be readily taking back their resolution and inviting the Chief Justice of India or requesting the Chief Justice of India to give them their degrees. So it's a decision which has happened by virtue of certain, incidents which happened in court. But that is entirely their fundamental rights for the student. Nobody can stop them from, expressing their concern on issues of which they feel are important as far as the student community is concerned. Thank you.
Right, Mr. Singh, appreciate you joining us. Clearly an issue that required the Chief Justice of India himself to weigh in on and then ask questions of the Bar Council as to why they did what they did. But that, unfortunately, is all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here.
India's private space race is entering its next phase. And one startup is betting that launching a satellite should be as flexible as booking a flight, not waiting for a seat on one.
Every time you ask someone to ride the rocket, right, it'll have to be reused. Now we know how to make things fly. Let's try to now get things back.
them back.
Today, to get a slot with the Falcon 9 SpaceX, it's October 28 or so. And the payment goes up today. We build semi-cryogenic engines, which means our fuel combination is liquid aviation fuel. I want to give customers flexibility to go to the best launch pad for them, which means transportation shouldn't be a big deal. We want to bring this 5 or 6 rocket hardware should be able to do about 30 to 40 launches. It starts off as a rocket and becomes a satellite.
So it's a transformer.
Yeah, it's a transformer. You know, as a company, SpaceX story was always there, known to people in the industry, known to people who are following tech. But because it got listed, now everyone, almost anyone who's doing some stock investing knows about it. I think the kind of missions and programs that ISRO will do, no business can do. There is no space industry here without ISRO for sure. India is the hub already, I think. We just need to get a couple of these satellites, these rocket companies to be, you know, more functional, and that's about it.
So it's just a matter of time.
Only a matter of time.
Fresh off Skyroot Aerospace successful Vikram 1 launch, India's private space race is entering its next phase. And one startup is betting that launching a satellite should be as flexible as booking a flight, not waiting for a seat on one. Hello and welcome to Young Turks Reloaded. I'm Shireen Pan. Founded in 2017 and incubated at IIT Madras, Agnikul Cosmos is building a full-stack space transportation company focused on dedicated on-demand launches for small satellites. Unlike traditional rideshare missions, Agnikul is developing configurable launch vehicles that allow customers to choose their orbit, launch schedule, and even modify payload configurations closer to liftoff. The startup has already achieved several milestones for India's private space sector, including the country's first launch from a privately built launch pad powered by a single-piece 3D printed semi-cryogenic engine. It is now working on, well, hold your breath, reusable launch systems and an orbital hosting platform that could extend its business well beyond launch services. Backed by global and domestic investors, the company is now preparing for its next big milestone, demonstrating booster recovery, scaling launch cadence, and building a business that extends well beyond launch services. Joining me now is Srinath Ravichandran, co-founder and CEO of Agnikul Cosmos. Srinath, it's always great to have you back on Young Turks. Thanks very much for joining us. So much has changed over the last 6 years. I mean, 2017 is when you incorporated the company, incubated at IIT Madras, and today in 2026, people can't get enough of space. Did you think that this was going to happen?
Actually, no, I didn't think so. I thought if we build the right kind of engineering, we would have the government support. But, you know, allowing us to do a launch from within Sriharikota, from our own private space, you know, orbital launch happened now privately. I think so many startups, it's unbelievable. I didn't even imagine this.
Yes, it does feel unbelievable in many ways. But, you know, you talked about the history of the big milestone that you created, which was the launch from the first private launch center in India. But I want to now talk to you about the next missions that you're working on. And the big one, of course, is the reusability factor. I mean, Musk is trying to do it, and you're attempting to do it right here in India. Take me through that.
So we figured that if you really want to think of a rocket as a simple transportation system, you can't be building a rocket every time you ask someone to ride the rocket, right? It'll have to be reused. So that's where the goal started. We were a little hesitant to actually attempt it in the upcoming mission before our previous launch. So when we did our mission 1, which was in 2024, we didn't know how that would go. We were confident, but it was a 100% successful mission. So then we sat back together as a team and figured, okay, so now we know how to make things fly. Let's try to now get things back.
Get them back.
So that's how it started. It took us, and one thing I realized, I mean, I knew about it, but doing the work, I realized it's a ground up new work. It's not like an add-on. It's not like you put a couple of of fins extra to the rocket and it comes back.
So it's
No.
starting from scratch.
Starting from scratch.
Okay,
So
explain that to me.
So when you usually size a rocket, you size it for maximum satellite capacity because that's what gets you the money, right? So you do that. But when you're solving for getting things back, you're doing two things. The customer wants you to take as much as possible, or the business side of us wants us to take up as much as possible. But the cost-cutting side actually wants us to bring the whole thing back.
Yeah.
So you're sort of solving two contradicting problems in a way. So you end up having to rethink every single aspect of the rocket. In the past, when you look at a regular rocket launch that's only going up, right, you don't think too much about the software aspect. The software that is written is just enough to make sure things happen in a sequence.
Right.
Now it's like it needs to have its own second brain, a brain that is going to bring it back. It needs to have a special pair of eyes that spots where the barge is, and we are landing on a barge in the ocean. So all of these things are like new eyes, new brains, and all of these have to work together with the old ones. So that's an entirely different challenge.
So the new eyes and the new brain, where are you as far as execution is concerned?
So we have the hardware ready. We're testing it now on the ground as much as possible because...
How many tests have you already done?
More than 70, 80. Every day there's a test happening. Even today there's a test happening.
Okay.
So, because we keep on fine-tuning the algorithm because we want to get the precision right. We'll have a large space in the barge to, where we landed, but still we want to get it literally to be like a bullseye landing. So we have all that buffer built in, but it's just, again, as I told you, asking all the questions, but in a different way completely.
So confident on the back of where you find yourself today that you will be able to do this early next year, early 2027?
Absolutely. Yeah. Very, very clear about that. And I think the steps have been laid out and the hardware is here, which is, a lot. Once you see the hardware, that gives you a lot of confidence.
What has happened with SpaceX? Have you been able to maybe learn from, incorporate as far as your own plans are concerned?
Yeah, they have done 500 or so landings, if I'm not mistaken. Yeah. So there's actually a lot of information available out there. Okay, no one tells you the last 2%.
Yeah.
Right? 98% you can get everywhere. But people have been writing about it. I think people have left SpaceX and Blue Origin landed it now on their first attempt, right? And similarly, we had China landed as well. So there is actually information available. And we have taken this Tesla sort of approach where the entire hardware is already fixed. So between the mission 2 that we're flying now and mission 3 and mission 4, only the software is going to get upgraded, if at all. If not, we're going to keep the outside part of the rocket and the inside hardware of the rocket exactly the same. Fix the rocket now, keep all the hardware in. As I said, all the sensors, the eyes are already in place, all the actuators, the fins, everything is in place. We will just be tweaking the software to make it land with
So
less
it's like an iPhone upgrade, is it?
Yeah, more or less. More or less.
I mean, to put it simplistically.
That's the approach. That's the approach we're taking. Yeah.
So what does it do to economics, to the cost of sending something up with reusability becoming a reality?
Yeah, it's drastic, right? 70 to 80% cost reduction. And I think mission 2, the upcoming mission, it may not be in a completely flyable form again, or we may just keep it as a memento like what SpaceX did. Just put it up there in front of a facility and say this came back from space. But I think the idea is to reuse at least 20 to 30 times. And so the entire economics is now about how can I spread my cost over 30 launches.
How you've positioned the company as rocket, as a satellite. I mean, we've all heard of SAS, but RAS is your thing. Now, explain to us what RAS is all about.
So if you go a little back to the history of it, right, satellites and rockets used to go to very different destinations. So it's like a relay, right? So the rocket would leave you at a particular place.
Right.
And from there, a typical satellite would start a big, long journey. It'll go to what we call geostationary orbit, which is like 36,000 kilometers away. And the rocket's journey would stop with 400 kilometers. And now we're looking at satellites which are operating in the same place in LEO, low Earth orbit, where rockets leave them. So the question came, why are these two different systems? Or why are they actually having so much duplication in them? Because in the past, it was needed. It was like someone left you in one place and you had to go to another place. But now you're basically right there. In fact, the rocket now has to do extra work to move away from colliding into the, the satellite that you just launched.
Right.
They call it, decommissioning the upper part of the rocket, the upper stage of the rocket. So this is one concept. The other one was it's just painful to throw away rocket hardware, right? That we learned even in the previous mission because it was fully functional and we know how much blood and sweat the team put into it, and we just saw it fall into the ocean. And there was telemetry all the way back till it hit the ocean last time. So all of that made us think something should be done to reuse hardware. You can't just throw it away. So these two things together, we started thinking about, can the upper part of a rocket, which anyway goes to space, can that itself behave like a satellite? because it has all the hardware like a satellite. It has the capability to navigate in space like a satellite. It has the capability to communicate back down. So it basically is a satellite without the core payload. So all of these we put together, and now what we have come up with as an upper stage of Agniban, our rocket, is its own complete it's basically a satellite. So the rocket.
So it's a rocket come satellite.
Exactly.
To put it again very simply.
No, it actually is. It's more interesting than that, I would say, because it starts off as a rocket and becomes a satellite.
So it's a transformer.
Yeah, it's a transformer. Or you can say it's a satellite with rocket engines.
Okay.
Right.
Okay.
Which throws away a part, which comes back and lands.
Right.
The other part of it just becomes a satellite.
So that's the RAS model that you were trying to explain to me. You know, what is the pitch that you're making to potential customers and clients today? What can you do for them?
So the pitch is flexibility, right? So if you're a small satellite or any satellite less than 1 ton, today the way to go to space, you don't get any flexibility. There is a particular rocket that flies when it wants. It lifts off from where it wants. It goes to wherever it wants to go.
Right.
And you have to pay a big minimum order quantity price, or you need to pay a lot of other, intermediate people to get the final mission you want out of your satellite. So that's our pitch, right? We are coming and telling you get to decide when you want to launch, you get to decide at what time you want to go, where you want to go to, and we'll give you a menu of options for the price. Let's say, for example, we want to launch from Sriharikota. Then this is the price. If we want to launch from the new launch pad that's coming up near Tuticorin, right, Kulasekarapatnam, then this is the price. Now the customer can decide whether they want to choose this or that, as opposed to usually being given no flexibility. It's like everything is fixed. And you have to choose. Now you're not able to choose. You're actually stuck with it, right?
Yeah.
Here it is like you get to choose. If I choose option A, I get this price. If I choose option B, I get this time and this price. Option C could be something else, but that's what we want to offer.
Okay, so flexibility is core to the strategy and core to what you're offering potential clients and customers. You started, in fact, a year earlier than Skyroot. They started in 2018. You started in 2017. But how different are the two of you in terms of what you offer?
So our technology is completely different, right? Like, let me start with a couple of obvious differences, which are like, for example, with the engines. So we build semi-cryogenic engines, which means our fuel combination is liquid aviation fuel, the same fuel that's used in planes, and liquid oxygen of commercial grade.
Okay.
Right. So the idea, why did we choose that? Because at some point we wanted to attempt reusability. We wanted to be easy to move from one place to the other. With a solid propellant like the ones that Skyroot uses, it's a bit more hazardous to handle. It's a bit more of an explosive.
Right.
So it's a lot of brute force energy addition, which is great for these quick missions that have to go immediately.
Yeah.
But if you're now trying to throttle, you're trying to come back, you're trying to go to a particular point, all of those things need a lot of flexibility in your engine. That solids don't offer as a technology.
Okay.
So which is why we build liquid propellant. So that is, I think, one of the big differences.
we've got all of this excitement at this point in time, but what about the demand? Is demand going to keep pace with all your aspirations and ambitions?
Here we're already seeing a ton of demand, right? I think it used to be only global. I think the last time when we spoke, very few private initiatives in India. And now we're looking at, just at a startup level, about 150 plus startups. We're seeing bigger companies also take up satellite, entire constellations to launch. And that's huge. I think so now there is global demand, which continues to exist, and also now local demand. And I think one thing that has happened in the global scenario is the dollars per kg you pay SpaceX is very low. But then there are so many intermediaries to play with that by the time you actually finish a mission that's commercial for a satellite, it becomes quite expensive. So I think those are the things that, I think are now those are the reasons why demand still continues to exist. Today, to get a slot with the Falcon 9 SpaceX, it's October 28 or so. 2 solid full years plus. And the payment goes up today. So who pays 2 years in advance for almost 100% of the launch price? And then you pay a lot of intermediaries in between. And if something happens in that, that slot, who knows when is your next launch? When a similar customer comes to us, we want to tell them, hey, there is a slot available in Feb, there's a slot available in May, there's a slot available in April. These are the 3 launch pads you can use. Now you tell me what you want to fly.
And what is the usual response when you say that to them?
They're baffled, right? They've not seen it even been offered like that before. So a lot of them are actually waiting for our mission 2 to happen to see how this all translates to actual reality.
So what is the client roster or the potential client roster looking like? And again, if I were to ask you in terms of, what you could book annually, revenue-wise, what does the picture look like today?
So we'll talk launch cadence because launch cadence and revenue come together, right? I think with the idea that we want to bring is 5 or 6 rocket hardware should be able to do about 30 to 40 launches. That's the ratio we're trying to get to, which is 1:5 production. Launch to production should be in that range, right? SpaceX has gone to 15 today, by the way. With 15 rockets, they fly 135, 140 launches. So it's in that range. I think for us, a good target to have, I'm calling it a launch to production ratio. It should at least be in the range of 5 to 7. Which means one hardware at least flies 7 times in 1 year. And so what happens is when we are building a facility, I can stop with around 25 or 30 as a production capacity and still target 150 launches a year. So which I think is a good sweet spot to target in the next 5 years or so. So our idea is to get to 100 plus launches a year in the next 5 years with only about 30 to 40 or maybe less than 30 pieces of hardware. And all our production, everything is sort of, tied to that.
Is geared to that. So in year 1, and I'm assuming if we say year 1 was to be 2027, what's the target as far as 2027 itself is concerned?
Yeah, so we have it planned in terms of 2 blocks. So the rocket comes in blocks usually because you fly the same rocket without changing much back to back, right? So we are already building 3 pieces of hardware together. So even though it's mission 2, in my head, it's very clearly mission 2, mission 3 and mission 4. And then we'll probably take a bit of a breather to learn whatever we learned from the previous missions and then incorporate that into mission 5, 6 and 7. So all of this within a year of when we start doing, that's how we're planning.
So what did you make of the way that the market received the SpaceX IPO and eventually what you believe it does for the entire space tech ecosystem, including companies like yours sitting here in India?
I think a lot of people suddenly, it became a consumer, level story, right? And I think it's the first time when it officially reached mainstream in terms of, as a company. SpaceX story was always there, known to people in the industry, known to people who are following tech. But because it got listed, now almost anyone who's doing some stock investing knows about it. So, and I think we've read about these stories as so many people are now waiting to be, I think tomorrow or day after the expiry of the date, your waiting time goes. So we're going to see a lot of liquidity as well come into the market. So I think it's good news for everyone. I think a lot of people who lost out on investing in SpaceX in the early years are now looking at people like us. So we got a lot of inbound after the IPO as well.
Data centers is the other big story that everybody seems to want to bet on. And that's something that you're looking at as well. So take me through some of the other big bets that are on the cards on the anvil.
I think interestingly now what has happened is people have warmed up to these end-to-end missions quite a bit. People who want to use our upper stage, right? And that's where the data center comes in. So our pitch to a data center builder is very simple. It's like, you don't build the GPUs, that is your forte.
Yeah.
But everything else we can build for you. So you want to put, if your dream is to put a GPU stack in space, the power for it, the cooling for it, the telemetry to get the data back, the navigation to keep it facing the sun or to keep it above the, the pickup tower on the ground, everything is our job. You can come install your GPU stack and it'll just work. And that's exactly what our upper stage is already, right? It's a platform to host the payload. So I think there we found a very natural fit. In fact, 2018-19, in our very early pitch decks, we had a category called unconventional space applications. And the first one was the data center. Of course, no one took us seriously back then. Now we're glad that it's all coming back because I really think it's a brilliant way to take care of the energy problem, right? So what's happening from a business standpoint? So there is this usual space transportation story.
Yeah.
There you're selling cargo rights to space. So that's a KG business, right? Then
I like that. That's a KG business. Yes. KG, not KG.
Right? And then you're talking about end-to-end missions where you're renting out your upper stage for a camera. That's a data business, right? So you're talking about GB, right? Gigabytes, right? And then now you're suddenly talking about hosting data centers and offering a platform, which means it's an energy business. So we are suddenly talking KW, kilowatts.
Yeah.
So yeah.
So from kilograms to kilowatts.
Yeah, so it is covering all those three. I think that is where I think our solution itself has evolved. It is still a rocket company at its core, at its DNA. We want to provide space transportation, but the manner in which I think customers will like it going forward is you provide all three depending upon the need of the customer. If it's just a transport, provide the ride. If it's just data, provide the data. If it is a system that gives you energy to do your business, give that, right? So I think that is how we are positioning ourselves now.
Let's talk a little bit about what it actually takes to get the hardware done. You gave us an insight into what it takes to move on the software side, but the hardware. And yes, we do have an existing sort of ecosystem of vendors and suppliers, but what has that story been like for you to ensure that there is frugal innovation, frugal manufacturing, and to be able to take something up to space?
Yeah, so the great thing about doing space tech from India is ISRO has already done the heavy, lifting
Heavy
work.
lifting, yeah.
They've developed so many vendors. In fact, I don't know if you know this, the vendor management team of ISRO is called Capacity Building Program Office. And that's for a reason. Because the tech that they have, painfully developed actually is used to build capacity outside through tech transfers and so on, right? Which is amazing because there are at least 500, 600 companies of all levels. You're talking from some of the biggest names in the country to a tier 3, tier 4 vendor who you may not even know. All of them know what are the qualification standards it takes to supply to ISRO, or in a broader sense, to supply to a space mission. There's so many vendors around, Chennai who built up entire ecosystems there. So this rocket is actually almost 90-95% completely. Even products are sourced from India. A few sensors come from France, but other than that, it's a India vehicle.
You were talking about how ISRO has really helped lay the foundations for the space sector in India. And I think today the conversation is shifting to, is the private sector's growth in space going to come at the cost of ISRO? How do you respond to that?
Yeah, I don't think that's going to happen at all, because I think the kind of missions and programs that ISRO will do, no business can do. Because the R&D missions, like going to Mars or going to build a space station, today is not a profitable business idea that you can easily sell. So that will have to be taken up by the government, right? And so only with those missions will the private industry next get a business opportunity to do the same thing. So I think it's going to become a little bit like how NASA is, right? All the deep space missions, going to various asteroids, going to Venus, all of these things are going to be ISRO stories. So that's going to require technology development at a completely different scale. And then we have Agnikul and a lot of other people as well who are taking the base and then building commercial solutions out of it. So our tweak comes at that business case level, right? Where like I told you, we are solving for time, price and cost. ISRO will have to solve for technology before it solves for, time, price and cost. So that will still exist. I don't think it's going to be at the cost of ISRO. And I think there is no space industry here without ISRO for sure.
Absolutely. That will continue to be the backbone of India's space sector. You know, you've got the former ISRO chief, Mr. Somanathan, with you as an advisor as far as Agnikul is concerned. Take me through what that has been like to, you know, of course, start at IIT Madras, to be incubated there. But today, as a company that's already found its feet, so to speak, you know, building more capability, building mentorship, what is that story looking like?
I think with Dr. Somnath coming on board, he was gracious enough to accept to, you know, be a board observer for us. So he brings in very interesting blend of extreme pragmatism along with very, you know, a deep-rooted approach to technology, right? He understands the tech really well. So if he wants, he can get down to the nuts and bolts. But at the same time, he can also think about what is the next mission that's supposed to be, right? So I think that's a great blend to have, because otherwise usually people are either big picture or detail focused. He brings both, and he can talk the language that many investors would want to understand. Like, he can talk about business, which is great, I think, right? So I think that's what he brings. But I think overall, one thing that I've realized from our own board, which has been, you know, more financial investor heavy, is if I'll have to take a tech focused idea and sell it to them to get approval, it forces me to think business. So in a way, it's like a guardrail for, you know, not getting too lost in R&D and tech.
So, you know, what would your advice be to somebody who's looking at getting into the space ecosystem at this point in time, wanting to start up on the back of being inspired by all of your stories?
I think it's a great time to be building space tech in India. Everything is opening up, right? I think there's a lot of positive momentum. I think the first 5 to 10 million is actually not hard to get, which is a big deal, I think, right? So, and I think now you have all the other schemes as well. So the only thing the person or the group of people who are coming to do this need is that patience it takes. I think this is a very priced commodity today. It's a rare commodity today.
You know, from a 5-10 year perspective, as far as this company is concerned, because you're building an institution to last, what is the milestone that would be the most significant for you personally?
I think really developing a customer experience where complete flexibility is given, right? Wherein they literally have to do very little in terms of, making the launch contract itself, you know, customized. As I told, here is the mass to orbit. Here is the desired time, and here is the mission, the orbit itself. And then if they enter that in an app or something, they should be able to get 3 options. Sriharikota, January 2027, this is the price per kg. Or whatever, Kulasekarapadnam, March 2028, this is the price per kg. Or Australia, some place, right? That level of flexibility, that is, I think, truly, I would feel that, you know, leaving everything that I had and coming back to this, I've done something for the sector in a small way, if that flexibility is actually available for customers. So that's what we are solving for.
Well, we wish you the very best of luck with that, and we wish everybody at Agnikul the very best of luck as you continue to persevere towards achieving your goal. And hopefully we will, of course, stay in touch with you over the next few months as you get ready for 2027 and the many milestones that you hope to achieve then. But thanks very much, Srinath, for joining us here on Young Turks Reloaded. Well, you heard it from the man himself, all the way from kgs to gigawatts to now kilowatts. That's the Agnikul Cosmos journey for you. Do send us your feedback. We always like to hear from you. Till next week, from the entire team, goodbye and many thanks for watching.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening. Crude oil prices edge higher as the Trump administration threatens to economically isolate Iran. Secretary of War says the U.S. can sustain its naval blockade indefinitely. The Treasury Secretary threatens economic pressure like never seen before. Tehran rejects Washington's assertion that maritime traffic is flowing smoothly through the Strait of Hormuz. The Sensex and the Nifty down 1% this week after a lackluster session on Friday. Metals, auto, FMCG leads the decline. Rupee remains on a tight leash above the 95 mark against the dollar. India's net FI inflows over a decade stand at near zero. Sustained selling in the last 2 years has offset the cumulative money foreign investors added to the market over the previous 10 years. A CNBC TV 18 analysis finds foreign money increasingly pivoted towards AI-exposed markets like South Korea and Taiwan this year. The board of Tata Sons is likely to be recast after Chairman Chandrasekaran's exit in February. Money Control reports senior executives within the group could be inducted. Meanwhile, Tata Trust is seeking an urgent hearing before the Maharashtra Charity Commissioner and is even exploring legal options, including moving the Bombay High Court. The Air India flight from Phuket to Delhi, which suffered an altitude drop mid-air, briefly lost some controls, including hydraulics, according to an analysis by Airbus. But the analysis does not establish the cause. Airbus asked Air India to conduct further checks. U.S. launches a fresh trade salvo. White House accuses more than 40 nations, including India, of helping China to get around U.S. tariffs. Estimates losses between $19 to $26 billion due to what it calls a transshipment scam. Names India, Mexico and Vietnam as China's biggest enablers. The Chief Justice of India, Surya Kant, slams the Bar Council over a short-lived directive asking state associations to not enroll any 2026 batch graduate from the Nalsar Law University. Says the circular was absolutely uncalled for and a dialogue between him and the students should not have led to this. Over 450 Nalsar students had signed a letter opposing Chief Justice Surya Kant as the chief guest at their convocation. 7 people dead, 3 others are missing after an under-construction tunnel was flooded with water and debris in Uttarakhand. 19 workers have been rescued so far after landslides caused the incident at an hydroelectric project. Days after pulling Jamshedpur FC out of the ISL, Tata Steel sells its legacy football club to Churchill Brothers for a nominal 100 rupees. The transfer is subject to clearance from the All India Football Federation. Jamshedpur FC, which saw a turnover of over 32 crores last fiscal, has never won an ISL championship. Well, let's go straight to the top story this evening. Tensions between Iran and the U.S. continue to be high as the Trump administration threatens to economically isolate Tehran. Here are today's developments. U.S. Vice President J.D. Vance has said that the U.S. will prevent Iran from obtaining a nuclear weapon while maintaining stable energy prices. Vance told Fox News the U.S. would emerge from the standoff with Iran in a stronger position. He also said the Trump administration is using diplomatic, military and economic tools to secure its objectives. U.S. Treasury Secretary Scott Bessent echoing Vance's views in an interview to Newsmax. Bessent warned that the U.S. will apply unprecedented economic measures to isolate Iran, adding that the move will be part of a 1-2 punch that includes the continued blockade of Iran's ports. U.S. Secretary of War Pete Hegseth has said the U.S. military has enough assets to maintain the blockade indefinitely, also disputed reports about poor conditions aboard the USS Abraham Lincoln aircraft carrier in West Asia. Now, 2 military-focused publishers and Reuters report that sailors tried to jump overboard the ship, which has been at sea since November last year. The Wall Street Journal reports the U.S. is sending USS George Washington carrier to replace the existing Lincoln aircraft carrier. Now, Iran maintains that its Revolutionary Guard Corps controls the Strait of Hormuz. The RGC claimed that no ship can safely pass through the waterway without Iran's permission and supervision. In the oil market, Brent crude prices remain near the $90 per barrel mark. Kepler data shows commodity vessels transiting at Hormuz has picked up, but only slightly, still lower than the month's daily average of 12 in August so far. Let's talk about the day's market action. Now, the market's ending lower after a muted session. The Sensex down 71 points. The Nifty dropped 30 points. Mid-caps bucking the trend today, up by about 330 points. If you take a look at the story for the week, the markets have snapped a 2-week gaining streak with the Nifty and the Sensex falling nearly 1%. So that's the picture for the markets this week. The mid-cap index closing, though, in positive territory. Staying with the markets, India's net FI inflows over a decade now stands at zero. Sustained selling in the last 2 years have offset the cumulative money foreign investors added to the market over the previous 10 years. Sudarshan joins us now with a detailed analysis. Sudarshan, so FII inflows virtually zero over a 10-year period?
From September 2016 to December 2024, that's 100 months, FIs had pumped nearly $46 billion into Indian equity markets. And in the next 19 months, that is from January 2025 to July 2026, that entire $46 billion were withdrawn. So net-net, no inflows. Some silver lining though. The last 2 weeks of August have seen the inflows of nearly $2 billion. Now let's break that inflows data year-wise and the events that likely to have played a major role. In the second half of 2016, the rate hike by US Federal Reserve and the liquidity shock led to outflows of nearly $3 billion. In 2017, emerging market basket had seen a major rally. MSCI emerging market had surged nearly 38% against 11% move in 2016. And because of this, Indian market too saw inflows of nearly $8 billion. But nearly 50% of 2017 inflows got reversed in 2018 as crude oil surge weighed on emerging markets. Come to 2019, Modi government came back to power for the second term, and the government announced a cut in corporate tax rates, and we closed the year with inflows of more than $14 billion. But 2020 was a different year. We started the year with a COVID fear and had seen a continued market fall in the start of the year. But no one had expected that recovery would be so much sharper. And the recovery was so sharp that we at the end saw inflows of nearly $23 billion. In 2021, we saw recovery even in global economies. Global GDP had recorded growth of almost 6% in 2021 against contraction of 3 to 4% seen in 2020. And in the process, we saw inflows of nearly $4 billion. In 2022, a global inflation shock driven by pandemic supply chain snarls and the war in Ukraine forced the US Fed into its most aggressive monetary tightening cycle in decades, raising interest rates from near 0 to 4.5%, and US consumer prices hit a 40-year high of 9.1%. And the impact we felt here too. FI outflows of more than $16 billion. But it didn't take much time to reverse those outflows. Very next year, FIs gone gung-ho on Indian equities. As just a year ahead of election, government too went aggressive on capex front by announcing an increase of almost 33%. And the result? FI inflows of nearly $21 billion. In 2024, Indian equity market hit record highs in September, driven by strong retail momentum. But shortly after, October 2024 marked an unprecedented reversal with a record-shattering FI net outflow of over $11 billion. But we managed to end the year with minor inflow of $0.1 billion. Now, FI outflows starting October 2024 continued till decently. And that led to total outflows of $46 billion till July 2026, nearly $19 billion in 2025, and more than $27 billion in first 7 months of 2026. But if there are some positives, it's the last 2 weeks. FIs have infused nearly $2 billion in August so far. So the key question now, does August mark the beginning of a sustained return of foreign capital, or just a temporary pause in a broader global reallocation?
The only missing link, as we all know, in the last 2.5 years has been the flows. The FI selling has been massive. We are all aware about the numbers. In fact, on a decadal basis, they've become neutral now. In the last 10 years, cumulative flows of FI is zero now. They've bought $69 billion in primary market, and they've sold exactly $69 billion in secondary market.
Well, that's FI data for you, the trend over the last 10 years. And because of the outflows that we've seen, it over the 10-year period down to zero. India's wholesale price index eased marginally to 9.78% in July as prices of fuel, power and food items have cooled. However, manufactured products saw an uptick in inflation at over 8% against 7.48% for the month of June. Shares of Piramal Pharma down over 3% in trade after Carlyle's exit from the company hit a roadblock. Sources tell CNBC TV 18 the private equity major's block deal to sell a 6% stake worth 1,750 crore rupees has likely been called off due to tepid investor demand. Shares of Zee Entertainment surging in trade. This after the Securities Appellate Tribunal, that SAT, granted interim relief to the company in its case against SEBI. The SAT has stayed SEBI's order against Zee Entertainment and allowed the company to proceed with its proposed preferential warrant issue worth over 3,100 crore rupees to promoters. The tribunal also allowed the company to access its mutual fund units for dividend distribution. Adani Birla-led Tata Microfinance has filed its draft red herring prospectus for a 300 crore rupee IPO. The offer has been split evenly between a fresh issue and an offer for sale. Adani Birla and her firm Antimatter Media together hold nearly 60% in Tata Microfinance, so heading to the Lal Street. The latest in the Tata Sons succession saga, the Tata Sons board is likely to be recast following Chairman N. Chandrasekharan's exit in February next year. Sources tell Money Control that the holding company is likely to induct senior executives from within the group to its board. The changes are expected to be considered as part of the transition to a new chairman, with some existing directors potentially retiring or even leaving. Discussions are still preliminary. No final decision has been taken on either the size of the board or potential new members. Meanwhile, the Tata Trust is seeking an urgent hearing before the Maharashtra Charity Commissioner and is exploring legal options, including moving the Bombay High Court. Rachna joins us now with the latest. Rachna.
Tata Trusts are now exploring their legal options, and that could mean going to the Bombay High Court. That is what our sources are telling us this morning. Now, yesterday, the trustees of the Sir Dorabji Tata Trust met and adopted the resolution on N. Chandra not seeking reappointment. The trust also had to appoint a joint nominee for the upcoming AGM. And that could not happen because Sir Ratan Tata Trust, the trust with which it has to appoint the nominee jointly, cannot participate in meetings owing to the Charity Commissioner's freeze. And since there is no update on that front, the restraint order of the 15th of May continues to apply, which is why the next option is the High Court, the appellate authority on Charity Commissioner's orders. Now, we've gone through Tata Sons Articles of Association, and they tell you exactly how tight this is, because until yesterday, this was about one nominee being jointly appointed. From today, it's about 4. Article 86 is the first one. Quorum at a general meeting needs at least 5 members personally present, and that must include one authorized representative jointly nominated by Sir Ratan Tata Trust and Sir Dorabji Tata Trust. But now look at Article 118, which governs succession at Tata Sons. The moment a chairman has to be chosen, a 5-member selection committee has to be constituted, and 3 of those 5 are nominated jointly by the same 2 trusts. The chair of that nominee also, the committee also comes from those 3. So one joint nomination for the AGM, 3 more for the selection committee. Sir Ratan Tata Trust cannot take a board decision right now. So in all likeliness, the AGM is also expected to be adjourned if no legal relief comes for the Tata Trust.
Yes, that is the important question, and the uncertainty continues. Rachna, many thanks for joining us. Now, CNBC TV 18 has accessed an analysis by Airbus on the Air India flight from Phuket to Delhi, which suffered an altitude drop mid-air. The analysis shows the aircraft briefly lost some controls. However, the analysis does not establish the cause. Shivani joins us now with details. Shivani, take us through the preliminary report, the initial assessment by Airbus.
Well, yes, sources tell CNBC TV 18 that the Air India Phuket-Delhi flight did briefly lose some of its key controls, including the aircraft's hydraulic systems. But Airbus's initial assessment does not establish why that happened. We have accessed the dossier sent by Airbus to Air India in response to the airline's queries after the incident. And according to the assessment, the aircraft first lost pressure in one hydraulic system, followed within seconds by the other 2. This meant the aircraft temporarily lost control of its elevator and ailerons for around 4 seconds. The surfaces that help pilots control the aircraft's movement up, down and sideways. Aviation experts tell us that a simultaneous loss of pressure in all 3 hydraulic systems is an extremely rare occurrence. The reason aircraft have 3 separate hydraulic systems is precisely to provide redundancy, so that even if one system fails, the others can continue powering critical flight controls. Sources say the pilots struggled to get an immediate response from the aircraft during those crucial seconds. The hydraulic system then recovered, allowing the pilots to regain control. Importantly, Airbus analysis shows does not establish the cause of the simultaneous loss of hydraulic pressure. Now, Airbus has therefore asked Air India to carry out further checks of all 3 hydraulic systems, including the relevant pressure switches, transmitters and other components. It has also sought additional maintenance information and inspection of the aircraft. The incident took place at around 9:32 a.m. on India Standard Time on August 4. Airbus's response to Air India was submitted later that night at around 1:59 a.m. IST on August 5. So Airbus has now given Air India a clearer picture of what happened during those crucial seconds, but what triggered the hydraulic failure is still under investigation. Back to you.
Shivani, many thanks. Now, the Trump administration has accused over 40 nations, and this includes India, of helping China to circumvent U.S. tariffs. The White House has estimated losses of between $19 to $26 billion due to what it calls, and I quote, transshipment scam. Abhimanyu joins us now with more details. Abhimanyu, take us through what the U.S. is alleging and what does this now mean for India and the current trade negotiations? Has there been any response from the Indian government?
Well, a response is yet to come formally as well as informally from the Indian government on the allegations which have been leveled by the United States. They have accused several countries, including India, of helping China evade tariffs through shadow transshipments. And the US is possibly going to use artificial intelligence to detect such shipments. The US has also indicated that such practices became much more common after 2018 when the US had levied Section 301 on China over the issue of unfair trade practices. Now, it remains to be seen what kind of a bearing this is going to have on India's trade negotiations with the United States, since the terms of reference which already have been finalized between India and the United States for a possible BTA cover 19 chapters, which include issues like rules of origin, customs facilitation, tariffs, goods and non-tariff barriers. So the issue of rules of origin is very much there between India and the United States as far as the terms of reference of a BTA are concerned, which will possibly prevent any transshipment from India into the United States. Now, it remains to be seen what kind of a response would formally be provided by India, either by the government or by India's exporters. Now, meanwhile, the GTRI has indicated that India should seek a shipment-level evidence to protect legitimate exporters from any action from the American side. It has also cited data that US's imports from China had fallen from $525.8 billion US dollars in 2017 to $227 billion in 2025. However, the global imports had still increased by the United States, which clearly indicates that if not China, goods were certainly coming into the United States through several other geographies, and China had countered US tariffs by supplying more intermediate goods to manufacturers participating in global value chains. So it remains to be seen what kind of an action is going to be taken by India's exporters, as well as what kind of a response will be given by the Indian government as part of trade negotiations, which already cover the ambit of rules of origin, which is possibly going to check any such concerns on the American side.
All right, many thanks, Abhimanyu, for joining us. We'll head into a break, but up next, days after pulling Jamshedpur FC out of the ISL, Tata Steel sells its legacy football club to Churchill Brothers for a nominal 100 rupees. That and more when we return. Chief Justice of India, Surya Kant, slams the Bar Council over a short-lived directive that asked state associations not to enroll any 2026 batch graduate of the Nalsar Law University. Over 450 Nalsar students had signed a letter opposing Chief Justice Surya Kant as the chief guest at that convocation. Now, the Bar Council's chairman, Manan Mishra, said that the order was issued suddenly and in haste, but it was withdrawn within 40 minutes.
ये अचानक थोड़ा आनंद फानन में एक ऑर्डर हुआ, उसको तुरंत 40 मिनट के अंदर उसको विड्रॉ कर लिया गया, उसको मॉडिफाई किया गया और फिर रात में काउंसिल का थॉरो डिस्कशन हुआ। हम लोगों ने सब में मिलके ये किया कि ये ऐसा मामला है कि इसमें कोई इंक्वायरी की जरूरत नहीं है, वैसे कोई, इसलिए दैट चैप्टर स्टैंड्स क्लोज नाउ। पूरी तरह वो कंप्लीटली जो है सो चैप्टर बंद है।
Well, that is Manan Mishra there on the order which was withdrawn within 40 minutes. Ashmit joins us now with more on this controversial order. Ashmit, the Bar Council backtracking after outrage and some harsh words today from the Chief Justice himself to the Bar Council.
Indeed, the Chief Justice was not in the mood to be kind as far as Manan Kumar Mishra is concerned, especially that order that he passed, which initially had said that no enrollment of Nalsar students in 2026 as advocates, and number two, had also instituted an inquiry. Now, this issue was flagged before the Chief Justice of India. He essentially said that, look, this is an issue that lies between the students, about 450 of them, who have written to him and saying that this is an issue that exists between the students and I. What business does Manan Kumar Mishra, what business does the Bar Council of India have in terms of intervening and intervening in the fashion that it does? The petitioners before the CJI raised the question that there are various Bar Council members who themselves were not privy to this decision having been made by Manan Kumar Mishra, and towards that end, that is what led to the outrage, that is what led to a recall of that entire order. So as of right now, no enrollment bar as far as the students are concerned. Also importantly, there is no inquiry that is being instituted, and towards that end, the CJI has passed preventive orders saying that no punitive action is to be taken either against any of the students or against the faculty members. The CJI making it clear that, look, even if the students may be wrong in opposing his invitation to Nalsar, they still have a reason to make their voice heard, that the right to protest, as long as it's peaceful, is in fact a constitutional right, and that there is no room here for the Bar Council of India to pass such sweeping orders.
All right, Ashmit, many thanks for joining us. Now, the Supreme Court has quashed a criminal complaint and summons issued against Congress MP Rahul Gandhi over his remarks against Hindutva ideologue Vinayak Savarkar in 2022. Cases filed in UP over comments made by Gandhi during the Bharat Jodo Yatra. The Apex Court observed the criminal proceedings lacked a particular sanction required under the law to prosecute Gandhi in the case. Now, days after pulling Jamshedpur FC out of the ISL, Tata Steel has sold the team to legacy football club Churchill Brothers for a nominal 100 rupees. Matthew Thomas joins us now to explain what is going on here. Matthew, Jamshedpur FC being sold for all of 100 rupees?
Well, Tata Steel has officially approved the divestment of its entire stake in Jamshedpur Football and Sporting. That's the entity behind the ISL club Jamshedpur FC. Churchill Brothers Sports Club is acquiring the club's 4 crore equity shares for a nominal cash consideration of just 100 rupees. This deal includes the transfer of the club's Indian Super League sporting license and the existing contract for 12 players and 2 coaches. So this means Churchill Brothers will officially take over the contracts for all Jamshedpur players and coaching staff. Jamshedpur FC saw a turnover of 32 crore rupees in the last financial year. Now that represents 0.01 consolidated turnover and carried a negative net worth of 5.8 crore rupees as of March 31st. Tata Steel previously told CNBC TV 18 that they would not reconsider the club's decision to withdraw from the ISL. But Tata Steel is not transferring its physical infrastructure. Instead, they will maintain their facilities in Jamshedpur, repurposing them for grassroots football. This comes as Jamshedpur FC reached the quarterfinals of the Durand Cup. Churchill Brothers is a storied club with 2 I-League titles and nearly 40 years of history. And they're expected to complete the transition by the 31st of August, pending final approvals from the AIFF. Before this dramatic takeover, Churchill Brothers spent years locked out of the top flight of Indian football, culminating in 3 separate rejections by the Federation and rival clubs in a single month. But the big question now is, will the two entities merge into one new identity, or will Jamshedpur FC live on?
All right. Many thanks, Matthew, for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Centricity has raised 280 crore rupees in a Series A round led by SMBC Asia Rising Fund, with existing investors including Lightspeed India also participating. The well-tech startup will use the funds to scale its technology, distribution business and private health operations in India and global markets.
Rasa Group is investing 15 crore rupees to scale its cloud kitchen business, Ji Bhar Ke, with plans to launch 5 to 6 new kitchens across north and central India over the next 12 to 24 months. The brand is targeting 150 to 200 crore rupee business over the next 5 years.
Scrubsy has raised 27 crore rupees in seed funding led by V3 Ventures after growing 100% year-on-year and acquiring over 5 lakh customers within 8 months of launch. The bootstrap EBITDA positive home cleaning brand is targeting 100 crore rupees in ARR by FY28.
Databricks has crossed a $7 billion revenue run rate, growing more than 80% year on year, and has raised $5 billion in a funding round at a $190 billion valuation. The round was led by Coatue along with Blackstone, MGX, and other investors.
Alphabet's 2015 investment in SpaceX has surged more than 100-fold to about $94 billion, making the Google parent the largest institutional shareholder in the rocket company, following its $86 billion IPO in June. Those were the headlines we've been tracking for you this evening. On Investor Eye today, Bluehill.vc has closed its maiden frontier tech fund at 400 crore rupees, backed by SIDBI, the governments of Kerala and Uttar Pradesh, family offices and other investors. The fund has already deployed over 100 crore rupees across 7 companies and plans another 80 crore rupees over the next 6 months. Joining me now is Manu Iyer, the co-founder and managing partner of Bluehill.vc. Manu, welcome to Startup Street. 400 crore rupees maiden fund focused entirely on frontier tech, and you've also exercised the 50 crore rupee green shoe option. Manu, what does the fundraise tell you about LP appetite for deep tech today? For almost 2 decades, Indian venture capital was dominated by consumer internet, SaaS and fintech. Has frontier tech finally moved from a niche allocation to a mainstream venture investment thesis?
Hi, good evening. Glad to be here today. So LP appetite has been fantastic for the thesis of frontier tech, or more broadly deep tech. It has definitely become more mainstream today. The government has realized that there needs to be sovereignty in defense, in space, in aerospace, in semiconductors, and they've put together a multitude of programs to support companies that are building in these spaces. The big one, obviously, that everyone is talking about is RDI. SIDBI has a large allocation in their fund of fund 2 for deep tech funds. But there are other programs like the India Semiconductor Mission, which just announced 1,25,000 crore allocation for the broader semiconductor ecosystem. On the back of a successful ISM-1. The program that ended up creating things like the Tata Fab, and then all the different OSAT facilities, and then multitude of startups that got funded through that and have started building in the fabless space. IDEX is a big program that has been very successful. InSpace supported space startups today. FAME subsidies have been there for some time, supporting the EV ecosystem.
All right.
So I think there is a lot of money that is now coming into the ecosystem. I think it's a great place to be. A lot of funds are, either putting together allocation for deep tech today, or creating brand new funds to focus on the deep tech space.
Yes.
And all of that is a great place to be.
Sure. And you're looking across a very wide canvas: defense, space, semiconductors, nuclear energy, advanced materials, robotics and manufacturing as well. Where are you seeing the strongest pipeline today? And if you had to pick 2 or 3 sectors where India has the best chance of creating globally significant companies, which would they be?
I think 2-3 spaces. Semiconductors is a very strong space that I think there's a big opportunity in today. Aerospace and space also, there's a great opportunity. I think this comes down fundamentally to a couple of things. One, the talent pool that India has in some of these spaces. Some of the biggest GCCs in the world operate out of India, whether it's Intel or Qualcomm. There's fantastic talent in these spaces. Similarly, the talent that is coming out of ISRO and that's coming out of DRDO. Time back, there was some news around people leaving ISRO, and the reason is that there are now pathways to entrepreneurship in spaces that need a lot of capital.
Okay. And deep tech startups can take years to commercialize, require significant capital, and often face binary technology risk. Manu, I believe the fund will have a concentrated portfolio of just 15 to 16 companies. How do you then underwrite that risk at the seed and Series A stage? And what evidence do you need before writing that first $1 to $2 million check?
So for us, the critical lens is on the IP itself, right?
Okay.
So the reason we call ourselves frontier tech and not deep tech is that we're looking for IP that stands its own globally. So ideally, what we're thinking about is to invest in the Amazon equivalent and not in the Flipkart, if that logic makes sense. And what we're trying to do is to find those companies that stand their own against global competition. So example would be ethereal exploration, which was just on screen. They are trying to build reusability of the second stage of a launch vehicle. Now that is something that today, even the global majors like SpaceX do not do. And, we are trying to attempt it from India.
Okay.
And those are the lenses that we are trying to use. Obviously, that's the tech lens. The second lens is on the founder, the quality of the founder, their background,
Yes.
what is driving them to solve the problems that they are.
Okay, and you've already deployed over 100 crore rupees across 7 companies and plan to invest another 80 crore rupees in just the next 6 months. One challenge, Manu, for Indian deep tech startup has traditionally been the journey from a successful prototype to large-scale commercial deployment. Is the bigger funding gap today at the research stage or in taking technology from the lab to actual industrial scale? And also very quickly, you're already talking about another fund in 2027. What will determine the size and strategy of this fund too?
So today, I think the gap is more on the growth side of things. The early stage, I think there's a lot of capital that has come in. Angel funds exist. There are a bunch of grant programs from the government. There is investment happening from different PSUs today. There are early stage funds that are there are quite a few of them that are there in the market today. So I think that part of it is largely taken care of. What is now needed is people coming in to underwrite Series A, Series B, Series C confidently. And I think that still that lens that people still use is connected to the consumer and SaaS tech startups, where they are used to seeing strong revenues, at the stage that they underwrite a Series A or Series B. And that's not necessarily the case for a deep tech startup. And so that change in mindset needs to happen. And I think it's slowly happening, but there's a gap there.
Okay, and what about Fund 2? Very quickly in 20 seconds.
Sure. Fund 2, we're targeting a growth stage fund, about 1,200 crores. The thought process here is to underwrite larger checks, exactly what I was just talking about, the gap. So we're looking to do, 40 to 50 crore type of checks, into companies that mature, from like TRL 3, 4 to maybe 6, 7.
All right, Manu, we've completely run out of time. Many thanks for joining us on Startup Street today and wish you the very best with Fund 1 and Fund 2 as well. Thank you so much.
Thank you so much.
And moving on, India's deep tech ecosystem is attracting unprecedented investor interest. From semiconductors and defense to space tech and AI, investors are betting that the country's next generation of global technology champions will emerge from these sectors. Riding this momentum, venture capital firm Piper Serica has announced the first close of its 800 crore rupee Bharat Tech Fund, raising 300 crore rupees in just 45 days. The fund will back deep tech startups building intellectual property across some of India's most strategic technology sectors. And joining us now to discuss the opportunity and where the next wave of innovation is coming from is Ajay Modi, the director at Piper Serica. Ajay, thank you so much for taking time out and being here with us on Startup Street. You've raised this 300 crore rupees within 45 days of launching this fund, right? What's driving this rush of capital into deep tech now? And, if you heard, we also spoke to another deep tech investor just before this. So there's a lot of capital going into India's deep tech sector. Is it conviction in the sector or a lack of opportunity elsewhere? And when will you close this fund?
Thank you for having me on the show. I think it is definitely conviction in the sector. We are seeing capital that is moving out of the traditional consumer and consumer internet, and that is backing the next wave of disruption, which is coming from the deep tech and the frontier tech sectors. And that shows in our quick first close in a matter of 45 days. We got 300 crores. We are already at 400 now. And almost 60% of that has come from repeat investors from the Fund 1. I think what investors are clearly seeing is that a conjunction of multitude of factors. There is a very strong policy tailwind towards sectors like semiconductors, robotics, deep tech sectors like advanced electronics, space tech, aerospace, defense. And then there is a lot of capital, both government, private, and global. So a lot of capital is now kind of moving towards engineering and IP-led businesses. And lastly, needless to say, India is a very, very bright talent pool. We've already seen young founders who've built and scaled very large consumer internet companies. So all of that put together, I think, is giving good confidence to investors that, look, they can ride this next wave of disruption. And more specifically, in case of Piper Serica, because we already have a very, very strong fund one track record, zero write-offs, zero failures, 44% IRR, early DPI. I think all of that put together is giving investors a positive signal, I would say.
Absolutely. And, if you could quickly tell us, you're writing 20 to 50 crore rupee checks for your fund to companies, right? Which sectors are seeing the strongest deal flow today? Is it semiconductors, defense, space tech, or AI? And where do you see the biggest commercial opportunity?
I would say that there is very good deal flow across the board. I mean, semiconductors, we are seeing fabless companies that have done their successful first tape outs that are going into production. When it comes to space tech, we are seeing companies that are ready for their next phase of launch. When it comes to, again, advanced electronics, I think is one space where we are seeing very, very strong opportunities. Founders who've already done the hard work of building an IP, building a product, and now going into commercialization, having very, very strong order book signals from large enterprises. So deal flow is promising across the board. We're seeing good scaled companies for that kind of a check size in Series A for defense, for space, a little bit for semiconductor, but a lot of them for advanced electronics, I would say.
Absolutely. And when will you start deploying the capital from this fund? And have you already looked at a few companies that you're going to invest in?
Oh, we already have signed our first term sheet for the deployment. We have two more that we are closely evaluating. We have a deal pipeline of about 45 companies as we speak. So I think we would be ready to deploy. I mean, we are already calling capital, so we'll be ready to deploy in a few weeks from now.
So ready to deploy in a few weeks from now. But, many Indian deep tech startups, they have impressive technology, but they're struggling to sort of commercialize it, right? What are you looking for beyond great IP before writing the check?
I think we are already seeing companies that have done the hard work of building a product, got early customer traction, clearly built an order book. So I do not see that problem that companies are struggling to commercialize. I think it is all about the founder capability. There are some founders who are excessively focused on only technology and product building. But we are seeing great founding teams where you have founders who are already taking their product, co-building with a customer, I would say. We have seen a lot of our portfolio companies who have successfully already commercialized, built an order book. And large part of that is coming from their capability to work with very large enterprises, co-build into their ecosystem. So again, I don't really see a challenge of commercialization. I think there are more opportunities for founders. I have seen founders who are grappling with, okay, how do I fulfill? I have these large 4 OEMs who want my product. How do I fulfill that? Because I do not have the right production capabilities. So I think our capital will go more into founders who've already built the sales funnel. They are either looking to build large QA/QC facilities, either looking to build large globally certified labs, or globally respected manufacturing facilities.
All right. Ajay, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best on your journey going forward.
Thank you.
On that note, it is time for us to head into a short break. But on the other side, AUM Ventures is also doubling down on India's big deep tech opportunity with a 750 crore rupee fund. Details on the other side. Stay tuned.
Welcome back to Startup Street. AUM Ventures is doubling down on India's deep tech opportunity with a 750 crore rupee India Innovation Fund 2 after raising 225 crore rupees in the first close, with over 65% coming from international LPs. The fund will focus on space tech, semiconductors, defense, AI, robotics and advanced manufacturing, with a strong emphasis on IP-led companies that can compete globally. Chetan Mehta, founding partner AUM Ventures, joins us more on this, and also with me, I'm my colleague Arundhati. Chetan, welcome to Startup Street. You have a 750 crore rupee target and have closed 225 crore rupees so far. How quickly do you expect to reach the final close? And are you seeing enough LP appetite to get there? And how much of that capital do you expect to deploy over the next 12 to 18 months?
Thank you for having me. I think it's a great time right now in terms of what we are seeing in the Indian market in terms of founders really building and going after core deep tech and innovation-led solutions. So I think we are there to support innovation coming from India and also work with founders very closely to take them global. As far as our fund is concerned, I think we've got a great response, and I have a strong interest not only from India but also globally. We plan to wrap up the fund by end of this year and plan to deploy as early as this month. Given that we have done the first close, so and we have a great pipeline of companies working with some very strong founders. So looking to start writing checks by end of this month.
Looking to start writing those checks by the end of this month, and there is great appetite for deep tech companies in India. On this show alone, we've spoken to 2 more investors before you who have funds for deep tech startups. So you are investing in 25 to 30 companies over 5 years. Does that mean roughly 25 to 30 crore rupees of total fund capital per company once follow-ons are concluded? How much are you actually reserving for follow-on rounds as well?
Actually, we have a different strategy where we want to keep kind of backing companies right up to Series A or even Series B, and that's what we've done in Fund 1 as well. So we have a larger kind of a 50% reserve pool to keep backing the winners coming out. So there have been companies in Fund 1 where we were the first investors, and we've invested right up to Series B. So therefore, we like to partner with companies and work with founders as co-founders in that journey, support them, not only in India, but leverage on our global network to see how we can help these companies scale up globally. See, because, deep tech companies at the end of the day have to be globally competitive from day zero. So therefore, working with the founders to develop that global mindset, making sure that, how we can open doors for them in international markets, and also, help them scale up and also fundraise from global funds. So I guess, deep tech requires a different lens. Of course, patient capital is required, but also, the right strategy to help and become globally competitive businesses is very important.
Absolutely. But, where is the opportunity? You're looking across space tech, semiconductors, defense, AI, robotics, like I mentioned earlier. In fact, you were an early investor in Skyroot. What's the next Skyroot? What is the next category where you think India could produce a globally significant company?
I think space is still as an area very early. So, we feel that there are many companies doing niche, space related solutions which can be, globally competitive. I think semiconductor is something which we have been looking at very closely, and we have made investments in Fund 1 as well. So we have a thesis there and looking at, a lot of companies in the semicon space. Defense is obviously, there's a huge market opportunity. But again, we are being a bit cautious there because we still want to see how the government procurement cycles are kind of panning out. But again, it's a big opportunity there. AI obviously is getting mainstream. We are looking at more vertical AI plays to see, founders coming with some core deep sector expertise and trying to leverage AI to build, ground up solutions. So I think, these are the, key areas, but also, related areas are, energy or even biotech. With the advancement in AI, now it's very fast to kind of take your idea from a lab to a market. And, we want to kind of, back such research-led, startups also, which we are seeing coming out of, incubation centers. In fact, just as we speak, today we have launched our India Deep Spark program. This is a flagship program to attract, the top quality entrepreneurs in the country, building in these core deep tech areas. So we are inviting applications from deep tech startups to kind of come in and we want to work with them very early from that early stage.
Absolutely.
And help them, yeah.
And if you could tell us in 10 seconds, we're running out of time, what sort of returns is this fund expected to generate for your investors? And deep tech can take years and substantial capital before commercialization, right? So how do you sort of balance the long gestation periods with returns?
No, I think, deep tech requires patient capital. So therefore, the investors that we are coming in are also informed investors who understand, the level of investment which is required. But I think India has the opportunity where, we can even deliver a 10x fund kind of outcomes to investors now, which, we've seen had that happen in China and US 15, 20 years back. I think this is India's time, and yet in India we can deliver very strong returns and large outcomes in such deep tech companies.
All right, on that note, it's time for us to wrap up this conversation. Many thanks, Chetan, for your time today on Startup Street, and wish you the very best.
Thank you so much. Happy Independence Day to all.
Yes,
thank you. It is Friday and it's time to take stock of all the deals from the startup world. According to Venture Intelligence, this week saw a total of 15 deals worth $581 million. Some of the notable deals include e-bike rental firm Yulu Bikes, which got $63 million in equity from GEF Capital Partners, while wealth tech firm Centricity bagged $24.14 million from Berman Family Office, Lightspeed Ventures, and more. Meanwhile, warehouse developer NDR Smart Spaces attracted $23.59 million from IFC.
Well, that's not all. Online bakery Baking Go raised over $10 million from Fairing Capital, while home cleaning product seller Scrubsy added $3 million from V3 Ventures. According to Venture Intelligence, this year has seen a total of 131 deals worth $5.8 billion.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates continue right here on CNBC TV 18.
Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Tata Trust aims to finalize the next Tata Sons chairman before the end of the year. Sources say Noel Tata could head the search committee, and the board is likely to be recast of Tata Sons as well once Chandra exits in February next year. A restraining order on Sir Ratan Tata Trust from holding a meeting stalls the joint nomination process needed to form the selection committee for Chandra's successor. Tata Trust seeks an urgent hearing before the Maharashtra Charity Commissioner, also explores legal options including moving the Bombay High Court. Reliance Industries signals its foray into the defence sector, announces a strategic intent to partner with UK's Rolls-Royce to build engines for advanced medium combat fighter jets. RBI announces the closure of the window to shore up dollar deposits from NRIs by the 31st of August, which is 1 month earlier than initially planned, cites encouraging response to the scheme, which has raked in deposits worth more than $52 billion so far. India's net FII inflows over a decade stand at zero. Sustained selling in the last 2 years has offset the cumulative money foreign investors added to the market over the previous 10 years. A CNBC TV 18 analysis finds foreign money increasingly pivoted towards AI-exposed markets like South Korea and Taiwan this year. The Sensex and the Nifty down 1% this week after a lackluster session on Friday. SEBI meets market makers, domestic mutual funds and stockbrokers to address their concerns over the new closing auction mechanism as it completes 2 weeks. Crude oil prices edge higher as the Trump administration threatens to economically isolate Iran. Secretary of War Pete Hegseth says the U.S. can sustain its naval blockade indefinitely. Treasury Secretary Scott Bessent threatens economic pressure like never seen before. Tehran rejects Washington's assertion that maritime traffic is flowing smoothly through the Hormuz. The Air India flight from Phuket to Delhi, which suffered an altitude drop mid-air, briefly lost some controls, including hydraulics, according to an analysis by Airbus. But the analysis does not establish the cause. Airbus asked Air India to conduct further checks. The U.S. launches a fresh trade salvo. The White House accuses more than 40 nations, including India, of helping China to get around U.S. tariffs. Estimates losses between $19 to $26 billion due to what it calls a transshipment scam, names India, Mexico and Vietnam as China's biggest enablers. The Chief Justice of India, Surya Kant, slams the Bar Council over a short-lived directive asking state associations not to enroll any 2026 batch graduate from Nalsar Law University. Says the circular was absolutely uncalled for, and it's a dialogue between him and the students. Over 450 Nalsar students had signed a letter opposing the Chief Justice as the chief guest at their convocation. 7 people are dead and 3 others are missing after an under-construction tunnel was flooded with water and debris in Uttarakhand. 19 workers have been rescued so far after landslides caused the incident at a hydroelectric project. Days after pulling Jamshedpur FC out of the ISL, Tata Steel sells its legacy football club to Churchill Brothers for a nominal 100 rupees. The transfer is subject to clearance from the All India Football Federation. Jamshedpur FC, which saw a turnover of over 32 crores last fiscal, has never won an ISL championship. Well, let's start with the day's market action. As always, they ended lower after a muted session. The Sensex slipped 71 points, while the Nifty dropped by about 30 points. The mid-caps closing about 0.5% lower as well, and the Nifty Bank was down by about 140 points. That's the story for the day. For the week, the market snapped a 2-week gaining streak with the Nifty and the Sensex falling nearly 1% each. The Nifty mid-cap just about closing 300 points higher. For the rest of the indices, it was down in the red. The big story this evening, the latest in the Tata Sons succession saga. Now, Tata Trust, which holds 66% stake in Tata Sons, that's the holding company of the conglomerate, is aiming to finalize Chandra's successor before the end of the year. That's the hope. Sources tell Money Control that the Tata Trust chairman, Noel Tata, could head the search committee. Harsh Manvani could be the Tata Sons nominee on the panel. Remember N. Chandrasekaran's decision to not seek a reappointment when his term comes to an end in February next year has ensured that the chairmanship of Tata Sons is up for grabs. That's not all. The Tata Sons board is also likely to be recast following Chandra's exit in February. Sources tell us that the holding company is likely to induct senior executives from within the group to its board. Discussions are still preliminary. No final decision has has been taken on either the size of the board or the potential new members. Meanwhile, Tata Trust is seeking an urgent hearing before the Maharashtra Charity Commissioner and is exploring legal options, including moving the Bombay High Court. Rachna standing by now to take us through what the options are and how Tata Trust is hoping to break this impasse. Rachna.
Tata Trusts are now exploring their legal options, and that could mean going to the Bombay High Court. That is what our sources are telling us this morning. Now, yesterday, the trustees of the Sir Dorabji Tata Trust met and adopted the resolution on N. Chandra not seeking reappointment. The trust also had to appoint a joint nominee for the upcoming AGM. And that could not happen because Sir Ratan Tata Trust, the trust with which it has to appoint the nominee jointly, cannot participate in meetings owing to the Charity Commissioner's freeze. And since there is no update on that front, the restraint order of the 15th of May continues to apply, which is why the next option is the High Court, the appellate authority on Charity Commissioner's orders. Now, we've gone through Tata Sons Articles of Association, and they tell you exactly how tight this is, because until yesterday, this was about one nominee being jointly appointed. From today, it's about 4. Article 86 is the first one. Quorum at a general meeting needs at least 5 members personally present, and that must include one authorized representative jointly nominated by Sir Ratan Tata Trust and Sir Dorabji Tata Trust. But now look at Article 118, which governs succession at Tata Sons. The moment a chairman has to be chosen, a 5-member selection committee has to be constituted, and 3 of those 5 are nominated jointly by the same 2 trusts. The chair of that nominee also, the committee also comes from those 3. So 1 joint nomination for the AGM, 3 more for the selection committee. Sir Ratan Tata Trust cannot take a board decision right now. So in all likeliness, the AGM is also expected to be adjourned if no legal relief comes for the Tata Trust.
All right, Rachna, many thanks for joining us. From the Tatas to Reliance, which is eyeing a foray into defence and aerospace. Reliance Industries and Britain's Rolls-Royce have announced a strategic intent to partner and develop India's indigenous combat engine for the advanced medium combat aircraft. Now, the entry of Rolls-Royce will make it a 3-cornered race with Safran and General Electric to bag the contract to manufacture the jet engines. French aerospace major Safran is partnering with India's gas turbine research establishment, or GTRE, which is a lab under the government's defence ministry. The French company is already embedded in India's aerospace ecosystem through the Rafale fighter jet program. Now, India's negotiations with General Electric appear to have hit a roadblock, and that is on account of unexpected cost escalation. And now, Reliance Industries is throwing its hat into the ring in a proposed partnership with UK's Rolls-Royce. I spoke with Rolls-Royce India's Vice President Sashi Mukundan in June on the company's plans to build the medium combat fighter jet engines in India. Here's why he believes they have, in his words, the most compelling proposal. Take a look.
We're already doing Make in India, right? I mean, if you look at our JV with Force Motors, it's called Force MTO in Pune. It's actually manufacturing, generator sets, right? Power gen sets in Pune. We've already manufactured and export